Good morning, my dear future chartered accountants. It seems the future chartered accountants have reduced. That's the way the course works, so nothing to worry. Let us start the new chapter, which many people again are having some issues, financial instruments. Let's go to the summary of it. So, if you basically identify whether these are financial instruments or not, you can say money, currency is a financial instrument, but pen, mobile is not a financial instrument, or credit card, debit card is a financial instrument. So basically means without even looking at the definition, you know the meaning of financial instrument. Uh, the three standards are there to cover this topic that talks about the volume of this particular content. What is financial instrument? Basically, it's a contract with financial asset of one and liability of another or equity of another. So basically we're trying to tell one person assets is other person's liability, and there has to be a contract, physical, implied or explicit. So when you take a element such as gold, fixed assets, inventory, they are asset of one person but they are not liabilities of another person, therefore they are not called as financial instruments, they are called as physical instruments. Debtor, creditor, bills receivable, loan given, there represents one person asset, other person liability, so they are coming under financial instruments. And if you take an element such as provision for tax, it is not a contractual obligation, it's a legal obligation, and therefore they are not part of the financial instruments. Then what is financial liability? What is financial asset? Let's look at the definitions quickly. What is financial assets? It is cash or equity instrument of another entity, and more importantly, you have contractual right to receive cash or right to exchange other asset, which is potentially favorable, or contract settled in own equity instrument. Typically we apply treasury shares, but in India we don't apply because of buyback provisions. But in general, when you have an asset settled in own equity instrument, essentially treasury shares, own shares, that is what is the last point, but not very relevant in Indian context. So last point, let's not worry about it. The important element is this: you have a contractual rights which will give you ability to exchange another asset and potentially favorable. So if you talk like a option point of view, if you have, let's say, call option, means you have the right to purchase the underlying asset from the holder point of view, and if it is not beneficial, you are not obliged to acquire the asset. That is, you have a choice, you like it or you don't like it, and that is why it is potentially favorable. So for a call option holder, it's always a asset. For a writer, it will be a obligation and therefore liability. Don't ask me who is the holder, who is the writer. That will be again part of your SFM. We can't really cover that in detail. I assume that you know earlier. Financial liability means it's an obligation to deliver cash or another financial asset which are potentially unfavorable. As I just told you, in case of option, holder will always have the right, but the writer has the obligation. So for holder, it is financial asset. For a writer, it is financial liability. Or contract can be settled in own equity instrument. Yes, this is definitely possible. For example, debentures or let's say creditors, instead of paying them cash, you can give your own shares to settle the obligation. That case is financial liability. Potentially unfavorable because it's obligation, liability. If it is favorable, it would have become an asset. And that's the difference between financial asset and financial liabilities. And also more importantly, its obligation should be deliverable cash, not in any other assets, because example, you take warranty. What entity has obligation is you are going to substitute the product or you are going to repair the product. You are not going to pay them cash. So warranty provisions will not be financial liability, since obligation will not be there to pay in cash. If obligation is to pay in some other assets, it will not be financial liability or asset. If you receive advance from customers, your obligation is to deliver goods and not to give the cash back, and therefore advance from customers is also not financial liability. In some situations, you have to be careful, especially in case of, I would say, derivatives. Derivatives means forward contract, option contract, future contract, you name it. You please check whether settlement is on net basis or settlement is on delivery basis. What is the meaning of settlement on net basis? Means if you have an agreement to buy certain things at 10 rupees where market price is 12 rupees and you say let us settle it at 2 rupees only, let's not execute the contract, let's cancel the contract, and the settlement will take place on differential basis, difference between the market price and the price as per the agreement. That is settlement on net, also called a settlement on cash. It is definitely financial asset, maybe liability, maybe asset, depends whether it's favorable or unfavorable. Whereas settlement is on delivery basis means you should check at the underlying asset. If the agreement is to purchase shares, then it will be financial asset or liability. If the agreement is to purchase or sell a PP, which is not a financial asset, so the forward contract on that, derivative on that, is also not a financial instrument. So basically what happens when settlement is on delivery basis, look at the underlying asset. If underlying asset is financial instrument, the transaction is also financial instrument. So it depends on the underlying instrument. That is regarding derivative. So what is derivative definition? There are mainly 3 points for definition of derivatives, 3 conditions. That is, the value should change with respect to underlying asset. So when the equity share changes, its option price also changes. That's what it is. Value should change in response to underlying asset. Initial investment should be 0 or minimal as compared to underlying asset. Minimal 0 will happen in case of forward contracts. You just sign an agreement, you don't pay any money in advance. That is 0 investment. Minimal investment will happen in case of option, because you see option premium versus strike price. Strike price may be 1800, the premium may be 12 rupees. So it's minimal as compared to underlying asset price. That is the point as second one. And it should be settled at a future date, meaning it is yet to be settled. If there is a future settlement pending, you sign an agreement today to be settled at a later date, the settlement is still pending. That is what is called as derivatives. Future options, interest rate swaps, all these varieties will come into this picture. Then regarding this fixed number of shares, variable number of shares, we have to understand this table, keep it in mind. Number of shares is variable and issue price also variable, and both of them are variable. It is liability. One variable, one fixed liability, one fixed, other variable liability. In other words, only when the number of shares are fixed, the price or the consideration is also fixed, then only it is called as equity. In all previous 3 situations, it will be called as financial liability. The number of shares should be fixed, its issue price, agreement price, contract price, consideration should also be fixed. So fixed to fixed test is what we will apply while making the decision regarding whether it's a liability or it is a shares. I mean, in the case of equity. Okay. One more typical variety, the what you expect in examination question, is compound financial instruments, are also called as the hybrid financial instruments. We will have an equity element as well as debt elements. Examples are convertible debentures, convertible preference shares. We have to break it down into debt component and equity components. And how do we calculate it is one of the most frequently asked areas from examination point of view. So for example, if a convertible debentures will have a series of cash flows. One type of frequent cash flows are called as coupon payment, you can say interest payment, and what you redeem at the end, that is called as the redemption price. So the entity has obligation to pay interest, obligation to redeem, and that is why to that extent it is debt or liability component. But it can be converted into shares, therefore there is equity component, and the equity component we compute as a balancing figure as a residual interest. And how do we achieve it? The cash flow, we take it from the contract, that is convertible debenture, but the expectation rate, in the sense the discounting rate, we don't take it from the convertible debenture, we take it from the non-convertible debentures. Essentially, a convertible debenture will have a lower rate of interest because it has an option. Whenever you have a benefit, you have to give up some sacrifice for that, and that sacrifice will happen in the form of interest rate concession, interest rate change. That interest rate concession is what is called as equity element. The interest what you are having as a convertible debenture and what you are having as a non-convertible debenture, that differential element is what we call it as equity element, but we cannot directly calculate it. We have to do it in a mathematical way. Just for example, convertible debenture has got, let's say, 8%. So we do like this: 8 rupees, 8 rupees, 8 rupees. Maybe last year we will have like 108 rupees redemption price face value plus 8 rupee premium. This we are going to convert. We are going to do a present value, discount it at the rate of lower rate, means what rate of interest a person would have given you the money if he did not have the expectation of conversion. Purely these are the cash flows what others would have expected, the market rate of return without conversion option. Without conversion option means I'll expect more. Let's say I'll expect at 12%. So discounting rate 12%, which we'll take it market rate, and in examination problem the market rate will be the rate of coupon of non-convertible debentures. That is a proxy for market rate of interest. So cash flows will be at the convertible debentures 8888108, but discounting rate will be non-convertible debenture at 12%. Obviously the value, present value will be less than 100. Let's say it comes to 96 rupees. So this 100 rupees the net proceeds, total proceeds. 96 is the debt component of it. The remaining 4 is called as the equity component. And for this 96 we are going to keep adding the interest at 8% on a compounding basis, and that's what is called as the amortization method when we go to classification of financial liabilities. On 96 we add 8%, add 12%, sorry, add 12%, subtract 8 rupees, because interest accrues at market rate of interest. You keep adding, compounding at 12%, but subtracting cash flows at 8 rupees. At the end of 5th year or 4th year, ultimately the value of liability would have become 100 rupees. This 4 rupee will be transferred to other equity, the equity component, and on final settlement after 4th year, what will happen to this amount depends on the method of settlement of debentures. This debenture may be settled in cash, in which case entire 4 rupees will be taken to the general reserve. It becomes free reserves. If the debenture is settled on conversion to equity basis, then this 4 rupees will be transferred from the equity component, will be transferred to securities premium to the extent of equity element. Of course, if you don't receive any consideration, you can adjust in share capital as well, depending on the amount involved. But usually you will debenture amount will be sufficient enough to transfer it to capital. So essentially, if you ask me, what is really happening is we are actually paying 8 rupees interest as cash flow, but I'm recording as if I am recording at 12%. So I'm showing more expense than what I'm actually paying. Why I'm not paying this expense? Indirectly I'm saving this expense because I'm giving other person the conversion option. So I have to show the interest expense, and for me to give the option to other, I will receive the consideration. That is what is called as the equity element. If I put it in one more expression or repetition, there are two things which are grossed up here. One thing, you are supposed to pay a payment, and for other things you are supposed to receive it, both of which you are doing it on net basis. You are suppressing the transaction. As per the standard, we are grossing it up. What payment you are supposed to make? You are supposed to make a market rate at 12%, but you are making only 8%. You are paying less. You are saving in expense. And when you give the option to somebody else to convert it into shares, or when you issue shares, you would have received money. So there is one payment which you are not doing. There is one receipt which you are not happening. Both of which we want to show it. We can't just do it on net basis. So we are grossing up the income, grossing up the expense. Grossing up the income means equity element, and grossing up the expense means I'm showing more expense than what actual payment I am doing it. In case it is not settled in equity, that means the excess amount what I have recognized is no more useful. Take it back to P&L. I've shown more expense. I mean, don't take it P&L account. I take it to accumulate reserves. I mean, general reserve. I would have already taken more expense. Now I take the income. Effectively, it will reflect the payments have been made. If it is settled in share spaces, then that amount will go to equity component. Essentially, will go to securities premium. This is the summary part of it. We may look at it, but if you have any conceptual doubt in this context, please ask. And journal entry will be initial entry back account to, let's say, 8% bonds within brackets debt element to 8% bonds within brackets equity element. Debt portion we take it to long-term borrowings, and equity portion we take it to reserves and surplus. It's very interesting. Heading we write reserves and surplus. Below that we write 8% convertible bonds. Yes. If settlement is in cash basis, the entry will be 8% convertible bonds debt element to cash. That debt element will close completely. Will become 100 rupees on maturity. That will be closed. It will be transferred to general reserve. At the end, the debt component, the debt element what we have, along with this equity element, both will have a credit balance. Now we'll debit it 100 and plus 104, and will be to the extent of face value, we transfer it to share capital. Excess will be to security premium. So this indirectly I have received the money as consideration to issue your shares. I received the money at the beginning itself. That's what I call as equity component. No, there also we have it. We have convertible bonds. We compute the present value. We call it as downsize risk. We calculate the value of convertible bonds, and we calculate the value of pure convertible, I mean pure interest and principal portion, as if equity don't have any value. We call it as straight value of the bonds. So convertible bond, straight value of the bond is what difference here we are calling it as equity element, and there we are calling it as the downside risk percentage when you calculate it. So there is a calculation, but here is that's what I was telling. It's accounting for SFM now. So what we used to calculate earlier, now we are bringing into books of accounts. So this we are, again, it's perfectly logical, and that's why I like it. And when you don't follow logic, it can be misused or it can be misinterpreted. That's a problem in practical life, but yeah, examination definitely conceptual. You are giving them some concession. You can't just show what is concession. You have to show both of them. What you are issuing at a higher price, and had you received something, that also you show it. So this transaction netting it off, but we want to show it separately. The fact that we are giving them the option and the fact that I am saving my interest, both should be reflected. And this is not one-off case. This, so many varieties you are going to see in the same chapter. We have concessional loan given to employees, staff loan, concessional loan received from government, we treat it as government grant. uh, Concessional rate of interest or no rate of interest loan given by holding to subsidiary. Or we are going to see uh, the security deposit given in case of customer supplier transaction, or in case of lease transaction you put some rental deposits. On rental deposit you give up the interest expense, that is also to be called as rent. So we have to show on a gross up basis. So this element what we are learning here is not one of the case. This is running throughout the concepts of financial instruments, and that's why Ind AS is in that sense such a beautifully logically constructed thing. It is consistent across standards. The present value concept, fair value, grossing up, all these elements. So in one place you get the hang of it, all other place you'll be able to just apply it. That is why I like Ind AS more than AS, but AS is like this. This is what the rules, we have to follow it. And this area, again, I am repeating myself because in the exam it has been repeated so many times. Here, there, like this, like that, journal entry, debt component, equity component, modification, like there's no end to it. At least 2 attempts once, I think, on an average, they're asking this problem related to this debt component and equity component. So what you have to understand is the difference between the cash flow and the cost. In this example, 8% is cash flow, but the cost will be recognized at 12%. So cash flow for us is different. The cost we take it to P&L account is different. Quickly, if I had to give you an idea about it, just don't worry about the numbers, just look at the concepts. We have like bank account, whatever we receive, it's illustration, don't worry about the numbers. Amount we received 1 lakh, but equity component is 1817, debt component is the 98183. So when you prepare the schedule, what happens is ultimately at the end of the day it becomes 1 lakh, and this equity component will remain in equity component, and on maturity that 8% to bank, if settled by cash, that will be transferred to earnings. And the conversion means to the extent of face value transfer here, excess amount we will transfer it to security premium. Some more elements can happen, some more adjustments can happen. For example, if there is transaction cost, underwriting, issue expenses, flotation charges, processing charges, registrar charge, whatever may be the name. But when you make a transaction cost payment, you don't pay for equity element, you don't pay for debt element. You are going to pay for the issue of convertible debentures. So once you calculate the debt component, equity component, the transaction cost should be divided in the ratio of equity and debt. The expense related to equity will get adjusted with equity. Equity component is 5,000, the transaction expense proportionate is 1,000, so net equity becomes 4,000. That is a done and dusted thing. But regarding the debts, there is one extra step that will be required. In case of the debt element, if there is any transaction cost, what will happen is from the debt component, this transaction cost we have to subtract. Net debt I will get. But if I use this net debt and to prepare the amortization schedule, opening balance, on that you add interest minus coupon payment, closing balance, the amount will not add up at the end, because amount at the beginning is not the debt element. Amount at the beginning is debt element minus the transaction cost, and therefore you have to recalculate the rate of interest, implicit rate, effective interest rate, such a way that the present value of cash flows will become the net debt amount. Because transaction cost I cannot directly take it to P&L account. It is connected with my borrowings debt element. So in case of transaction cost, the borrowing you need to reassess effective rate of interest. It will be slightly higher. Like in our example, it was 12%. With effective interest cost maybe like 12.2%, something like that. Small change will come, increase will come, because transaction cost also will be added, will be considered as part of interest cost, not directly, as a percentage on the balance. And also one more thing. So just for reference, so when you prepare the amortization schedule, it looks like this. Whatever the opening balance, that is debt component. Then we add the finance cost at the rate of interest market rate. Then we subtract the coupon paid, and then we get the closing balance. And basically, if you observe, the finance cost is what goes to P&L account. Amount outstanding at the end is what goes to balance sheet, liability side. Coupon paid will go to cash flow statement. And these are the three components of financial statements. Liabilities, the balance sheet, coupon paid, part of cash flow statement, finance cost will be part of the P&L account. That's how the three elements, three legs of financial statements are structured in case of hybrid bonds or convertible bonds or hybrid instruments. Okay, there is one more concept which I'll discuss now itself. That's called as embedded derivatives. Embedded means implicit. Embedded, first of all, derivative itself is difficult, and the embedded derivatives. You imagine a derivative like a ghost, and the ghost is hidden in a small jar or something. Allowed you scratch it and suddenly it comes out. That is embedded derivatives for you. Derivatives included implicit in some contract. One is called as basic host contract. You see sounding also host, ghost, very similar. Host contract and derivative value in the host contract. Should you separate it? Yes, you can, subject to three conditions. That is the basic contract separate, derivative separate. If three conditions are satisfied, the two values are having different economic characteristics. Existing comparable derivative is there. If you want to value it, you need to have a market for that. And host contract is not measured fair value. The basic contract should not include the fair value of both. So you separate it. The fair value of host contract separately, the fair value of derivative contract separately can be accounted. Just to give an idea, many people get confused because you are spoiled by your SFM knowledge. You're really spoiled by SFM knowledge, or you're too much into SFM, the words is revolving around your mind, and therefore you end up not getting this in its purest form. I'll tell you what exactly I mean. In case of foreign customers, what forward contract is implicit? Or if I ask you, in case of foreign suppliers, dollar, are you selling or are you buying? In case of contract with customer, foreign customer, dollar, are you selling or dollar, are you buying? That is what I am telling you. You are spoiled by SFM knowledge. When will you sell? Once you receive from the customer and then you sell it. I'm not talking about the second transaction. Talk about the first transaction. With the customer, you sell goods and you purchase dollars. You are purchasing dollars. Somehow your mind don't accept that fact. With the foreign customer, how can I purchase? When I say customer, it means sales. Exporter. Exporter means sales. That word is embedded in our subconscious minds. But what I would request is, think of as a barter transaction. Before this cash concept was there, if barter transaction would have been in place, just imagine how the world will be. You go to a class, you don't have to make a payment for any classes. Then how do you take classes? How do you attend any coaching classes? You go and tell the teacher, today shall I drop you home? Your lunch will offer today. Now also you can offer, but anyway, example I'm giving. You start offering something in exchange, but not cash. Imagine that in case of an export transaction. You are selling goods, and in response to selling goods, I am purchasing dollars. Should I account these two separately? Selling goods as a separate transaction, purchasing dollar as a separate transaction. If I do, that's what I'm applying separate recognition principles. That is sale of goods I'm doing, and I'm collecting cash, and I'm purchasing goods, I'm making payment of cash. You, even the one transaction, you separate it as if I'm transacting with some third party. If you separate it, and that's what you are accounting for. Separate recognition, different economic characteristics. For example, if you have a foreign lease, operating lease payable in foreign currency, operating lease increases in response to the inflation rates or as per agreement, whereas the exchange rate, underlying currency changes with respect to the exchange rate fluctuations. So different economic characteristics, that's what it is meant. It is not applicable in all the situations actually. It is in only in some situations, that is, and they will tell you in the exam in which situation, so you don't have to worry about it. Basically, two people's functional currency is same, but their transaction currency is different. That is when you are going to apply this, but that you don't worry much. They will tell you when to account for it. Okay, don't write it down, just try to read this problem. Don't write it and don't go for any final numbers, just read it, just for understanding. ABG Private Limited, a company incorporated in India, enters into contract to buy solar panels from AA Associates, a firm domiciled in UAE, for which delivery is due after 6 months, 30th of June. So you are signing a contract on 1st of Jan, and the due date or the contract settlement date will be after 6 months. So 1st January to 30th of June. The purchase price for the solar panel is $50 million. So you are entering into a contract to purchase solar panels at 50 million. Now don't read anything else. Let's just focus on this one line. When are you going to purchase this? When are you going to make a payment towards this? You will purchase it after 6 months. And $50 million. Let's say exchange rate is 60 rupees. And later it becomes 61 rupees. 1 rupee exchange rate have changed. Does it mean the value of the asset is changed? Logically thinking, when the exchange rate changes, it should not influence the value of the asset. Whether I am entering into a forward contract or is secondary, but for me, when I am recognizing this asset after 6 months, when I am purchasing, I want to purchase at 50 million and I will purchase at 60 rupees conversion rate. I might purchase after 6 months, but the value I know today itself, because it is dependent on the today exchange rate. Exchange rate in the sense, I will take as on date 6 months forward contract. Implicit, that's what I'm going to make use of it. So you can see the 6 months forward rate is spot rate is 60, forward is 65. So actual value will be like 50 million multiplied by 65 rupees. This forward contract, now I'm not entering. This contract is going to be settled after 6 months, and therefore the value of the asset after 6 months should be 50 million into 65. This is the value of the asset I know standing today. But actual rate after 6 months turned out to be 66. So that 1 rupee extra happened because of my expectation change on the exchange rate, not the value of the asset. So value of the asset will still be 50 multiplied by 65. That 1 rupee extra thing, what happened, I'll account it as foreign exchange loss. My cash flow will be 66 rupees only because I've not entered into any contracts. But the transaction which I have to go into account, standing today, after 6 months I'm going to buy the asset, and I know after 6 months the rate is 65. Standing today, it's worth after 6 months this, and I know the value of the after 6 months today itself, it will be that. But actual rate has been 66. No, value of the asset I cannot change it. That 1 rupee excess I can only account for the exchange loss. Okay, that's what is embedded derivatives. I would like to cover the summary part of the Ind AS 109 also. Then I'll take the discussion forward. So any doubts at this point in time, you can ask. Asset debit, forex loss debit to bank or to cash. So both are debited. 65 rupees debited, 1 rupees debited. 5 rupees difference we don't account. It is worth of the goods. Correct, but see, this contract is to be executed on which date? At that time, I'm getting whatever the rate likely to be that time, I'm taking that rates. If I purchase the contract today, I will record at 60 rupees. Then it becomes 65, 5 rupees exchange loss account separately. See, the contract you have to think, two contracts you try to think. One contract, I'm purchasing the goods today, I'm making a payment after 6 months. In this case, I'm not doing that. I'm purchasing the goods after 6 months, I'm making the payments after 6 months. So I cannot treat both of them same. The fact that I'm going to purchase the goods means the value of the goods should be what could be the value at that point in time, standing at that point in time. I have to record that in my books, not today, after 6 months. But today itself I'm expecting something, so I'm writing that because I know the contract is to be executed. So I'm accounting only for the exchange difference. I'm not accounting for the purchase of assets now itself. Then if the exchange rate further changes till the settlement date, again then you are going to apply the different rates of transactions. And when other factors change, value of this it also will change. Other factors can have an impact. That's completely fine, because suppose if this contract is not there and you purchase after 6 months, it happens to be at 65, you'll record 65 only. You will not know about the futuristic course of actions. The reason of factors changes in interest rate, I mean forward rates can be anything. That's fine. No, you are not settling at a predetermined rate. You are not entering into a forward contract on foreign currency. What you are doing today is, I am going to purchase a the solar panel asset after 6 months. So after 6 months, I am going to record in my books as my asset. At what value will I record? After 6 months rates, standing today. But when actually reached that time, it was not 65, it became 66. But I am not going to change my value of the asset. I still recorded at predetermined rate, not predetermined transaction. Forward contract I have not entered into. On a notional basis, had I purchased from somebody, if everything else remains same in the world, it would be 65, and my value of the asset standing today itself, I know it will be 65 into 50 million. Forward rate is an estimation. That is, and when changes happens, estimation change. So 1 rupee estimation change, I am going to record it as a exchange loss. So till that 6 months, asset I don't recognize, but exchange rate fluctuation keeps happening. That I will show it in my books of accounts if I choose to separate my host contract and the derivative contract separate. And that's why practically it is not really followed. It is applicable only under certain circumstances. The reason why we should do it logically, if you ask me, because that contract also I want to bring into books of accounts. That forward contract what I've signed, that should be in my books of accounts for that reason. That I will come to know the amount only at that point in time. That 65 I know today, but 66 I will not know today. That 66, the rate prevailing on spot rate after 6 months, I will come to know only after 6 months. I will not know today. That will happen when when settlement date comes, even at a later date. Here you are signing a contract to get the delivery of goods after 6 months. Let's say you make a payment after 3 months subsequently. So from that 6 months from you purchase and the payment you make 3 months later, the purchase to payment period, in that period you are going to amortize if you sign a forward contract for hedging purpose. If there is a hedging contract, if there is no hedging, the amortization and all will not apply. That is after the date of execution till the date of settlement. We should. If you close the books of accounts every month, you should do it. These are all applicable on reporting dates. Typically, let's say quarterly reporting. So I will report it on 31st of March. 31st of March, if exchange rate happens to be, let's say, 65.2, then I am going to record it for, I thought it was 65, but year end it happened to be 65.2, so I'm going to account as 0.2 as loss. And that 2.2 cannot be pure my loss because this is my expected loss. On 30th of June, I should discount it by 3 months. We call it as fair value or something, or mark to market adjustment. But typically the value component is the 0.2 should be reflected in my books of accounts. Correct. That will go to P&L account. Yes, that is a forward exchange, forward loss. Yeah, that is a liability change. Yeah, that will go to P&L account. That should give. That should give. But usually, yeah, forward contract, fair value of the forward contract, on every balance sheet date, we have to account for fair value change. As long as it is a financial instrument, of course. Correct. As on 1st of Jan, the journal entry, as on 31st of March, we account. Not only for this, any forward contracts, any contract for that matter, you will account only when the contract is settled. But when the contract is in progress, you account only for the fair value changes until the final settlement. The fair value change in forward contract is what we are going to account for it. Yeah, convertible preferential embedded derivative, they have not asked in the exam, but it is worth knowing this concept because many other concepts are involved here. Okay, so I'll just quickly go through the Ind AS 109 as well. Or I should quickly talk about one small point. Okay, conceptually I'll discuss. Point you can go through it. There's one concept called as settlement in own equity shares, or when you are having an obligation to pay, like it actually should have been liability, but still we classify it as equity even when you have an obligation to settle in own instruments. That situation will come. I'll just give an example, then you apply in the corresponding point. It is going to come in mutual funds. Again, we have to connect the SFM concept there. So in mutual funds, you will have unit holders who will withdraw money from the mutual funds, who will invest in the mutual funds. Mutual funds should buy or redeem as an investors. So when the unit holder want the money, mutual fund is obliged to give them the money. Now mutual fund is having an obligation to pay cash. Will it be a liability? The unit capital, should we report as a liability? It will not be a liability, it will still be a equity only. That's one section which will come. Even though obligation to pay cash is there, it will still be considered as equity element. That one concept will come, just be aware of it. Some para 16 something is there. Anyway, let's go to the important points from exam point of view. Okay, classification of financial asset. For that, we apply this model test, business model and SPPI test. Again, for some people, model means they get different image, but for CS students, we have to remember business model and SPPI test. So basically, what we are trying to understand is this: when a company has an asset, financial asset, how it is managed, how it is treated. Is it treated as a part of working capital, or is it treated like a fixed element? Is what indirectly they are telling how the cash flow is managed during the regular course of action. You're having an asset to collect the cash flows till the end, or you are going to sell the assets. That's we call it as the contractual cash flow characteristics, SPPI, solely for the payment of principal and interest. Anyway, let's look at the definition. You will understand better. If the asset what you are held is intention is to collect cash, that is, come what may, I will wait till the end, then it will be for collecting contractual cash flows, it will be classified as amortized cost. Second thing is, I am having that financial assets, but I don't have intention to hold, I will sell it, then it will become FETPL. I have an asset, I don't know what to do exactly, so neither amortized cost nor FETPL, then it is FETOCI. I will receive contractual cash flow also, but if time comes, I'll sell also. You are on the border, then it will be called as FETOCI, fair value through OCI. There is one time irrecoverable option given for equity instruments, investment in shares. It's an option given, no logic behind it. One time option given, if you're investing in shares of other company, do you want to have FETOCI or do you want to have FETPL? If you choose to show FETOCI, from that point onwards, it will be under FETOCI. After, otherwise, it will also be under FETPL. Anything held for trading will come under FETPL. So typically, when this situation will arise in case of financial institutions, in case of banks, there is one concept called as the factoring. That is where this situation apply. Or there is one method where we have sub prime lending concept. You have that Security Asset Reconstruction Act. I don't know whether it's still part of the law. It's popularly called as the SURFACE Act. It sounds scolding somebody, but yeah, it is SURFACE Act, or if you know the full form, you should give 5 marks. I think that's asset reconstruction, some companies. That concept is what is applicable here. So when you give loan to somebody else, will you wait for final settlement, or you are going to hand over it to others, telling I cannot collect the money, you collect it, you give me the money. That's called as factoring. Or what else you do is, you have this concept of debt securitization in SFM. You can connect that point. All the loans, we are going to bundle it and we transfer it to new company, and they will, taking that as the base, issue securities to others. Basically, what you have converted, the bundle of loans, you are able to collect the money for that. You have converted the loan into cash, and if that is the nature, it will not be at amortized cost. It will be classified as the FETPL. Still, lot of confusions are there, but basic point to be kept in mind: asset held till final collection, amortized cost; asset held for selling purpose, FETPL. You're collecting contractual cash flows, as well as you might sell anytime, it will become FETOCI. That is on the assets is concerned. Liabilities, derivatives, held for trading, contingent consideration, if you remember, business combination, designated as FETPL. That is, if asset is FETPL, liability also should be FETPL if there is one-to-one connection. In these cases, it will be FETPL. Continued involvement, I'll cover it slightly later. In all other cases, amortized cost basis. Amortized cost means opening balance plus interest minus coupon payments, the closing balance, amortized cost basis. Creditors loan, all those will be amortized cost basis. Regarding the measurements, Initially it should be at fair value basis, instrument at market terms, transaction price we assume it is fair value basis. Market terms means not with related parties, we can assume transaction price and fair value both are equal. But if it happening at not at market terms, not at market terms means happening with some related party. And when I say related party, it is not related party. I don't know whether you understand my English. When I use the word related party, don't go to definition of related party. They are reportable related parties. Maybe related party means they are not regular market participants. So if you are transacting with the customer, you are not a market party. That is, you are not going to do it market terms. You are keeping some money as deposit, rental deposits. Have you given it to somebody else, the deposit you would not have given just like that. You expect interest. But with the landlord, you have given the money because you are expecting him to, or he is expecting you to take care of the property, therefore you are giving the deposit. So there is some other element which is being connected, which is not at market terms. That's what I meant by not at market terms. We measure at fair value, and which will be different from transaction price. And if level 1 input is used from Ind AS 113, in the sense market price, if it is used, then difference you can take it to P&L. If other inputs is used, then usually you are going to show it as asset. Yes, if it is qualifies. Example I'll give you. Typical example, they will ask in exam also, they have asked it. Let's take customer supplier example. You are purchasing goods from, let's say you are purchasing some liquid. You are a chemical manufacturing company, you need some chemicals and you can't get the chemicals like this. You need containers. And the containers are so costly that the supplier will not sell you every time. It's not like your water bottle or your Coca-Cola bottle where the cost is cheap. The container also is costly. So what he told, you can use my container, give it to me back. But we Indians, no, when something is given on trust, how is it possible? It is really not to us, at least. Therefore, he'll say, I'll trust you, but you keep the money as deposit. In case you ran away, at least that money I can use it. So as a customer, you have deposited money with the supplier, and once the relationship ends, the deposit will come back to you. Now this deposit will not have any interest element. This is transaction not happening at market terms. We have to account it as an asset and we have to account it as an expense. Let me explain the concept. Problem maybe you can have it later. This is one repeatedly asked question in exam as well, this particular area. Just for example purpose, the deposit what you have is 10,000. You are going to receive this deposit, let's say after 3 years. Will this 10,000 remain same after 3 years as well? So 10,000 after 3 years, if you do a present value, let's say it will come to 7,000, which means in this contract, contractual cash flow you're receiving after 3 years is 10,000. If you have to receive from somebody else same 10,000 in market terms, today how much you would have given it to them? You would have given much less, in this example 7,000. So if market terms I have deposited, today I deposit 7,000, I'll get after 3 years 10,000. This 3,000 income I am foregoing, because I have a relationship with them. I have a relationship means, don't think differently, that I have a transaction relationship with the supplier there. So this 3,000 what I'm sacrificing as income has a purpose. That purpose should be recorded. This income also should be recorded. Effectively, if I have to pass one journal entry, the entry will be deposit account 7,000. This expense account debit 3,000. To bank 10,000. Deposit 7, on that you keep adding interest. you accumulate interest, because 7,000 on that interest, on that interest, on that interest, it will come to 10,000. So what journal entry we pass for interest? Deposit account debit to interest income. Now where will this 3,000 income go to? P&L account. Where this 3,000 expense will go to? P&L account. Ultimately that has no effect over a period of 3 years. But the amount of income you show, the amount of expense you show, that will not be equal. The expense we will amortize, 3,000 divided by 3. But income we accrue it, we compound it, we follow it on effective interest basis. If I ask one journal entry, I'm passing entry like this. Expense account debit to income account. Again, if you tell this journal entry outside, they will think something happened to you, but that is what the requirement of this standard is all about. We are recognizing an expense because I am making that payment, or I am sacrificing that interest to have transaction with that supplier. Indirectly, that is my expense, my sacrifice, and I have to earn my income. Had I given to somebody else, I would have earned my income. So I am showing my expense, I am showing my income, and that is what is effectively happening. Expense I will amortize over 3 years. Income I will recognize it accrual basis over a period of 3 years. This transaction also applies in case of concessional loan given to employees. Again, typical problem being asked in examination, which means the market rate of interest may be 10%, you give the loan to employee only at 6%, 4% you sacrifice. And why are you sacrificing that? Because you are receiving the service from employee. You recognize the expense of employee and recognize the interest income foregone. Expense also you recognize, income also you recognize. The method of calculation is same. Cash flow you do a present value, then actual transaction, the transaction fair value, the difference is what is going to be treated. Either as expense immediately, or if it qualifies as it will be amortized over a period of years. Which basically means, if you live in a rented house, you pay rent of, let's say, 10,000 per month. That is your rental expense. And you have deposited 12 months, 10 months deposits. On the deposit, you have foregone interest expense, that also to be called as rental expense. That's what this point basically says it. Okay, let me just show you the different classification. Initially, this already told you. Yeah, this is already done. Various situation can arise. I told you example of tenant, employee. It can be parent subsidiary relationship. Holding company give concession loan to subsidiary company, not expecting anything. Why are you giving the loan to subsidiary company? Because you want the subsidiary company to grow. It's like an investment from your side. Therefore, you account as investment. And income you are supposed to receive. Had you given to somebody else, you would have received interest. So journal entry effectively be investment account debit to interest income account. That is what is parent subsidiary, or subsidiary to parent. Reverse also can happen. Very rarely, subsidiary company gives to loan at lower rate of interest. That is because the parent want to extract the money from subsidiary company indirectly. Therefore, it will be treated like a dividend received. Or government grant to the entity, they give at a concessional rate of interest loan, or a zero rate of interest. That interest foregone by the government to be accounted as a grant. That is what is part of Ind AS 20. As far as the recognition subsequent is concerned, initial recognition at fair value, FET OCI, if it's the classification, everything is fair value only initially. Transaction cost, amortized cost means we add it to fair value and we recalculate the rate of interest. That's called as the implicit rate of interest. Same thing with FET OCI, but if it is FETPL, then the transaction cost is transferred to P&L account. Subsequent recognition, amortized cost, market value does not change. We do it only at amortized cost basis. That means the effective interest basis. FET OCI, valued fair value. FET OCI equity, fair value. FETPL also fair value. FET OCI debt and equity means you are investing in debt instrument, investing in equity instrument. Means investing in bonds of another company, investing in equity shares of another company. That's the difference between the debt and equity in the heading. Initial income recognized in amortized cost, effective interest. In FET OCI also will be at effective interest, and fair value change will be transferred to OCI, but effective interest will still be applied even in FET OCI, but debt element. For equity, we can't use any interest element, so transfer it to OCI. and FETPL changes transferred to P&L. Interest or dividends, amortized cost, only effective interest is taken. FETOCI, FETPL, every case will be taken to P&L. Derecognition, difference you transfer it to P&L. FETOCI, if you remember, it is with recycling. It will be from OCI, it will come back to P&L. FETOCI equity, without recycling, then FETPL anyway directly P&L account, it will be transferred. This is financial assets recognition. Subsequently, liability recognition is not a complicated thing. What is important is derecognition, and what is important is modification. Those 2 points I should discuss. One more small point is there, but that is not important. Examination, practically it's important, but examination is not. Impairment of assets, in the sense, if provision for doubtful debts, the customer is not paying money, receivable is not recoverable, what do? Impairment is what we call it. We have to make a provision. If it is towards trade receivables, I mean debtors and all, or lease receivable for financial lease, lifetime expected credit loss is provided. In case of others, we just go with 12 months credit losses. Otherwise, it has to be lifetime credit losses. This has a serious implication on banks, because banks in India at present, we follow the rules given by RBI, prudential norms like doubtful debts, NPA, substandard, that percentage 25, 30, 40%. If this comes, they have to provide lifetime credit loss. So within 30, 40 days only, they have to provide for full loss. The banks will be in serious trouble. Already NPAs are mounting and the banks are suffering due to Corona especially. That's why they are postponing Ind AS application also. The Ind AS is not applicable to banking companies, at least in this context. If they start applying, I think banks might collapse. Like, this is a serious issue, practically, not so much in examination point of view. Okay, let's look at derecognition. Means when you take out the asset from the books of asset, financial asset from books of accounts, when there is expiry of a right to receive. What is that expiry of right to receive? You have a debtors in case of discount or in case of bad debts. What is the difference between bad debts and discount? Discount means you are telling don't pay. Bad debts means he is telling I will not pay. In both cases, you are not receiving money. The asset should be derecognized. This is an interesting point. You transfer the right to receive. Especially it will happen in case of factoring. You have a receivable, you outsource it to a third party. You transfer the right to other person. There are two types. One is called as the with recourse, other is without recourse. With recourse means in case he is not able to collect the money, he will come back to and say, I cannot collect the money, you give it to me. Without recourse means if he is not able to collect the money, that is his headache. That's what here we call it as. Does it qualify for transfer of risk? Substantial transfer of risk and rewards. If substantial transfer risk and reward is transferred, then it is, it is without recourse, means risk is transferred completely. You can derecognize. Otherwise, what you are going to do, you will recognize the asset also, and amount received also you will be taken as a liability. Asset also will show, liability also show. One more typical situation this will apply is in case of bills discounting. You have a bills receivable, you go to bank and you discount it. You don't have any obligation, right is transferred. But in case the drawee or the drawer, who? Payer. Remember those terminologies. In case the drawee is failed to make the payment, then you have the obligation to make the payment to the bank. That means your liability is not discharged yet. Significant risk and rewards are not transferred. In case of bill discounting, you should continue to recognize the asset, and money received, you recognize it as a advance received. Once the time period is lapsed, then you can set off the asset and liabilities. Till then, you will show it separately. Financial liability when discharged, yeah, this is important. This is one area again. Institute is asking questions. Modification, or it's called as extinguishment accounting. In case of liabilities, if there are any change in the terms of the contract, a coupon rate might be changed or the term might be extended. Typically it's happening now because of corona effect. You are going for restructuring of activities, the loan might be postponed. In those cases, liability point of view, if it is material, then more than 10%, we are going to account it as if it is a fresh transaction. If it is less than 10%, we are not going to worry about any much of changes. Let me explain what is this modification or this extinguishment accounting. When we apply, it is material more than 10%. And how do you say, first of all, the 10% or not? We take the cash flows, new cash flows at the old rate, new cash flows at the new rates. That is basically the difference between the present value what we have. We check whether it is more than 10% or not. I repeat this: the existing value of the liability what we have, I compare with the new cash flows but the old discounting rates. Whatever discounting rate which was considered initially, these concepts will come in Ind AS 116 as well. Lease modification also same concept is there, but material 10% all is not there, but calculation of present value concept is similar. So we take the new cash flows, but modified cash flow, we take the old discounting rate, we see present value, let's say it is 10 lakh 10,000 and the existing value is 10 lakh. So 10,000, just 1% difference, we are not going to use the new discounting rate. But if it is if it is material, in the sense the difference is crossing 10%, then we are going to extinguish. Extinguish means existing liability will be closed and the new liability will be recognized fresh. Existing liability book value, the new liability will be new cash flow and new discounting rates. The present value will be like a fresh loan. The fresh loan maybe let's 11 lakh, existing is 10 lakh. That 1 lakh will be transferred to P&L as a extinguishment accounting or profit or loss on restructuring or modification of financial liability. And then that loan will be recognized as a separate thing. Be careful about the transaction cost. Transaction cost also will be part of the financial liabilities. So you may have to consider effective rate of interest, which will be usually given in the problem. Okay, so this is what is the important element as far as the theoretical concept is concerned. See if you have any doubts in this context. Anything else related to the financial instruments? I have covered mainly from exam point of view. I have not gone theoretically in depth. What is required for exam? They can ask you a problem on derivative, whether it's a financial asset or not. Problems on concessional loan given to employees, problems on security deposits, problems on the debt component, equity component, maybe a problem on embedded derivatives. These are the areas which are concentrated heavily. From exam point of view, only that portion I have covered it. I have not gone too much into the details. But anyway, at this point in time, any questions, any doubts in the context? If you have anything, get it clarified. Okay, nothing else? No questions? Okay, fine. This is on Ind AS 32 RTP November 2021 question. On 1st of April, PS Limited issued 6,009% convertible debenture with a face value of 100, maturing on 31st March 2006, means after 5 years. The debentures are convertible into equity shares at a conversion price of 105. Interest is payable annually in cash. At the date of issue, non-convertible debt could have been issued by the company at a coupon rate of 13%. On 1st of April 2004, convertible debenture have a fair value of 6,30,000. Oh, on 1st of April 2004. So before maturity, at the date of issue, non-convertible debt could have been issued by company at a coupon rate of 13%. This is 13% rate for non-convertible debt. We will be using it as discounting rate. On 1st of April 2004, after 3 years, convertible debentures have a fair value of 6,30,000. PS Limited makes a tender offer to debenture holders to repurchase debentures for 6,30,000, which debenture holder accepted. At the date of repurchase, PS Limited could have issued non-convertible debt with 2-year term bearing coupon interest at 10%. Show the accounting entries in the books of PS Limited for recording equity and liability component at the time of initial recognition, at the time of repurchase of convertible debenture. It is premature settlement. Initial recognition should be straightforward, not a complicated one. That is, our discounting will happen at 13%. The cash flow, contractual cash flow, will be 6,000 into 9% into 100 and multiplied by the annuity factor. And last year, 6,000 into 100 will you take, or 6,000 into 105 will you take? 100 for redemption. I'm talking about the redemption. Do we take 100 or do we take 105? 105. 100. Don't expect answer from my reaction. That is, you will never get it. Read it carefully. It is conversion price, does not mean redemption price. It is convertible at 105, not redeemable at 105. So if you redeem, you get 100 rupees only. Face value, nothing is mentioned. So for present value purpose, we still have to take 100 for debt calculation. So present value of 5 years interest payments, 54,000. That is 54,000 is 9% on 6,000 into 100. Interest 54,000 multiplied by annuity factor, then 6 lakh multiplied by discounting factor. This is the obligation to pay cash. So 5,15,718 will be your debt component. Proceeds 6,000 into 100, which is 6 lakh. Therefore, debt component is 5,15,000. Equity component is 84,282. Yeah, since 105 is conversion price, it's not used. Journal entry: bank account to debt component to equity component. That is the journal entry at the time of initial recognition. Essentially, what is the meaning of this 84,282? This is the concession you have forgone because you are giving them the option. Had you given this debenture to somebody else who don't have conversion option, this amount you would not have left it. You would have received this money as well. So this money essentially is received towards issue of shares. Indirectly, it's received towards issue of shares, and that's why it is equity component. Many people think it's a profit. It's not a profit. This security premium received is not a profit. It is money received towards issue of shares. That is this context, equity. Now on the settlement, what will happen? If it is settled on cash basis, this liability would have become 6 lakh at the end of that number of years, 5 years. So at the end of 5th year, this would have become 6 lakh. And this equity component we will transfer to general reserve. It becomes free reserves basically. but it is not happening after 5 years. It is being happening after 2004, after 3 years only. After 3 years means the debt component will not become 6 lakh yet. The equity component is not 84,000. Book value 84,000, but as on the date of settlement, you have to calculate again what is debt element, what is equity element. And the difference between debt element, equity element should be reflected in P&L account. Reassessment, modification, whatever we call it. And for that purpose, what they have given, how many remaining years to maturity? 2001 to 2004 means 3 years over out of 5 years. 2 years remaining to maturity, and 2 years remaining means the rate of interest the company could have issued non-convertible bonds with the rate of 10%. The new rate of interest will be 10%. So you should calculate the cash flows of this 54,000 interest and this 6 lakh redemption amount for remaining 2 years. You get the debt component standing at third year end. And some people apply extraordinary mind in exam. Here you don't do it because you don't think here. In exam you will think. In exam what do you think? How many years per year? 1, 2, 3, 4, 5. Out of first year over, second year over, third year over. Fourth year discount, fifth year discount I'll apply. I don't know you're getting what I'm trying to tell. Here you don't think, because in exam is where actually you think. No? So 5 out of 5 year, 3 years over, remaining. Fourth year discount, fifth year discount, apply it, you get present value. Standing on third year, remaining 1 year, remaining 2 year. So you should still use first year discount, second year discount. Standing at that point in time. And that amounts the present value of 2 years, remaining interest payment 54,000, discounted 13% and 10% respectively. Carrying value. Okay, that's one more thing I should tell. This 5,15,718 becomes 6 lakh after 5 years. But after 3 years, you have two methods. One, you prepare the table. Opening plus interest minus coupon closing, like a amortization schedule. You get the value after 3 years. Or what you can do, remaining 2 years, you take the old rate only. The value should come to same mathematically. I don't know, your reaction says this fellow speaking some bad words in the morning, but I hope you understand. What I'm trying to tell you is you can calculate in two ways. One way is you start the opening, in this example, rate of interest, you keep adding 13% and subtracting the coupon payment. Opening plus interest minus coupon closing. That closing becomes opening plus interest minus coupon closing, and that becomes opening plus interest minus coupon becomes closing. That is the book value carrying amount at the end of third year. The second method what you have is standing at the third point in time, remaining 2 years cash flows, take it at old rate only, 10%. That also will give you the same carrying amount, which is what Institute has done. Carrying amount, they have taken 13% only for remaining 2 years. Whereas fair value purpose, the debt component purpose, they have taken 10%. Hope you understand this calculation. And 6 lakh, they have taken 13% here, 10% here. So liability component, this is the book values. Or do one thing quickly, do it in calculator so that you can use calculator. 515,718 plus 9% minus 54,000. Do it 3 times like this. You start at 5,15,718 plus 13%, yeah, plus 13% minus 54,000. I'm sorry, 5,15,718 plus 13% minus 54,000 plus 13% minus 54,000 plus 13% minus 54,000. Just 3 times you should do it. You will get the carrying amount of approximately at least 5,60,000. 5,59,000 they got, 5,60,000 approximately you get. That's what they have applied. They have applied the remaining cash flows, old rate only they have used. And here fair value means new rate. So this is the liability component. It was 5,59,000 and 5,89,000. What about the total component? You see the today value they said 6,30,000, the fair value of debentures, so 6,30,000, and the difference is the equity element. And the carrying value, this is existing only 84,282, that is continued to be as 84,282. This is existing amount. This 40,710 is a balancing figure. Now we are reassessing this one. Please be careful, look at this calculation. The book value is 5,59,000, the fair value is 5,89,000, therefore the difference is a loss. Liability is more than the book value. When liability is more, this is a loss transferred to P&L account. This is equity component 84, but actual equity component is 70. So the difference is actually a profit, which will be transferred to reserves, which will be transferred to free reserves, general reserve. For that reason only we have calculated like this. So journal entry will become like this. Debenture account 5,59,000, that is the liability component today. And P&L account, I'm sorry, this is the fair carrying amount today, 29,418. Effectively we are accounting at 5,89,290. The fair value amount is repaid. And we are also paying 40,710, which is equity component. Then debenture equity component 84, remaining is transferred to retained earnings 43,572, which is same as this number 43,572. I'm not sure whether you get this journal entry amount wise. Effectively you are paying to bank 6,30,000. That is the amount which is settled. Then what is the 8% debentures? Carrying amount is 5,59,872. This is the book value of debentures, and the loss on restructuring or loss on early settlement, whatever it is, that is 29,418. Then you transfer to general reserve, that is what is this amount, the difference in the equity component 43,572, and then you transfer or you close down that the equity component, you debit 8% debenture, the equity component you debit whatever the book value. The book value is 84,282. Anyway, this is the one entry you are passing effectively. If you are able to understand, that is well. Okay, that is regarding this one. Let's go further. ABC Limited issues, this is May 2022 question. ABC Limited issues 4% 1 lakh OCPS. What is this OCPS? Optionally convertible preference shares. I don't know what and all they're expecting us to know the full form. In exam we can't do Google. At a face value of rupees 100 per share, and these are redeemable after 5 years. Dividend is non-cumulative. Each preference share entitles the holders 10 shares, and preference shares are optionally convertible by the debenture at any time until maturity. How will the preference shares be classified at initial recognition, assuming that a comparable instrument carrying a market rate of 7% provide the journal entry for 1 year? Will classification be changed subsequently in case there is a likelihood OCPS will be encashed at the end of maturity periods? It's actually very similar only. It's a compound financial instruments. What we are going to recognize, market rate of interest, discounting rate 7%. So you'll do 1 lakh into 4% into 100 rupees. That is your interest. 1 lakh into 100 to 4%. That is what I think you are supposed to get the amounts. But one more important point is it is non-cumulative, right? Dividend is non-cumulative, so it's not really an obligation. So the interest component I cannot recognize. I mean the preference share dividend component, it will be recognized every year as and when you make profits. It's no obligation at the beginning. So that's why you see here 1 lakh into 100, the principal components are discounted for 5 years, and that comes to 7129. So out of 1 crore, 7129 is debt component, the remaining amount is equity component. And you know that you start with the equity component, you add interest, no repayment. Even if you have any repayment of that is recognized as expense separately, that will, because it's non-cumulative in nature. So opening balance plus interest, no repayment, closing balance, and at the end of 5th year, that's what amortization comes to 1 crore. Journal entry at the beginning, bank account debit to liability, that's 7129, that we calculate here, 7129. To equity balancing figure, equity components. And every year you are going to recognize that unwinding of discount, that is the table we prepared. You recognize interest expense transferred to the P&L account. And any payment made, that also will be taken to P&L. But it is non-cumulative in nature, so I cannot do it in advance. And finally, on the date of exercise, this liability account will be transferred to equity, meaning to share capital. If any excess is there, it will be transferred to security premium. If on settlement in maturity, if cash means liability account debit to bank, that is the liability finally settles. Okay, now they're asking one question. How will your, what is it that? Will the classification be changed subsequently in case there is a likelihood that they will be encashed at the end of maturity period? If there's a likelihood, then also you will still continue to recognize equity component. You will not close it. Only on final settlement, the equity component will be closed. Until then, whether likelihood is there or no likelihood or no livelihood, it does not matter. The equity amount will still continue. That will not be changed, and that will not be even reassessed. That will, because it's equity component, and equity components are not reassessed. Only debt components are reassessed. You learn that in share-based payments as well. Okay, that's a straightforward question. Next. On Feb 1st, 2009, the next question, this is on the fair value of the contracts. On Feb 1st, 2009, Future Limited entered into contract with Sun Limited to receive fair value of 1000 Future Limited's own equity shares outstanding on 31st Jan 2010 in exchange for a payment of rupees 1,04,000 in cash, that is 104 per share. The contract will be settled in net cash on 31st Jan 2010. The fair value of this forward contract on different dates were under fair value of the forward contract on 1st of Feb, on 31st of December, on 31st of Jan. Presume that Future Limited closes the books of accounts on each 31st December each year. Pass entries if settled in cash, if settled by delivering shares. So how to account for the forward contract? What we are discussing, it will be accounted on fair value basis. So as on 1st of December, though there is no fair value change, on 31st of December, you are going to account for 6,300. What entry will you pass? Forward contract account debit assets to fair value gain, and fair value gain will be transferred to P&L account. Then fair value of the forward contracts, again then 2000. Then what you do? 6,300 has become 2,000. Don't think additional 2,000 gain. This 4,300 is not going to be a loss. So debit the fair value loss account, which will be transferred to P&L to the asset account 4,300. So 6,300 asset will come to 4,300. And if settled in cash, you receive the balance of 2,000. If settled in equity, you transfer it to your equity account, or you adjust it in equity, means share capital. You treat it like a buyback. You treat it like a settlement of equity, or just for exam purpose, you can just say don't debit to cash, just debit to the equity account. Ultimately, this forward contract account is closed. Okay, next. Okay, Softtech Limited has a policy. This is July 2021 question. Softtech Limited has a policy of providing subsidized loan to its employees for the purpose of buying or construction residential houses. Mrs. B is a senior manager in the company. The company granted loan to her on the following terms. Loan amount 25 lakhs, interest rate 4% for the first 10 lakh, 7% for the next 15 lakh. I don't know why they want to complicate these things and all, but they have done it. Interest 4% for the first 10 lakh and 7% for the next 15 lakh. Loan disbursed on 1st Jan 2019, tenure 5 years. Prepayment, full or partial prepayment, adoption of the employee. The principal amount of loan shall be recovered in 5 equal installments and will be first applied to 7% interest bearing principal. The accrued interest shall be paid on annual basis. Mrs. B remain in service till the terms of loan ends. Market rate comparable is 12%. Give calculations by adopting present value factors are given. Following table shows contractually expected cash flows from the loan given to Mr. B. They have given this table. Actually, this table we can also prepare it. But anyway, they have given it to help you. But by looking at the length of the question, you would have helped yourself by going to next question. So this table, see, they have given 25 lakh, 5 equal installments. So 25 lakh is the loan, divided by 5. That's what the principal they said, 5 lakh each. But that is again a controversial thing. They have given it here. But in general, when they tell 5 equal installments, how do I interpret? It should be equal principal or principal plus interest. Technically speaking, it should be principal plus interest. But all the exam question I have seen in FR related to financial instruments, when they use the word 5 equal installments, they have interpreted as 5 equal principal payments. Why? I don't know. They have done it. I can't explain any logic. So you also don't have any logic in the exam. You also make a same assumption in this particular case, not applicable in other problems. When they tell you 5 equal installments, especially loan given to employees, maybe employees can't understand this. I think that they would have done calculation like that. The loan amount divided by 5, make it as principal equal payments, like the way they have done it here. And how you are going to calculate interest on 25 lakhs, you can't apply directly. They said the first 10% to 4 lakh means 40,000, and 7% 15 lakh means 1 lakh 5,000. That's what they have done. 1 lakh 5,000, 40,000. So out of 25 lakh, 5 lakh you repay, balance 20 lakh, and then 5 lakh you repay, then 15 lakh, 5 lakh you repay, 10 lakh, 5 lakh you repay, it becomes 0. How are you calculating the interest? They said next we have 20 lakh. Out of 25 lakh, 5 lakh over 20 lakh. On 20 lakh, how do you make the interest payment? First 4 lakh 10%, 10 lakh 4% only. But next how much? 20 lakh minus 10 lakh. That means next 10 lakh will apply 7%. You get 70,000. I really don't understand the purpose of complicating these things in exam. This is not at all related to the accounting point of view. This, forget in accounting, even in financial management, this type of structure will not be given. But in examination, they will ask, Mrs. B prepays 5 lakh, adding salt to injury. On 2020, Mrs. B prepays 5 lakh, reducing the outstanding principal as on the date of 10 lakh. Following table shows the actual cash flows considering the prepayment. So this table now is revised. So basically this table is valid only till 31st December 2020. Now it was supposed to be 15 lakh minus 5 lakh she did. So this became 10 lakh. So this actually is redundant after this, whatever it is. So next table they have given. I'm sure this question was prepared when the examiner was in very bad mood. Maybe the article goofed up some filing of income tax return. Maybe you would have filed some wrong PAN number or something. In that context, he created this, so that whole article students suffer. Okay, so this is the new table. 25 lakh, 20 lakh. You see, it was supposed to be 15 lakh. Now here it is 10 lakh. And that means entire things over 10 lakh means you are going to charge only the interest at the rate of 4%, 4%, 40,000, and then 5 lakh only at the rate of 4% means 20,000. Prepayment is done. So what is their problem now? Record the journal entries up to December 2020 in the books of Software Limited, considering the requirements of Ind AS 10. Past journal entries. Okay, let's see what is their journal entry is all about. Okay, so now this is a case of modification. Now modification, before we go to the stage of modification, at the beginning we have to recognize it fair value basis, meaning all these cash flows. How much cash flows? 5 lakh 40,000. Now 5 lakh 40 plus 1 lakh 5. The entire amount is year 1 cash flow. 5 lakh 70 plus 40, that is second year cash flow. 5 lakh plus 35 plus 40, third year cash flow. 5 lakh plus 40, fourth year cash flow. 5 lakh plus 20, fifth year cash flow. These 5 cash flows will be discounted using market rate. Oh, is there? Okay, market rates 12%. So discounting factor also they have given. So we can't even use annuity factor here. Every year cash flow is separate. So we do like 6 lakh 45,000 into 0.8929. Like that we do the first thing. And we get the first table. Which we get like this. Okay, so as I told you, discounting factor 1. I don't know, maybe the typist also must have been frustrated with these numbers. So anyway, I think this typing did not come as a typing mistake. It should be these numbers 0.7972, 0.718, 6355. These numbers, when I discount it, that's how I get the present value. So I get the fair value at inception 21,09,000, but the loan given is 25 lakhs, and the fair value comes to 21 lakhs. So 4 lakhs, 3,90,000 is the difference between the fair value and transaction price. And this we should amortize it over the period of the loan, because the contract says that the employee should be in service. So the benefit we are going to receive over a period of time, so this will be treated like a prepaid expense and amortized over a period of whatever number of years, divided by 5 or something. And how much will happen to the liabilities now? Amortization schedule, if you prepare, we start with opening balance of 21,09,000. Then on that we charge interest. What interest? This again up to 10 lakh, beyond 10 lakh and all is not there here. here only one rate of interest, which is 12%. The opening balance, on that you add 12%, opening plus interest minus repayment is closing balance, and this closing becomes next opening, on that you apply 12%. So opening 17 plus 2 lakh 6 minus 6 lakh 10 become the closing balance. The amortization process continues. At the end it becomes 0. Some people see mask there. At the end of the table the value is 0, and our marks also will coincide with that. Okay, so they asked what journal entries every year they have to pass, or up to December 20. Okay, 2 years. First entry you understand, that is okay, let's show it. First year entry. Loan to Mrs. B, prepaid employee cost to bank, that is what is prepaid expenses amortized over 5 years. You can see 3,90,000 divided by 5. I think approximately you get this number. Then for receiving the money, receiving that loan repayment 6,45,000 to loan to interest 2,53,000 we calculated here, 2,53,166. So bank account debit to interest income, to the balancing amount will be apportioned toward principal, or you can pass one separate entry also. You can pass separate entry in the sense that loan account debit to interest income. Then you can pass one more entry, loan to bank. The 2 entry also you can pass. They have passed one that entry, and this 3,90,000 divided by 5 prepaid expenses amortized to P&L account. You don't have to pass P&L account entry and all. This much is sufficient. Then next year again same thing will repeat. Second year, will be bank account to interest income, the second table, the second number in the table 206,146, balancing figure applied toward principal, and this the same number 78,057 apportioned towards amortization. Okay, now there is a repayment, prepayment and pre-closure. For that you have to compare the carrying value, and you don't have to do modification as such. You just have to look at whatever the amount paid and carrying amount, the difference we should treat it, or adjustment we required. What is the amount of loan repaid or carrying value? I think go back to the table. Second then, okay, carrying value, I'll put it the table. Let's see if we are able to follow it. Okay, computation of carrying amount, new amounts. So what we are going to do is very simple. Standing at that point in time, remaining cash flows and remaining discounting rate. What will be the remaining cash flows? Look at the table. They have given the table just for your information, that they are not asking you to calculate. They have given second table. This was the original table, the second table. Second table, the remaining cash flows after this 31st December 2020. The amounts are 5 lakh plus 40,000, 5 lakh 40,000, and 5 lakh plus 20,000, 5 lakh 20,000. These two numbers we will be discounting at which discounting rate? First two only. As I told you, as on 31st March 2020, remaining discounting rate 7118, 6355 and all, don't take it. Remaining 2 years, still we take 0.8929, 0.7972. That's what they did. 5 lakh 40,000, 0.8929, 5 lakh 20,000, 0.7972. This is the supposed to be the revised carrying value. And what is the current carrying value? You can look at the table. It is at this time, is it 13 lakh, this number 13 lakh 1328, yeah, that number. So difference is the adjustment which is required. So adjustment means what you are going to do, you debit this loan account 4,17,318 and you write, no, you don't debit, you credit, because the loan account is closed. So to loan account 4,17,318, and you debit the bank account. The 5 lakh received, the excess amount you take it to the P&L account. The adjustment required. Let's see the journal entry for that. So you receive money, that is bank account debits, 2 prepaid employee cost, that is balancing figure, 4,17,318 is what you are going to close the loan account, and differential amounts is transferred to P&L account. Okay, they're not transferring to P&L, they're adjusting the employee cost. Effectively, it will be adjusted in P&L account. They're adjusting with the debit balance, that prepaid employee cost what they have. They're adjusting towards that. Okay, so that's what the journal entry over a period of so many years. If you really think it's not complicated, but they make it complicated because of the volume involved and the amount. They just complicate it. The concept of this problem is initial recognition, present value of the loan, the difference is the prepaid salary expense which will be amortized. In the case of pre-closure, you have to calculate the revised carrying amount using the remaining cash flows discounting rate, and that difference and the carrying amount, to that extent the asset, the liability asset account should be closed. Difference we'll take it to P&L, in the sense we will adjust with the prepaid employee cost, which will be effectively gets reflected in P&L account. Okay, that's what this problem was all about. I don't know how many marks it was asked, remember 15 or 16 I think. It is definitely not justified. It's not fair. We discuss everywhere fair value of the loan, but the marks what they put is definitely not fair. It's unreasonable. It's for the sheer length, not the concept, not the complications. Pass, no? I mean, here, bank, this one, employee benefit to prepaid employee costs, employee benefit to prepaid employee cost. 2 years is what they asked. Next year onwards, value will change because we have adjusted the last amounts. Next year onward, this value will change. Okay, so that's about this one. So hedge accounting, I'm really not sure whether from exam point of view it will be there, but somewhere in back of your mind it could be there that something hedging is there. So for satisfying that, hedging basically means to cover risk. So there has to be 2 parallel accounts. One is hedging instrument, hedging item. Hedging item creating the risk, for example sundry debtors, foreign customers, and hedging instrument, for example the forward contract what you enter into will be covering the risk. There are 3 types of hedging. Fair value hedged, where hedging item difference, hedging instrument difference, both will go to P&L accounts. Cash flow hedge means the objective is to not to protect the value of the asset. The objective is to protect the cash proceeds from that asset. That is, if you remember, maybe in SFM there is something called as hedging the portfolio using index futures. You are protecting the value of the portfolio. That is fair value hedge. You are protecting an asset. If you're worried about the foreign exchange conversion rate, that is, you don't know how much amount will come from the customer, you're worried about it, so you're focusing on the cash flow element, not the value of an asset. That is what is cash flow hedge. Hedging item, hedging item means whatever happens in the debtor account. Normally where do we transfer it? When exchange difference on debtor comes, we take it to P&L account, but here I'm going to transfer it to cash flow hedge reserve. Hedging instruments, effective portion, that you don't worry, it will be also be hedging instrument means the forward contract, again you would have taken to P&L. Now here I'll not take it to P&L accounts, I will take it to the OCI. And here is what even amortization comes. For example, spot rate was let's say 60 rupees and the forward rate is 62 rupees. The 2 rupees will be amortized from the cash flow hedge reserve to P&L account over a period of the contract of the loan. Amortization will take place in case of cash flow hedge reserve transferred to the P&L account in case of loss or profit. Hedges as net investment, that you don't worry, that is for investment in case of subsidiary, joint venture, associate. You're protecting the value of investments, the fair value of it. Same thing actually. Hedging item, you take it to OCI. Hedging instruments, you take it to the OCI as well. Anyway, hedging basically concept is matching thing. Wherever hedged item will go there, hedging instrument also should just follow that instrument. So beyond that hedging, you don't worry much. Okay, let's just take a quick example of an illustration. Don't write it, just try to understand the concept. Just read this illustration, not there in the books. Just read. On 1/1/2020, exported goods 1 lakh USD, credit period 6 months. To protect from exchange risk, X Limited enter into forward sale agreement with the bank at 62. Spot rate is 50 rupees. On 31st of March is spot rate 55, forward rate 57. On 30th of April, spot rate is 60. This is a cash flow hedge because you're protecting the cash proceeds from exports. On 1/1/2020, you will recognize the debtor account at 50 rupees, the spot rate, debtor account to sales account. Year end, 50 rupees became 55 rupees. The spot rate became 55, as per AS 11 Ind AS 21. The debtor value increased, 5 rupee gain. Where would have transferred to? Normally I would have transferred to P&L account, but here this 5 rupee gain I will transfer it to the OCI, cash flow hedge reserve. Then settlement, 55 became 60, again 5 rupee more gain, again I will transfer it to the cash flow hedge reserve. Now forward contracts on 1/1/2020 was the rate at 62, then on 31st of March rate it became 57. So here you have a gain. I'm not sure whether you understand this. Again, purely from SMM angle, I'll try to explain as much as possible. This is a forward sale contract. Forward sale contract, if you think independently, you are going to sell at the rate committed 62, but the spot rate happens to be 57. Means from some market you can buy at 57, you can sell it at 62, you can make a profit of 62 rupees. Or if you're comfortable with long short, this is even more faster. Forward sale contract means it's the short contract, and when you short, the price reduces, it's a gain for you. 62 became 57, you realized gain. This gain again will be transferred to cash flow hedge reserve. This next it became 60 rupees, 57 became 60. In the short position, the rate increased, that will be a loss for you. Effectively, if you take all of these things put together, 5553, net cost is 12 rupees, which is exactly the difference between the date spot rate was 50 and the forward rate was 62. This 12 is what is the total gain ultimately, and therefore that will be amortized over a period of 2 years, because not 2 years, over the period of 6 months, from 1st of Jan to 30th of June. 3 months comes in this year, 3 months comes in the next year. That's the accounting treatment of amortization, recognition in cash flow hedge reserve and forward contract and so on. Again, I really don't expect hedging from examination point of view. Maybe at worst case they can ask you a theory question, maybe very rare case. I don't expect problem on hedging because there's enough questions from other areas, and hedging is also optional if you want to apply in practical life, because you have to have proper documentation signifying the connection and all. So practically also it is not very common. So examination also I don't expect it, but anyway, just be aware of it, about these basics at least. Okay, any other doubts in the financial instruments? At least from exam point of view, I'm not going anything beyond that. Okay, so moving on, next standard, let's do a smaller one. Ind AS 20, government grants. Let's look at the summary part quickly. So government grants refers to the assistance provided by the government, maybe in the form of subsidy or in the form of cash support or in the form of asset given at concessional rate. You should recognize the grant when there is reasonable assurance that the conditions will be complied with. Measurement, we follow income approach, which means whatever the grant received should be taken to P&L on some reasonable grounds. Unlike, if you remember, AS 12, which said if it is in nature of promoter's contribution, we transfer it to capital reserve, those elements are not present. It has to be compulsorily be transferred to P&L on some systematic basis. If it is in connection with expense, then the grant is recognized in P&L. If it is in connection with assets, in the sense you might get machinery at a concessional price, or you might get a refund related to an asset, then you have two methods available. One, you subtract from the fixed assets and provide depreciation on the remaining value of the asset, or you don't subtract it, you credit it to a separate account called as deferred income account, and from the deferred income account transfer to P&L account in proportion of depreciation. If you get a loan at a concessional rate of interest from the government, you account as per Ind AS 109, which basically means whatever the repayments, cash repayments, that is whatever are loan principal plus interest repayments, that repayment you discount using market rate of interest. Just like the way we did convertible debenture, that method, the cash flow will be from the government loan, but the discounting rate will be from the market rate. Obviously, the present value, fair value will be less than the actual amount received. The difference to be treated as loan, treated as government grant in concessional loan. And of course, which should be taken to P&L on some reasonable basis. Non-monetary grant, such as receiving machinery without any cost. Earlier, we had to show machinery account debit to grant account. Machinery also recognized, grant also recognized. Now we have a choice. You can either recognize at fair value, which means asset account is recognized full and grant is recognized full, equivalent to fair value amount, or you can do at nominal value. Nominal value means you don't recognize the asset nor you don't recognize any liability. You simply reflect maybe in the disclosure or in the notes to accounts telling there is a asset received from the government and it is recorded at a nominal value of, let's say, rupee 1. That is when you receive the asset without any consideration, called as non-monetary grant. There might be situation of refund or called as repayment. You understand, right? Especially when you receive grant from government, you have to take care of many people from the lower level to the top level, and you don't take care of them, then they'll find some missing fault. This signature is not matching, this certificate is missing, and they say grant is now revoked. Whatever received also had to be refunded. And what do? Whatever we had done it earlier, that things will be reversed. Earlier we had taken to P&L accounts, now also take it to P&L. Earlier you subtracted from fixed assets, now you add to fixed assets. Earlier you transfer to deferred income account, now also you transfer to deferred income account as a debit item. But any excess deferred income is there, that you can transfer to P&L account, and that is all is Ind AS 20. Relevant problem they can ask in exam mainly are two kinds. One is related to the assets regarding connection with depreciation. You know, asset, you have two methods, deferred income or subtract. And the second variety of problem is regarding the loan received from government at a concessional rate. These are the two typical problem you can expect in examination. Yes, please. You can revalue the assets. No, grant is not connected. If you are following the deduction from fixed assets, if you do fair revaluation, you can do it. It's still a revaluation reserve. There is no specific adjustment with respect to government grant. So then you could have gone to deferred income method. I mean, logically, can you do it? You can do it. But it is, if you are thinking of doing revaluation, then we don't recommend you go for the second choice. Go for the first choice. Transfer the government grant to deferred income account. Keep the asset account as it is. Asset account you revalue and you create a revaluation reserve. So government grant is untouched. So that's what recommended. But yeah, technically, can we do it? Yes, we can do. We can do revaluation, not a problem. But we cannot accumulate it in any capital reserve. That thing is not allowed in Ind AS. That has to be transferred to P&L in some form or the another. Okay, let's go further. Small standard. This one chart is sufficient. Okay, let me read. Government of India provide loans to MSME at below market rate of interest to fund the setup of new manufacturing facility. Sukshma Limited. Sukshma Limited. I don't know. Date of transition of Ind AS is on 1st of April 2020. In the financial year 14-15, the company had received, so many years back, loan of 2 crore at below market of interest from government. Under Indian GAAP, the company had accounted for the loan as equity and the carrying amount was 2 crore on the date of transition. The amount repayable, the loan, how can they taken as equity? Anyway, they have done it, I don't know. The carrying amount of 2 crore at the date of transition, the amount repayable on 31st of March 2024 was 2.5 crores. The company had been advised to recognize the difference of 0.5 crores in the equity by corresponding increase in the value of various assets under the property, plant, equipment by an equivalent amount of proportionate basis. Its company has been advised 0.5 crores in the equity by corresponding increase in the value of property. So increase the asset, increase the equity, because repayable is 0.5 crores. Further, on 31st March 2024, when the loan has to be repaid, 2.5 crores should be presented as deduction from property. I don't know who advised, but that's the advice. Discuss the above treatment and share your views as per Ind AS. Of course, whether you, I mean, definitely the advice is not correct. 2 crore is a loan repayable, so you have to account it like a loan only. In the sense, you continue the 2 crore, but the repayable is 2.5 crores after how many more years? We are on 2020, repayable on 2024. Repayable after 4 years. So over a period of 4 years, we have to recognize interest expense prospectively. Historically, we don't touch it, but prospectively, we'll recognize the interest income on not interest expense on effective interest basis. That's what they say. First time adopter did not under previous GAAP recognize measure government loan, that is completely fine. On the date of transition, the carrying amount continues as it is. The loan amount meets the definition of financial liability, therefore reclassified from equity to liability. It also uses the previous GAAP carrying amount of loan as it is. So existing loan amount will be, I mean, existing equity amount will be taken to loan now. As on this date, it is a loan. It's a liability because obligation to pay cash. And it calculates the annual effective interest rates as under 2.5 divided by 2 to the power of 1 by 4. That is 5.74% approx. Did you get this calculation? Compound interest, it's purely financial management. They're asking so many SFM concept in FR. I just hope they don't ask FR concept in SF. Anyway, so this is the 2 crore loan today. And after 4 years, the loan repayable is 2.5 crores over a period of 4 years. So you take the 2 crore as present value, 2.5 crore as future value, and number of year as 4, and you compute the rate of interest. And the formula of compounding interest is F equals P into 1 plus I or R to the power of n. So 2.5 divided by 2 and to the power of 4, and to simplify means I should do 1/4 on both sides. So 2.5 by 2 to the power of 1 by 4. That's what they have done here. 2.5 by 2 to the power of 1 by 4. And they got 5.74 approximately. I don't know how they are calculating, but anyway, in calculator what you can do, 2.5 by 2 square root. 2 times when you press, you get the 1/4. If it is cube root, if it is fifth root, I hope they don't ask such things. You can do like square root many times, -1 + 1 into equal to many times, but I don't expect, I hope they don't go to that extreme level of torturing students to that extent. 1 by 4 at least is reasonable. Pressing square root 2 times, you get the answer. So next 4 years, the 2 crore you start, on that you recognize 5.74% implicit interest rate, effective interest rate, closing balance. On the closing balance you charge interest rate, the closing balance, and that is how you are going to recognize interest expense over a period of 4 years related to the government loan. Ind AS 101 read with Ind AS 20. So no retrospective effect, only prospective calculation. Standing on the date of transition, we recognize liability and we have to repay the amount. So we are going to calculate the interest expense for the remaining period. Of course, life would have been easy. 2 crore to 2.5 crore, the amount is 50 lakhs, divided by 4, every year recognize, simple. But of course, the Ind AS is not about simple, it's about what is proper, what is appropriate. So in life, which is more appropriate, simple interest or compound interest? Compound interest is more appropriate. Example, you have salary. You start salary with 1 lakh. Second year they tell 10% increment. So on 1 lakh you get 10% increment. So second year salary is 1,10,000. Third year again they tell you 10%. Which amount will you apply? You like, no, simple interest, sir. 1 lakh only you give me this, sir. Then there is no increment. 1 lakh 10%, you get 1,10,000 only. So it is compounding in nature. In fact, life is not simple interest, compound interest, it's continuously compounding. You see, interest amount will come to your bank account or interest you pay on a particular date. But the life growth will happen continuously. Is it like today is your birthday, you've grown by 2 inches? It's not. You grow every day and you degrow also every day. So continuous compounding is applicable in life as well. I hope they don't listen to me, because that's also they'll bring it into books of account and say that Ind AS from next year onwards should be effectively continuously compounding interest. I hope they don't do it. They're still at effective interest. Let's live with that. Okay, any doubts in this question? Okay, next one. A Limited is engaged in manufacturing of certain specialized chemicals. They started again the history. Maybe they tell the date of incorporation, who was the auditor, then what happened to the employees. During the manufacturing process, certain wastewater is produced which is released by A Limited in the nearby river. To reduce the pollution of the rivers, the state government has introduced a scheme with the following salient features. If a manufacturer installs certain pre-approved wastewater treatment, the government will provide interest-free loan equal to 50% of the cost of the plant. This is where the institute want to confuse you. They provide interest-free loan up to 50% of the cost of the plant. Now this is a government grant. We should take at a concessional rate or a government grant related to acquisition of fixed assets. Which type of grant it is? That's the problem with the institute. They tell apple is fruits, Red is color. What is orange? This is the type of question you'll expect. Let's read. Let's see if any other specific requirement is there. Such loan will be repayable to the government from 5 years of date of dispersal. The manufacturer availing the benefit of this scheme must treat the wastewater of its factory using a specified plant before releasing it to the river. If this condition is violated, the entire loan become immediately repayable to government along with a penalty of 10 lakhs. Cost of wastewater treatment plant to be installed to avail the benefit of the scheme is 50 lakhs. Cost is 50 lakhs. A Limited decide to utilize this scheme because if it were to obtain similar loan from bank, it would avail a market rate of 12% per annum. Accordingly, A Limited applied and obtained the government loan of 25 lakhs. 25 lakhs. How 25 lakh? Because they said 50% of 50 lakhs. So 25 lakhs they got the loan at a interest free loan. Had they gone for the market, they would have paid 12%. A Limited purchased and installed the plant such that it became ready for use on the same date. A Limited has accounting policy of recognizing the government grant in relation to depreciable asset in proportion of depreciation expense, meaning they are transferring it to deferred income, and from deferred income they are taking it to the P&L account. That's why the proportion of depreciation expense comes into picture. It has determined that the plant will be depreciated over a period of 5 years using straight line method. The one good thing they have done is straight line method. In the month of March, government officials conducted a surprise audit. Maybe they were short of some income, so they surprise audit, and it was found that A Limited was not using the wastewater treatment plant prescribed. Accordingly, 31st March 2003. 2003 means this is when? 1st April 2001. So after 2 years, at the end of second year. A Limited to repay the entire loan along with penalty. A Limited repaid the loan with interest and penalty as per the order on 31st March 2003. Measure the government grant on 1st of April, determine the nature of the government grant and its accounting treatment, principally for the year ended 2002. Also determine the impact of profit and loss, if any, on account of revocation of the grant on March 2003. So initially, hope you understand, we have to recognize the loan at a concessional rate, meaning free of interest means we should recognize the present value, fair value of the loan, compare with the actual loan, that becomes your government grant. Fair value of the loan 25 lakh. Have they given? Okay, present value is 12% for 5 years, therefore it comes to 14 lakh 17,500. From the 25 lakh minus 14 lakh 17,500, you are going to call it as government grant. And what is the purpose for which this government grant is received? It is to acquire, to purchase a plant, and therefore it is related to fixed asset. And when it is related to fixed asset, you have two choices. Either you can reduce from the cost of the plant, or you can adjust. I mean, you can take it to a separate account called deferred income. And because in the question they said it is in proportion of depreciation, so they have transferred it to deferred income account. And this deferred income account amount will be transferred to P&L account in proportion of depreciation. Because they said straight line method, I can simply divide it by 5. That's what they did, straight line method. If it was WDV method, go to next problem. We take the cost of the plant. Let's say this cost of the plant is 25 lakhs, or actually 25 lakhs, or no, 50 lakhs, no, 50 lakhs. Cost of the plant is 50 lakhs. And then what we are going to do is that 50 lakhs, we provide depreciation for year 1, year 2, year 3, year 4, year 5, applying the rate. That amount of depreciation, in that ratio, we divide this government grants. So I cannot apply a percentage just like that. So we should thank them at least for using straight line methods. That's helped us in some manner. So this 10 lakh 82,500 will be spread across 5 years. We simply divide by 5, means 10 lakh 82,500 divided by 5, we get 2 lakh 16,500. That's what it is. Deferred grant account debit to P&L account in the first year. This depreciation cost of the property 50 lakh, no residual value, 50 lakh divided by 5. Depreciation to plant property equipment 10 lakh is recognized in the P&L account as expense. Yes. Then what will happen in the impact of revocation? The revocation means it will be debited back to deferred income account. The amount of repayment is full refund. Full refund means 25 lakhs along with the penalty of 10 lakhs. So 25 lakh along with penalty of 10 lakhs. So total 35 lakhs you have to repay. So what and all is going to be the transactions on 31st of March? Deferred income account debit to P&L account, you still transfer the proportionate amount because it is taking place at the end of the year. What will be the loan amount at the end of second year? Second year is what you're repaying. Where is that loan amounts table? Not here. Okay, it will come working note here. Fine. So opening recognition at present value 14 lakh 10. First year interest become 15 lakh 87. That becomes opening for next year. Interest accrued because refund taking place on the last day. 17 lakh 78 112 is the loan amount in the books of accounts. Now this will be closed. So debit loan amounts, deferred grant income account, it is recognized initially 10 lakh 8200. First year you transfer, second year transfer. We are standing at the end of second year. So closing balance is 6 lakh 49 500. This also you debit it. And two payment 25 lakh entire refund given back. The debit transferred to P&L account balancing figure. And in excess the penalty payable, that is also, I think they have not given, it's paid, I don't know, but anyway, the P&L accounts debits to government grant payable 10 lakh is also transferred to P&L. I think it's paid also. Maybe you can also write to bank. That is also fine. So total impact on P&L account is 72,388 plus 10 lakhs. That's what is the expense impact on P&L because of revocation. Okay, so that's about this problem. Again, so many calculations are there, but you can actually do it in just one page. 4-5 calculations should be sufficient. Anyway, see if you have any doubts. Okay, anything else related to the government grants? Next standard, share based payments, Ind AS 102. Again, I'll discuss broadly what is required from exam point of view. We have to understand the concept of the terms. The date on which this announcement is made is called as the grant date. Then the employees will be eligible to subscribe only after fulfilling certain conditions. That condition is called as the vesting date. And once you satisfied the condition, you are eligible to subscribe. You have time to exercise. That is called as the exercise dates. From the grant dates to the vesting dates, the period within which the condition is fulfilled is called as the vesting period. And from the vesting date to the date on which actually exercise is called as the exercise periods. In the period of vesting only, the expense is recognized. And in the exercise period, whatever the outstanding amount, like ESOP outstanding, we say, that will be converted into share capital. And this may be in the nature of equity, means shares are subscribed, or maybe in the nature of debt, means entity will have an obligation to pay cash, or it may be having cash alternative where the employee can choose whether you want to settle in cash or by receiving shares. So all the three accounting treatment will differ slightly. For this purpose, I have designed one simple tabular format so that any kind of adjustment comes, it will be considered in this table itself. I'll cover it quickly. First thing is number of employees who are expected to satisfy the conditions. So it is not the number of employees as on this date. What management thinks, how many employees will be there at the end of the vesting period. Then how many options given per employee, the fair value of the option, you multiply all these things, that will give you total expense in the vesting period. Let's say vesting period is 5 years. That is what is the next line, expected vesting period. Then we calculate the closing balance. We follow cumulative catch-up basis approach, meaning I don't calculate expense for the year because there are a lot of changes. Calculating for a particular year becomes complex. So we calculate the closing balance and we calculate the compare with the opening balance, and difference balancing figure we transfer it to the P&L account. And how do we calculate the closing balance is how many years completed, that is whatever the expense we calculated in the whole vesting period, that we multiplied by number of years completed divided by the vesting periods. So this will basically tell you how many or how much expenses should be completed, should be recognized as on this date. For example, 3 years are over out of 5 years. So whatever the expense into 3 by 5 must be my closing balance. What happened in the previous year does not matter. Number of employees can change, fair value can change, that's a different matter. But what is supposed to be my closing balance, expense in the vesting period multiplied by 3 by 5 is the closing balance. Then subtract opening balance, which is previous year closing, I get the current year expense. Have you seen this calculation somewhere in life? Not in this standard, I'm asking in another standard. In Ind AS 103 business combination, where share based payments either replaced or not replaced. If it is replaced, we take the whatever the expense multiply the fair value of the existing grant, we multiply it by the number of years completed divided by higher of the two, actual vesting period as per the old grant or the new whatever replaced grant, whichever is higher. Basically cumulative expense. This is the logic behind the calculation in business combination Ind AS 103. It's close only, we are doing it late. This is 102, that is 103. It comes close one after the another. Anyway, now these things may undergo changes depending on whether it is in the nature of equity or in the nature of debts. When it is in the nature of equity, this fair value we will not change it. Fair value on the grant date, the concession. What is this fair value is all about? If let's say market value is 80 rupees, but you give them only at 67 rupees, 13 rupees is a concession given. That concession is called as the fair value. Actually, it is called as intrinsic value. The present value of intrinsic value is called as the fair value, subject to probability and volatility. Have I spoken English? Again, this is connected with your SFM. The date on which you are going to exercise, that market price and the exercise price difference is the intrinsic value. But that we will know only on the date of exercise. Standing today, we can do only present value basis. But value will be fluctuating. So we have to take care of volatility, we have to take care of probability. And we had models like binomial model, risk neutrality model, Black-Scholes model, applying whatever model you apply. Of course, I hope they don't ask those things in exam. I sincerely hope they'll give you fair value of the option in the exam directly, but it represents ultimately difference between the market price and strike price. It's a concession, it's a benefit for the employees. If employees are also given fair value, then why will employee come here? He'll go to market and buy it. The fact that employees are given benefit is for this difference, and this difference is the fair value standing on the date of grant, and subsequently that grant is not revised. The fair value is not revised when this is in the nature of equity. Then what can change? Number of employees can change, options per employees can change, depends on their agreement, but fair value is not subject to change. It can change in the case of debt, or this is treated as liability, which we call it as SAR, stock appreciation rights. The entity will have the obligation to pay cash equivalent to the value of the ESOP outstanding. Shares are not issued. So when it is the obligation to pay cash, it is in the nature of debt, and therefore the fair value of the option also is revised every year, not only until the vesting period, until the date of actual exercise. And that period, whatever the difference, we keep accumulating, or we call it as changes in accounting estimates. For example, if the fair value of the option is 18 rupees, then became 19 rupees, then became 20 rupees, we keep providing it. But subsequently it becomes 21 rupees. In the nature of equity, we are not bothered because we don't account for any changes. But in nature of debt, we are actually going to make a payment of 21 rupees on the date of exercise. So this 20 to 21, 1 rupee difference, we should recognize it as changes in estimates. And the journal entry for recognizing this expense will be ESOP, employee benefit expense to ESOP outstanding. Of course, employee benefit expense will be transferred to P&L, the concession given. ESOP outstanding, if it is in the nature of equity, it will go to reserves and surplus, meaning other equity. If it is in nature of debt, it will go to long-term provisions because it is in nature of liability. On the date of exercise, if the employee said we don't want, the option lapses, then ESOP outstanding will go back to general reserve to the extent option is not exercised. But in case of liability, it will not go to general reserve, it will go back to P&L account, because liability changes assessments should be taken in P&L accounts. Okay, there is one more thing, which is cash alternative. During the period beginning, cash alternative, initially we should divide this into debt component and equity component. Now debt component also to be recognized by preparing this table only. Equity component also should be recognized by preparing this table. So how do we calculate this debt component, equity component? If the employees wants to go for equity, then the number of shares will be more. If the employees want to go for cash settlement, number of shares will be less. So multiplied by the respective fair value, the differential amount is called as the equity element. Obligation to pay cash, the obligation to settle in cash, that is debt component. The total fair value difference becomes equity component. Debt component also recognized over vesting period. Equity component also recognized over vesting period. Initially nothing is recognized, but the difference is equity component we don't reassess every year, but debt component the fair value will change, so we need to reassess every year. And yes, debt component you recognize, equity component you recognize. Now on exercise at the end, if settled in equity, then both the debt component as well as equity component will be transferred to equity. Debt component as well as equity component will be transferred to equity only. But if it is settled in cash basis, then the debt component will be paid in cash. But what will happen to this equity components? It will be transferred to general reserve. Fortunately, unfortunately, the institute solutions is not showing this, but this is the logic we have been maintaining even in financial instruments, that we classify into debt and equity in case of convertible debenture, compound financial instruments. When settled in cash basis, the liability is settled, but equity component, residual, that is whatever amount accumulated at the beginning, equity component will be transferred to general reserve. Same thing we apply here also. Settlement in cash, debt component to cash, equity component whatever was there accumulated will become free reserves, will be transferred to general reserve. Okay, then modification and settlement can happen in the sense there could be some changes in the terms of the contract, due to which the fair value might increase. Even in case of equity option, I'm telling, that is because of changes in terms. Maybe option exercise price is changed, for which fair value is changed. That will take into consideration. So if there is a decrease in fair value, we are not going to account for it. If there is a increase in fair value, the incremental amount will be apportioned among remaining useful life, remaining unvested period. That is, for example, if the vesting period was, the fair value was, let's say, 80 rupees. Next, and 80 rupees, you made one third, let's say one third. I'm just taking one share for example purpose. Next year, the fair value became 90 rupees due to change in the excise price, change in the terms. Then what you're going to do, the incremental is 10 rupees. And remaining life is 2 years. So 1 by 2 of 10 and 1 by 2 of 10, that is increase in the fair value, is only accounted as modification and is amortized over remaining vesting periods. We don't change anything of the past. Existing fair value is untouched in case of equity. In case of debt, we don't worry about like this, because anyway fair value change, the table itself will take care of all the adjustments to be made. And one more thing will happen in case of settlements. In case of cancellation, whatever happened, we transfer back to P&L account if unsettled, or if it is accumulated in ESOP, we will transfer it to general reserve. But problem is regarding settlements. Like one of the problem is also there in the study material, like employees or directors are given some kind of shares, and later it was in the nature of equity initially, and next year it was decided to settle earlier. It was supposed to be 3 years, but they settled in the second year itself, and they closed the amount payable to directors. So in that case, what you should do is, we should do actually in 3-step process. Whatever the equity amount you have, you should compare it with the liability amount, because previously it was equity, now it is going to be settled at liability. So you should take the fair value of liability components, and equity is the carrying amount. This difference is the revaluation amount you need to consider. And from liability to actual payments, this difference you are going to take it in the P&L account. So this difference from carrying amount to fair value, I'm going to adjust it in ESOP outstanding, because equity elements, and from this fair value to whatever actual payments, that will be transferred to P&L account. So you should do it in 2-step approach in case of settlement, or early settlement, or premature settlement. One more thing is there, that is a share given to the employees of subsidiary company. I will discuss that, but any questions conceptually up to this point? The last one. Okay, I don't have question in the material, but I'll just use the numbers directly, so that it'll be easy for you to connect it. Just read this question. Again, it's not there in the material. It is just to give an example to understand that cancellation. Bima Industries issued a 4,000 share option to its employees, 20 directors, for exercise price of 200. Directors are required to stay with the company for 3 years. Fair value of the option estimated 260. Expected number of directors to vest the option 16. During the second year, there was a crisis. Management decided to cancel the scheme immediately. Fair value of the option at the time of cancellation is 180. Market price of the cancellation is 198. There was a compensation which was paid to directors, and only 18 directors were currently in the employment at the time of cancellation. It is agreed to pay an amount of 190 to each of 18 directors. Let's not worry about number of directors. Let's worry about on the per share basis. Okay, what is the fair value of the option initially recognized at the beginning in this problem? What would be the number? It would be 260. This is the fair value on grant date. And what is the vesting period? The director should stay with the company for a period of 3 years. So how much of the expense you will recognize in the first year? Can I say it is 260 into 1 by 3? Per share I'm asking about, per employee or per share base, per option basis. Whatever number, how much you get? 87. Okay, 86.66. Okay, 87. This is the amount of recognition in the year 1. Now second year, what they have decided, they decided to close it immediately, which means this closing balance, if I discuss next year, what was supposed to happen if everything happened according to our expectation, the closing balance was supposed to be 260 into 2 by 3 was supposed to happen, closing cumulative expense. But here, because of accelerated vesting period, I'm going to take it as 260 into 2 by 2, because entire expense has to be recognized by the end of second year. So 260 is the closing balance, but 87 already recognized. Difference will be 173 is the expense in the second year to be taken to P&L account. This is the value of equity, ESOP outstanding, standing at the second year end. Now what is cash alternative now as on this date? Fair value of the option on this type second year end is 180 rupees. So we are showing in our books of account as 260 rupees, but the amount what we are having is 180. So difference is 80 rupees is what I have to take out from my ESOP outstanding. And where will I take it to? That 80 rupees, the difference amount, I will be transferring it to general reserve, retained earnings, because that now is free reserves. So once I transfer that ESOP outstanding to free reserve to the extent of 80 rupees, my ESOP outstanding liability component is 180 rupees. Now 180 rupees, but what is the market price of this share on the cancellation dates? 198. Therefore, you are going to recognize as, I mean, you can take it as 198. Actually, you are not paying 198. What you are actually paying is 190. So from 180 rupees to 190 rupees, the 10 rupee extra you are paying, that will go to P&L account. So from 260 to 180, 80 rupees will be transferred from ESOP outstanding to general reserve, and from that ESOP outstanding remaining 180, but you made a payment of 190, the extra 10 rupees will be transferred to P&L account. So 3 steps will happen. First step, accelerated vesting period. This expense recognized in P&L account. Second step, revaluation from equity to debt. 260 to 180 revaluation, that will be taken adjustment in the general reserve. And third, whatever actual payment versus liability outstanding, that difference taken in P&L account. So 3-step approach. This is what I was wanting to tell. Accelerated vesting in the P&L account, revaluation from equity to cash settlement, and actual cash settlement and revalued amount difference taken to P&L account. Okay, so this is the summary of Ind AS 102. Any doubts in this context? Journal entry for the first one. I mean, in this case, what was the amount we calculated? No, first year. Okay, first year 87 is ESOP, I mean, employee benefit expense to ESOP outstanding 87 rupees. Second year employee benefit expense to ESOP outstanding 173 rupees. So ESOP outstanding we have 260 rupees. And that I am going to transfer 80 rupees to general reserve. So ESOP outstanding account debit 80 to general reserve 80 rupees. As of now, ESOP outstanding balance contains 180, but actual payment 190. So ESOP outstanding account debit 180, P&L expense 10 to bank 190. Okay, last one I should discuss before I go to problems. That is on the holding company giving the shares to employees of subsidiary company. Very common, especially in the practical context. You are an employee of Microsoft. There is no point in getting shares of local Indian company because it's unlisted. You get RSU kind of things from the holding ultimate parent company. Very straightforward thing. In fact, holding company gives the shares to subsidiary and subsidiary gives the shares to employees. We have to treat according to this. So it will be like this. Holding company giving the shares to the employees of subsidiary company. But we don't account it directly. We show as if holding company has given the shares to subsidiary and subsidiary company has given the shares to employees. So what entry would holding company would pass? What entry would employees? Okay, let's first do subsidiary company. What they would pass? Normally, what entry will you pass? In the case of share-based payments, ESOP employee benefit expense to ESOP outstanding. Expense account I'll debit because it's subsidiary company's expense. It will be employee benefit expense to, if I pay in cash, I'll say to cash. If it is the shares payable, to ESOP outstanding. Or if it is amount yet to be paid, I will say SAR, stock appreciation rights. But here I am not paying, holding company is paying. So ideally I should write to holding company, because now the amount is paid actually by them, holding company. But we are not giving anything back to the holding company. So we treat it like contribution receipts towards equity. It's like share capital, shares issued, money received, the contribution received. Of course, it will be taken to the equities only. It will be shown under reserves and surplus, equity received. Think from holding company point of view, you definitely write two ESOP outstanding because you are going to issue your shares, and two ESOP outstanding will become share capital, reserve surplus later. But you don't debit employee benefit expense, instead you debit the subsidiary company. But subsidiary company, you don't receive the money as it is. Instead, what you do, you are going to write it as investment in subsidiary company. So holding company will treat like an investment in subsidiary. Subsidiary will treat like a money receipts, though it is not direct on a notional basis. The two separate entries are passed. Holding company will show investment to the extent of fair value of shares issued. Subsidiary company will account as contribution receipts towards equity, will be taken to the equity side. In the reserves and surplus, we'll show it as contribution receipt. Okay, so this is regarding Ind AS 102. Okay, any other doubts in Ind AS 102? Then we can take a look at some problems. The stable format, it will be more convenient if you can learn it, if you are not learn it, because sometimes vesting period can be fluctuating also. They will be like based on average profits. It will be 1 year, 2 year, 3 years. So those kind of things. The table, if you follow, you can fit into any format of questions. You don't have to worry about it. If just have to quickly cover those points. Vesting conditions can be service oriented condition like employment period 3 years kind of thing. We apply the judgment how many employees are expected to fulfill. Performance condition market related. Market related means outside the parameter of the entity, like market price or market share kind of thing, where entity don't have the control, then you can consider the impact on the fair value of the option. When you consider the fair value, basically when you apply the models, there you consider it, and then you don't change it. If it is performance related to non-market conditions, for example, profitability achievement and all, which is inside the control of the company's operations, then you don't consider the impact on fair value of the option. Instead, you modify the vesting period on every year. That is what I was telling, just like that. Initially, like if you have to achieve the vesting period of 1 year, if your average profit is 10%, first year not achieved, then what do? Second year you postpone it. Average has to be 9%. Second year also not happened, we postpone it to third year. Let's say that target is 7%. Third year fulfilled, yes, we got the answer. If third year also not fulfilled, we don't postpone to fourth year. Maybe that problem will stop at that point. It's not your CA exam, no? Keep on postponing to next attempt. We'll have to stop at that one point in time. So if it is like this, first year completed, we'll say 1 by 1. But if first year not completed, I'll make it as 1 by 2. 1 out of 2 years completed. I come to second year, if fulfilled, I'll just make it as 2 by 2 and I'll close it. But if not fulfilled, I'm postponing to second, third year, means I'll make it as 2 by 3. And last year, let's say the condition is fulfilled, then I'll make it as 3 by 3 and I'll close it. And if last year also not fulfilled and the terms don't allow me to go further, then I'll make it as 0 by 3 and I will close everything back to P&L account. That is basically non-market related conditions not fulfilled, we'll take back to P&L. But market related condition not fulfilled, I don't take back to P&L, I'll take back to general reserve because it is not within the control of the entity. Anyway, that point you don't worry much. Again, it's more of theory. For problems impact, this will not have much. In practical life, while determining the fair value, what factors to be considered, there this will have more impact. As far as examination question is concerned, just follow the table. You just know number of years completed divided by total vesting periods. You will get to know the expenses. Okay, let's take up some problems. Rider, a public limited company, is reviewing certain events which have occurred since its year end 31st March 2004. The financial statements were authorized for issue on 12th May. The following events relevant to the financial statements for the year ended March 2004. The company granted SAR to employees on 1st April 2002, 2 years back, based on 10 million shares. At the date rights are exercised, the SARs provides employees with the right to receive cash equivalent to appreciation in the company share price since the grant date. Rights vested on 31st March 2004. So you have issued on 1st of April 2002 and vested on 31st March 2004. That means over a period of 2 years. And the payment was made for schedule on 1st May 2004. The payment of cash to be made. The fair value of SAR per share on 31st March was 6 rupees, on 31st March 2004 was 8 rupees, and 1st of March is 9 rupees. So it became 6 rupees, and then 8 rupees, and then 9 rupees. The company has recognized the liability for SAR on 31st March 2002 based upon Ind AS 102, but the liability was stated at the same amount on 31st March 2004. So second year they have not changed it. Discuss the accounting treatment on the above events in the financial statements of rider, taking into account the implications of events occurring after the reporting period. Okay, this is 31st of March 2003. This is 31st of March 2004 and the payment is due on 1st of May 2004 and settlement, I mean the accounts were finalized on 12th May. Okay, so on 31st of March first year, how much expense should be recognized? 6 rupees the fair value. But we should recognize, I mean, of course, 10 million is there. I'll just discuss on per share basis. 6 by 2 because vesting period is 2 years. So I should take half of 6, 3 rupees in the first year. It became 8. So 8 rupees multiplied by 2 by 2. The closing balance at the end of second year, that is 8 rupees and 3 rupees already recognized. So incremental amount is 5 rupees. What about this 8 rupees to 9 rupees, 1 rupee? It is before finalizing the account. So should I take it as adjusting events? Standing on 31st of March, liability is 8 rupees. On 1st of May, it is 9 rupees before approval of the account. So should I take this change as a adjusting event? Because on 31st of March, liability pending is there. As on 31st of March, the value is 8 rupees. So as on that, you have to account for that. Actual payment happened to be different, that you can account as changes in accounting estimate. It's my opinion. Let's see what institute has told. SAR would be 9 rupees settled. It is non-adjusting event. Okay, they also told the same thing. Hence, change in fair value is accounted in the year next year 4-5, not in the year 3-4. So first year you recognize 3 rupees. Second year you recognize 3 to 8, 5 rupees. And third year you account as a change in estimate, 8 becoming 9, 1 rupee, because that estimate is taking place in the next year, not in the current year. In other words, you use the word non-adjusting event. Okay, so that is this problem. So much solution is there, but ultimately summary is that. Next. Voya Limited issued 1000 share option to each of its 200 employees. An exercise price of 10. Employees are required to stay in the employment for next 3 years. Nice people. Just stay in the employment for 3 years. They'll get share options. You also stay in a place for 3 years. What you get is next exam. The fair value of the option is estimated at rupees 18. 90% of the employees are expected to vest the option. The company faced a severe crisis during second year. It was decided to cancel the scheme with immediate effect. Market price is 15. The following information is available. Fair value of the option on the date of cancellation 12 rupees. The company paid a compensation to employee at the rate of 13.5. There were only 190 employees in the employment at that point in time. You are required to show the cancellation will be recorded in the books of company as per the relevant in the years. Okay, so first year, how much expense you are going to recognize? Again, I'll do a quick calculation. Number of employees expected to fulfill the condition is 90% of 200 employees. That is 180 multiplied by the fair value, 18 rupees, and number of options per employee, 1000, and how many years? 3 years. So into 1 by 3. This is supposed to be the expense in the first year. How much you get? 10,80,000. 10,80,000. Second year, first for what you should do is full amount should be recognized in the second year itself. So it is going to be how many employees were actually there? 190 employees. Fair value will be first 18 only you do it. First you close this existing into thousands into 2 by 2. Then that is coming to how much? 34 lakh 20,000. 34 lakh 20,000 is the closing balance. So differential amount go to P&L accounts. 23 lakh 40,000. Okay, so this will be transferred to P&L account as a first step. Then two more steps are there, that is reevaluation from this equity to liability, then actual payment, the change in estimate. Okay, so what will happen to that? Let me just show it at the top. From this, at present we are valuing at 18 rupees, and the fair value of the option on the date of cancellation is 12 rupees. So from 18 rupees, 12 rupees you should transfer to general reserve. So 6 rupees multiplied by whatever it is, 6 rupees multiplied by 190 employees multiplied by 1000 options. 11,40,000, that is transferred to general reserve. Okay, now what will be the balance? What you will have in the ESOP outstanding is 23,40,000 minus 34,20,000 minus 11,40,000. This will be the balance, which is 22,80,000. That is the existing amount, but actual payment is 13.5, so 1.5 extra. That is what you are going to transfer it to P&L account. So 1.5 into 190 into 1000, that is 2,85,000. That will be transferred to P&L account. Anyway, so that is what is this problem. They also show the calculation differently, but ultimately this is the 3-step process that you have to follow in case of cancellation. You can switch off at first. You can just go to that other side, no, background. It's off. Or you have a AC switch in the next room. You can just switch off in the. It's off. It's fine now. Okay, so this is regarding the cancellation. Okay, let's go further. Ind AS 2, valuation of inventories, again from your previous life. Hope you remember it. Nevertheless, we'll just quickly glance through the valuation of inventories. It is for the stock in the normal course of business, either held for sale, means finished goods, or in the process of production, WIP, or in the form of raw material or consumables to be used is raw materials. This is like your foundation, intermediate, and final. Foundation in the form of raw materials, intermediate in the form of work in progress, your final is your finished goods, and after that you are available for sale. Not applicable in certain situations: construction, financial instrument, livestock. Valuation cost or NRV, whichever is less. Cost includes the cost of purchase, non-recoverable duties and taxes, which means where the refund or input credit is not available. Cost of conversion means any labor expenses, overhead expenses, any other cost to bring the asset into present location and conditions such as freight, insurance is also part of the cost. Net realizable value means estimate selling price, estimate because you don't know the actual selling price, then minus further cost of completion minus any selling expenses like sales commission. Regarding this other cost, especially you should remember how to calculate this overhead cost. It will be, first you calculate the recovery rate. Recovery rate is fixed overhead cost divided by actual production or normal production, whichever is higher, so that when you multiply it by the actual production but actual cost may be high, there will be a situation of under absorption, but the situation of over absorption do not arise because we divide by the higher rate. And we also have certain elements such as joint product, byproduct, which means in joint product we will have one joint operation but there will be multiple main products emerging. Byproduct means one joint operation but only small items emerging, we don't treat them as main product. Joint cost, joint product means the joint cost will be allocated in some reasonable basis like number of units or sale value. But if it's byproduct, then we don't recognize the byproduct value separately. The realizable value of byproduct is subtracted from cost of the main product. That's what is joint product, main product. And sometimes we'll use a replacement cost also. When the finished goods is valued on cost basis, raw material also valued on cost basis. But when the finished goods is valued on NRV basis, in that case, the raw material will be valued on replacement cost basis, because for raw material we cannot have NRV. Raw materials are not sold, so raw material will not have NRV. Raw material will have to be having replacement cost only when finished goods are valued at NRV. Cost formula: if it is ordinarily interchangeable, we go with either non-historical cost or historical cost. Historical cost means, you know, our favorite methods, FIFO and weighted average. First in, first out. We believe in strong everywhere. We are so strong in FIFO is even if you go to restaurant or hotel, we ask them what is available. He will tell something is fresh. We tell no, bring what is first made, because we believe in first in, first out. Anyway, in all cases, FIFO is not appropriate, but for examination point of view, for academic, we say FIFO or weighted average. Historical cost. Non-historical cost means based on experience, based on data, based on statistics. Standard cost, we know from the experience this material will have only this much of units. So on experience, on data, cost of unit is so much. Standard cost. Retail method applicable for retail stores such as Big Bazaar, where it's very difficult for you to keep track of cost of individual items, but definitely they know the sales margin they keep, because without profit they don't sell it. So from the selling price, subtract the margin, approximately you get the value of the stock. That is called as retail method. That's completely fine. No, it's not accurate, but accounting is not about accurate. Accounting is all about fair presentation. So it's okay even if it is approximate method. If it is not ordinarily interchangeable, for example, painting, art, jewelries, we apply specific identification method. That is, we don't apply any first in, first out. We have to say this is our particular item and the cost of producing those items is so much. Applicable for software companies, cost of developing a software, maybe for construction companies where we have work in progress. This is the overall thing of Ind AS 2. And sometimes you can also, one more special point is there, they are common but still, if you write down as NRV being less, we can reverse in subsequent years if there is clear evidence that the whatever reversal have been reversed. I mean, down have been reversed in that year. Expense also, the write-off also can be reversed. These are all just the points, brief summary of Ind AS 2. Nothing major, but if you have any doubts, please ask. Hope you are comfortable with the standard. I know it is still intermediate level, but they do ask in exam as well. Final also they ask, because they know first in, first out. No, you learn first, you forget first. So they will ask. They keep asking these some intermediate level questions in final as well. I've seen in so many places they keep asking. It would be very basic, but they still do ask, because in the process of getting the advanced thing, some basics you might have forgotten. Okay, next, just to recollect our memory. ABC Limited buys goods from overseas supplier. It recently taken delivery of 1000 units of component X. The product price of the component X was 1200 per unit. ABC Limited has negotiated a discount of 5% due to size of the order. The supplier offers an early settlement discount of 2% on the payment within 30 days of the ABC Limited intends to achieve. Import duties, basic custom duties. Oh, I hope they don't ask GST and all to calculate countervailing duty or some custom duty. 60 per unit must be paid before the goods are released through custom. Once the goods are released through customs, ABC Limited must pay delivery cost of 5,000 to have the component taken to the warehouse. Calculate the cost of inventory. 1200 per unit multiplied by 1000 units. 5% discount, trade discount, we will subtract. 2% discount, cash discount, we will not subtract. Import duties, I don't know whether it's recoverable or not. Let's assume it is not recoverable and it will be part of cost of the inventory. Delivery cost, yes, any expenses incurred to bring the asset into present location condition will be part of the cost. Therefore, cost of the inventory is 11,40,000. Subtract 5% discount, import duties, delivery cost, that is your cost of inventory. Intention to take settlement discount is irrelevant, because whether you take it or not, the cash discount is not considered as cost of inventory. It is recorded separately later. Basic problem, but still quick coverage. A business plans for production overheads of 10 lakh per annum. Normal level production is 1 lakh. Due to supply difficulties, the business was only made to 75,000 units. Other cost per unit 126. Calculate the per unit cost and amount of overhead expense to be charged during the year. Other cost is 126. This will be 10 lakh divided by either 1 lakh or 75,000, whichever is higher. So it is 75,000. So not 70, 1 lakh. So 10 lakh by 1 lakh means 10 rupees, 10 rupee plus 126. So cost per product becomes 136. But actual cost incurred is 10 lakh, recovered is 10 rupee into 75 means 7 lakh 50,000. So there is under absorbed overheads of 2 lakh 50,000, which will be transferred to the P&L account directly. That is mainly in the nature of abnormal loss. That's why it is transferred to P&L and not part of cost of production, not part of cost of inventory. ABC Limited manufactures control unit for air conditioning systems. Each unit requires the following: component X cost of 1205 at a cost of 800, raw materials at cost of 150. Company faces the following monthly expenses: factory rent, energy cost, selling and distribution expenses. Each unit take 2 hours to assemble. Oh, they are asking cost sheet here. Production workers are paid 300 per hour. Okay, at least this one will do it. We started it. Production overheads are absorbed into units of production using an hourly rate. Normal level of production per month is 1000 hours. Determine the cost of inventory. Okay, material X. The cost is 1205 because you use one components. Material Y 800. You use one component. Sundry raw materials is 150. What about labor? You use 2 hours and 300 per hour. So 300 into 2, that will be 600. Production overheads. What is production overheads cost? We don't take selling and distribution overheads. We can take factory rent. We can take energy cost. 16,500 plus 7,500 divided by how many hours? Production per month is 1000 hours and multiplied by the unit will take 2 hours to assemble. So it will be 7,500 plus 16,500 divided by 1000 hours multiplied by 2 hours. Okay, so that's what we get. Material X, Y, raw material 600, 1650 by 16,500 plus 1,500 by 1000 into 2 hours, we get 48. Labor are 2 hours into 300, total 2803. Selling and distribution are not part of the cost. Anyway, straightforward. Will quickly, we have read it. Ind AS 16, plant, property and equipment. Again, this is part of your previous life, I hope so. Okay. Okay, in this property, plant, equipment, one basic question is that plant refers to actual physical plants or plant and machinery plant? It refers to physical plant only. Bearer plants. The plant actually they mean the physical plant, but in the nature of fixed asset, that's what they use the word bearer plant, which bears the fruits like mango tree. But when the plant itself is the product like sugarcane, that is not part of the standards. So PP held for use, not for sale, or for rental to others, or for administrative purpose. Recognition, two basic recognition: when there is reliable measurement of cost and when there is future economic benefits. The rules are same as with respect to inventory. The cost of purchase will include purchase price, non-refundable tax, meaning recoverable taxes are not part of the cost, and any expense incurred up to the point of present location and condition and up to the point asset is ready for intended use and purpose is capitalized. Not put to use, up to the point asset is ready for use. All transport, traveling, installation, carriage, inverts, insurance, everything is capitalized. And more importantly, cost of dismantling is capitalized. The specialty about cost of dismantling is it is not expense incurred. It is the expense that is going to be incurred when you take out the asset. That is to say, you are taking an asset on lease basis, let's say property. In the property, you're constructing like artificial cubes or some network equipments. But the condition is when you leave the organization, you have to give it in its original condition. So you have a responsibility to clean things up. So the expenses incurred will be capitalized, but expense that is going to be incurred when you leave the premise, that also should be capitalized and depreciated. Amazing, isn't it? You have not even spent the money. You are going to spend the money, let's say, after 25 years, but that expense should be depreciated over a period of 25 years. Nice concept anyway. And this cost of dismantling, in a way, journal entry will be machinery account debits to provision for dismantling, and that provision for dismantling will also be part of Ind AS 37 liabilities, because it is an expense yet to be incurred, and this will be at present value basis, and every year on this we will charge interest because we recognized on present value basis, and that is called as unwinding of discount. We keep accumulating interest, and at the end, when last year comes, the amount will be paid and liability is closed. What expense will not be incurred is general cost, general admin overhead cost, opening ceremony cost, relocation cost. Relocation cost is not capitalized in the sense you are working in a factory, you want to construct a new building over there, so you temporarily shift the employees machinery into somewhere else, and the shifting cost, installation cost there, those expenses are not capitalized. Relocation cost. One more thing, I think I forgot to write it here, or does it come later? Oh, it will come later, fine. Regarding the subsequent recognition, we have two models, either cost model or evaluation model. We'll discuss as we go further. Capitalization ceases when the asset is ready for use. Self-constructed or bearer plans, opportunity cost, internal profit cannot be recognized, meaning only cost can be recognized. You can't put the argument that if I worked for somebody else, I would have made that profit. I cannot add to the value of the asset. That is not allowed. Land and building, separate the assets. I mean, don't think literally, separate land and building. The value of land and building should be, to the extent possible, should be separated, for the reason land is not subject to depreciation, building only subject to depreciation. So to the extent possible, separate it. Day-to-day servicing, repairs and maintenance, charge to P&L, replacement or inspection cost when they are significant in nature. The new cost what you're adding is capitalized. Existing component which is being replaced, which is taken out, that will be transferred to P&L account, derecognized. Deferred beyond normal credit terms. So if you are purchasing an asset and you want extra time, and for the extra time the supplier charges the money extra, that is towards interest element, time value of money, not to the part of the asset, not to be recognized. Incidental operations are interesting. They are connected in the course of construction, but not necessary. They are transferred to P&L. Basically, they are not directly attributable expense. Not necessary in the sense, a common example we give, you are constructing a building, you have vacant land, you give it for parking, you earn income. That income is arising in the course of construction of the building, but it is not necessary. It's not that without giving it on parking, we can't construct the building. Nothing of that sort. They are incurred in connection, but not necessary. So those expenses are also not capitalized. That is incidental operations. Exchange of the assets, meaning you should recognize the asset whether it has commercial substance or not. If there is commercial substance, then you should measure the asset at fair value of the asset acquired or given up, whichever is available. If a commercial substance is not available or fair value could not be ascertained, then you will recognize at carrying value, book value basis. Commercial substance means the cash flow of the organization should change. Common example that I give, if you are giving a car to managing director and now you replace with the new car, the sales of the company will not increase. But if it is a cab service company, you replace the old car with the new car, the cab service company give better service, you can do more trips, the sales can be increased, better customer satisfaction, the cash flow of the organization will increase. There is a commercial substance. So in those cases, you should recognize the asset acquired at fair value basis. This is exchange of asset. A company have a choice either to choose cost model or evaluation model, and that is the accounting policy that they have to choose, and it is depending on the class of assets. For example, they might feel that factory building is on the outskirts of the city, the value will not change, I'll use cost model. Whereas the head office building is inside the city, at the heart of the city, the value will keep fluctuating. It is important the users must understand the fluctuations. So for office building, I'll follow revaluation model. For factory building, I follow cost model. Completely allowed as long as they belong to different class as defined by the company. If it is cost model, it is cost less accumulated depreciation, less impairment. If it is revaluation model, it will be revalued amounts, less accumulated depreciation. In revalued method also there will be depreciation. Revaluation will always takes place at the end of the year, not at the beginning. So many people have the opinion, suppose at the beginning of the year the cost of the asset is 10,000, at the end of the year cost of the asset is 9,000, and therefore 1,000 is depreciation, is not right. So what you should do, what is the useful life? Suppose useful life is let's say 5 years or let's say 4 years. So 10,000 divided by 4, depreciation is 2,500. 10,000 minus 2,500, year end 7,500 is the cost of the asset, revalued at 9,000, and therefore 1,500 will be transferred to revaluation reserve. Revaluation should happen at the end of the year after providing depreciation for that relevant year. So the revaluation also, depreciation will come up to the point of next revaluation. Again, the value of the asset will change and you keep providing depreciation for the subsequent period. And revaluation profit, you should made for the entire class. You can't say that only one furniture I'll do or one asset I'll do. For furniture I'll do or building I don't do it. For class of assets, you can follow different revaluation models. Initial upwards you transfer to revaluation reserve, but initial downwards, prudence principle loss, we take it to P&L account. And subsequently, if it happens, we reverse it. And once you dispose the asset, the revaluation reserve will be transferred to, first you adjust the loss with the revaluation reserve, excess amount of revaluation reserve will not come to P&L, it is without recycling, directly it is transferred to general reserve, it becomes retained earnings, free reserves. Depreciation means systematic allocation of depreciable amount is cost of the asset minus scrap value. Systematically allocate means when you use the asset, you are getting a benefit. And when using the asset, the value of asset is getting reduced, that is depreciation. So depreciation should reflect the benefit in which you are receiving the asset. It may be in the form of straight line method, I'm getting the benefit every year same, or WDV method, my benefit is getting reduced every year, or you can say that it will be based on the extraction method. Whichever year I use more manufacturing units, and that year I provide more depreciation. That based on the number of units produced, that is also fine, but it should reflect the benefit in which asset is being used. Accounting estimate should be reviewed, which is useful life, residual value, and we are going to give a prospective effect. Only the cost model, revaluation model, we are going to give a retrospective effect. Depreciation should start when the asset is available for use. Depreciation should cease, complete, stop when the asset is classified as held for sale. You don't have to wait for sale. If you remember, I told you, the moment you become a CA, you are ready for use. It does not mean whether you use it or not, but you're ready for sale, ready for use, you can start depreciating yourself the moment you become CA. Until that point in time, you can capitalize. Your knowledge, your expense, everything will be capitalized. But the moment you become CA, you're ready for use, depreciation starts. Once you are classified as sale, once your retirement age is completed, nobody gives any respect, that means over. You would have seen in various political parties also, after a particular age, people don't consider them. They are there, but they are not there. They're physically existing, but not living. So physical life is different, economic useful life is different. The moment economic life is over, the asset is no more in useful condition, it is classified as sale, depreciation we cannot have it. The logic still try to understand. Depreciation happens because we are using the asset. If the asset is held for sale, I'm not using the asset, so no question of charging any depreciation. But one point to be kept in mind, if it is for temporary abandonment, like we have produced enough inventory, we don't want to produce more because existing stock is only not getting used. Because of this corona effect, we have a demand problem, supply issues, we are not able to use the machinery. Temporary retirement, depreciation will still continue because asset is there, means the value still will get reduced. Temporary abandonment will not be stopping depreciation. Depreciation will stop only when it is classified as available for sale. So basically means you're moving from Ind AS 10 and you go to Ind AS 16, you go to Ind AS 105. The moment you touch Ind AS 105, depreciation stops. And you follow component method of depreciation, which means you try to depreciate every component separately. Because for example, if we take a building, the AC might have, you purchase building on lump sum basis, but it will have different components. Tiles will have different useful life, the floor will have different useful life, the windows might have different useful life. As long as possible, each component you account for depreciation separately, called as component method of depreciation. What else is the important point? Relevant especially for revaluation reserve. Quite a few points are there. So let's take a look at that. Revaluation points. Revaluation reserve will be transferred to general reserve only in the year in which it is actually sold, but alternatively the additional depreciation, meaning because of revaluation, if you got additional depreciation, that can be transferred to P&L account, not P&L, can be transferred to retained earnings every year, to the extent of additional depreciation. Additional means before evaluation how much depreciation you used to charge, after evaluation how much you are charging, the incremental depreciation, that extent you can take out from revaluation reserve and you can transfer it to retained earnings. Don't wait for the asset to dispose completely. To that extent, the reserves becomes free reserves, because when it is in the revaluation reserve, it has got lot of restrictions. As and when you use the asset, you can take out from revaluation reserve, put it to retained earnings, it becomes free reserves. One more special point, how you create a revaluation reserve. There are two methods. That is method 1, proportionately increase. That is, you increase the gross block as well as you increase the accumulated depreciation proportionately. Journal entry will be gross block you increase, accumulated depreciation increase to revaluation reserve. Second method is elimination method. That is, whatever accumulated depreciation, you close it. Basically, revaluation date, you treat it as a fresh purchase. Whatever happened in the past, you forget. Like you do, no? Even in some relationships, breakups also, you do, okay, let's stop this point, let's start fresh today, let's forget whatever happened, let's treat that as bad dream kind of thing. That bad dream here, it's called as accumulated depreciation. Everything you transfer it to the asset account and close the accumulated depreciation. Now the asset look like a fresh purchase, and from this point onwards you start providing depreciation. Accumulated depreciation will have a credit balance. Now you debit it, that account is closed. Gross block will have a debit, you credit, or you can debit balancing figure, ultimately will be transferred to revaluation profit. Okay, these are the main points connected with Ind AS 16. Okay, any doubts in this Ind AS 16 before we take up some problems? I know it's again part of your previous life, but it will be part of your current life also. Property, plant, equipment is an important standard. They will ask an exam definitely. Were you able to understand this revaluation reserve creation, or do you want a numerical example on this? You want an example on this? Okay, suppose the gross block is 1000, accumulated depreciation is, let's say, 300, therefore net block or WDV is 700, and you revalue at 770. So revaluation reserve is 70. So this revaluation reserve 70, you don't directly take it to an account because we have two ledger. Gross account is one ledger, depreciation is another ledger. We'll do it proportionately. So multiply 1000 into 70 divided by 700. So basically that comes to 100, I think. And third 300 into 70 by 700, that becomes 30. Essentially it means we are increasing by 10%. 700 to 70 increasing by 10%. Gross block 1000 to 100 increasing by 10%. Depreciation 300 to 30 increasing by 10%. Ultimately this becomes 1100 and this becomes 330. So 770. Journal entry will be gross block account hundreds to accumulated depreciation 30 to revaluation reserve 70. This is first method called as proportionate method. The second method what we have is elimination method. Elimination means first you remove it. That is what we have as depreciation minus 300 was there. I'll make it as plus 300. Basically that depreciation will become now 0. Eliminated. Accumulated depreciation closed. So if accumulated depreciation closed, then what should remain is only the gross block. That is 770. So 1000 should become 770 means this should be 230, I think. Or you can say 300 minus 70, that is also balancing figure, but it's better is 1000 minus 770 is 230. Journal entry will be accumulated depreciation 300, which is getting reduced, so I'm debiting it, to gross block, because gross block will have a debit balance. Now I have to reduce means it should be credited. So to gross block 230 to revaluation reserve 70. So basically from this point onwards the asset is fresh. The history of past whatever number of years it was purchased, it's erased. From now onwards the asset will look fresh at the cost of 770. The date of revaluation is deemed to be the date of purchase. That's how it is reflected. In both the cases, it will be on remaining useful life. But when you say remaining useful life, indirectly you are telling I'm forgetting the past. That's what I was trying to give the effect. But anyway, in both the cases, the revaluation reserve will not change. In both the cases, the depreciation will not change. In both the cases, it will remain same. But how much gross you show, how much net you show, that matters. Because you know, when there is gross amount, when there is depreciation net amount, people understand how old the asset is. Based on that, you can make projection in the future years, you know, future FCFF calculation in your financial management and all, we do it based on how old the asset is. So for that, this will have impact, but as far as direct balance sheet is concerned, anyway, it will be net reflected. 770 is what comes in balance sheet. Okay, so that is Ind AS 16. Any doubts on this one? And yeah, the change in use we have discussed enough times. The method of depreciation is the change in estimate. Only the cost model, revaluation model, only that change is accounting policy. Okay, so no doubts on the property, plant, equipment, PP. Okay, good. Okay, moving on. Let's do some problems on this one. Ind AS 16. This is a problem on decommissioning or dismantling liability. Let's read. H Limited purchased an item of PP costing rupees 100 million which has a useful life of 10 years. The entity has a contractual decommissioning and site restoration obligation estimated at 5 million to be incurred at the end of 10th year. The current market based discounting rate is 8%. So at this point in time, if you calculate present value of 5 million at discounting rate of 8% for 10th year, that is what is going to be the recognition for decommissioning liability. The company follows straight line method of depreciation. H Limited follows cost model for accounting, PPE. Determine the carrying value of item of PPE and decommissioning liability at each year when there is no change in expected decommissioning expenses, expected timing of incurring and decommissioning the expenses, or the discounting rate, no change. B, at the end of year 4, the entity expects the estimated cash outflow on account of decommissioning and site restoration to be incurred at the end of useful life is 8 million. That is, instead of 5 million, it is re-estimated. The discounting rate, no change. Determine in case B how H Limited need to account for the changes in decommissioning liability. Okay, discount rate and all they are not given, but I hope you can calculate. So you can do in calculator 1 divided by 1.08 press equal to 10 times, then multiplied by 5. I think you get 2.32. So 2.32 will be the opening balance. If you talk about the liability, and the value of the asset, they said 102.32. So you have to keep on providing depreciation divided by 10, 10.23. Liability 2.32. On that you add 8%, it becomes 2.5. On 2.5 you add 8%, that is 0.2. So 2.7. On 2.7 you add 8%, and so on. Ultimately, if everything according to expectations, you will get the closing balance as 5 million. This is the first part of the question. Second part of the question, at the end of year 4. At the end of year 4 means our value of asset was this 61.39, and value of liability at this point in time would be 3.15. Now this you need to re-estimate for the year 5 to 10. So 5 years, discounting rate same, so you do 1 divided by 1.08, press equal to 5 times, and then press 8. I mean multiplied by 8. How much you get? 5.4. This is at the end of year 4. You should press equal to 6 times. This is at the end of year 4. So remaining 6 years are there. So 1 by 1.08 press equal to 6 times multiplied by 8. You get 5.04, whereas it is 3.15. So the difference 5.14 minus 3.15 shall be adjusted against the cost of the asset in the current period. So what is going to happen to this? The difference amount, some 2 point something or 1 point something, 1.89. The difference 1.89 will be added to the carrying amount 61.39 plus that number, and 3.15 plus that number, that 1.89. So then you get, I think, 61 plus 3, 64 something, depreciated over remaining 6 years, 5 years or 4 years over. So 5, 6 and 8, 9, remaining 6 years you provide the depreciation 6, 7, 8, 9, 10, and on this liability 5.04 you keep adding 8%. Ultimately it will reach up to 8 at the end of 10th years. Okay, so this is how the change in decommissioning liability will be accounted as a part of adjustment in the cost of the asset. Had they followed revaluation model, we would have adjusted in the revaluation reserves rather than adjusting in the cost of the asset. That would be the change. Anyway. Okay, next. A Limited purchased some property, plant, equipment on 1st of April, and the estimated useful life for the purpose of financial statements prepared on the basis of Ind AS. Following were the original cost and useful life of the various components, property, equipment assessed on 1st of April 2001. A Limited purchased some property, plant, equipment and estimated the useful life for the purpose of financial statements prepared on the basis of Ind AS. Following were the original cost and useful life. Various components of PPE given: property, plant, equipment, original cost, useful life. Building, machinery, furniture, original cost, estimated useful life. A Limited uses the straight line method, and on 1st of April 2004, so after 3 years, entity reviewed the following useful life on external valuation expert. Building 10 years, machinery 7 years, furniture 5 years. There were no salvage value of the 3 components and equipment or the initial or the useful life were revised. Compute the impact of reevaluation of useful life on the P&L for the year ending 2004. So for the first 3 years, you are going to provide a component method of depreciation: 15 lakh by 15, 10 lakh by 10, 10 million, sorry, 15 million by 15, 10 million by 10, 3.5 million by 7, and that is the depreciation you get in first initial years up to date of revaluation. So 3 years over. So if you provide on this 150 lakhs, 1.5 crores, 150 lakhs. 3 years are completed, so 10 lakh, 10 lakh, 10 lakh. So out of 1.5 crores, take out 30 lakhs, remaining useful life becomes 12 lakhs. Yeah. How suddenly 12 lakhs is coming with 1.2 crores, right? It should be. Okay, then they divide by 10 also, they have done it. Okay, they have then directly gone for that calculation also. So 1.5 crores subtracted by 3 year depreciation, 30 lakhs, you get 1.2 crores divided by remaining useful life, divided by 10. So 12 lakh, similarly for plant and machinery, similarly for furniture. What will be the impact before reviewing? It was 25 lakh. After reviewing, it is 26 lakh. So because I think they have reduced the useful life, the expense have been increased. Again, not much impact. It is just that when the revision of useful life happens, you should take the value of the asset as on the date of revision and spread across remaining useful life. Anyway, this is again looks very lengthy one, but conceptually it is not a complex one. Let's go further. Okay, this is interesting one. Mr. X is a financial controller of ABC Limited, a listed entity which prepares consolidated financial statements in accordance with Ind AS. Mr. X recently produced a final draft of financial statements of ABC for the year ended March 18 to the managing director for Y for approval. Mr. Y, who is not an accountant, they are bringing the bias here. Mr. Y is not an accountant, had raised the following query from Mr. X after going through the draft financial statements. Notes to the financial statement states that the plant and equipment is held under cost model. However, property which is owner occupied is revalued annually to fair value. Plant and equipment, they are doing cost model, but property they are doing fair value, revaluation model. Changes in fair value are sometimes reported in P&L, but usually in other comprehensive income. Also, the amount of depreciation charged on plant and equipment as a percentage of its carrying amount is much higher than the owner occupied property. Another note states that the property owned by ABC Limited but rent out others is depreciated annually and not fair valued. Mr. Y is of the opinion that there is no consistent treatment of PPA items in the accounts. How should the finance controller respond to that query from managing director? How do you respond? You respond telling you don't know accounting standards. Basically, they're asking, you are doing inconsistent accounting policy. So what do you justify? is this inconsistent accounting policy? Ind AS allows different accounting policies, cost model, revaluation model for different class of assets as long as it is justified and the financial statements are resulting in faithful and better presentation. Class by class basis is what the standard uses. Uh, Class by class basis. So plant, property and equipment is a separate asset and owner occupied property is a separate assets, and therefore that is completely fine. And also we know when revaluation model applies, if it is a profit we take it to OCI, revaluation reserve. If it is a loss we take it to P&L account. So that is also being reflected. And also if you initially take it to revaluation reserve and subsequently there is a loss, first we should adjust that revaluation reserve. Any excess only you take it to P&L account, and those are the points. Reason by explained depreciation is being adjusted. And one more point he raised, depreciation charged on machinery is higher than owner occupied property. What is your opinion? Depreciation on plant and machinery, plant and equipment is at a higher percentage. That is always the case because land and building usually will have a higher useful life. And more importantly, if you don't depreciate separately, the component only building is depreciated. And the two for higher useful life, and the life is higher, the rate of depreciation will be lesser. So those kind of points you can mention. Okay. Next one also we read. I think this is exam question. January 2021. H Limited constructed a warehouse at a cost of 10 lakhs in 2015. It first became available for use by H Limited on 1st January 2016. So for one full year they are not using anything. Maybe they are preparing for exams, I think. On 20th January 2020, that is after 4 years, they discovered the warehouse was damaged. Why only warehouse? In our case, the whole flyover only will be damaged. During early February 2020, an investigation revealed that the damage was due to structural fault in the construction of the warehouse. Maybe the laborer was absent on that day of construction, so it is not there. The fault became apparent when the warehouse building leaked severely after heavy rainfall in the week ended 27th Jan 2020. In January, it seemed there is a rain. I don't know what question they prepare. 27 Jan there will be heavy rain. Rain I understand, heavy rain on 20th Jan. Okay. The discovery on the fault is an indication of impairment. Oh, impairment is also coming. So H Limited was required to estimate the recoverable amount of its warehouse. The recoverable amount estimated was 6 lakh. Furthermore, H Limited reassessed the useful life its warehouse 20 years. Originally not given. Reassessed 20 years, that is ready for the use. Before discovering the default, H Limited depreciated the warehouse on straight line method at nil residual value over 30 useful life. Okay, 30 year was the original one. Now it is re-estimated to be 20 years. Seepage of the rainwater through the crack in the warehouse caused damage inventory worth 1 lakh cost price and become unsaleable. The entire damaged inventory on hand on 31st December 19, H Limited has not insured against any of the losses. It accounts for all property, plant, equipment under the cost model. H Limited's financial statements for the year ended December 2019 were approved by the directors on 28th February. Ultimately, what you are required to think first, you should write, I'm still alive, I'm ready to read the next question. Prepare the accounting entries to record the effects of the events after reporting period in the accounts year ended December 19. Kindly ignore the tax impact. Why only tax? Problem only we can ignore. Disclose the disclosure requirement in the above cases as per Ind AS or disclosure requirement. So that's usually we don't prepare. Will your answer be different? If at all, if you have an answer, if there was no structural faults and damage to the warehouse had been caused by an event occurred after 31st December 2019. Okay. Uh, Cost of the asset we have incurred was 10 lakhs put to use from, not put to use, available for use from 2020, and depreciated over useful life 30 years. So 10 lakh divided by 30, that will be around 33,000. And how many years are over from 2020? From 2016 to 2020. So 17, 18, 19, 20 is not completed yet. So we can say that 16, 17, oh, this is December ending. So, okay, so 2016 1 year, 17 1 year, 16 full, 17 full, 18. Okay. What are the dates on which the changes have taken place? There's them on 31st December 19. There was a recoverable amount. So we should first arrive at 19 and then we come to 2020. So you provide depreciation for 16, 17, 18. If you provide at that point in time, it will come to 333 on 333 into 3 years. So basically 1 lakh. Or no, 3 out of 30 year is over, 1 by 10th is over, 1 lakh. 9 lakh is the carrying value. And at that point in time, they have re-estimated the useful life of 20 years. But this is 20 years from which date? From that date. Sometimes we have to apply not just the English sentence, we have to apply a little bit more interpretation, because what was the original useful life? 30 years. Out of 3 years over, so we have to have remaining 27 years. I mean, if I just continued as it is originally, if I do from this point onwards, one interpretation possible is from the 2019 remaining 20 years. That is one interpretation possible. The other interpretation is when they use the word from that date, it was ready for use. From which date it was ready for use? From the year 2016. So that out of 20 year also 3 year is over. So remaining useful life is actually 17 years. I'm just calculating at the beginning. I'm calculating for the year 2019. Usually revaluation will happen, the revision of useful life will happen beginning of the year. Revaluation will take place at the end of the year. That is a change you have to remember. So I know 2019 they are re-estimating the life, but 2019 life means you should include that year as well. In that sense, if you take it 4 years, that you will do it from 20 onwards, but I want to do it for 19 also, and therefore you should interpret the calculation from beginning of 2019. So don't take it as 4 years completed, take it as 3 years completed. S limited required to estimate recoverable amount. Recoverable amount on December 19. Therefore, on that dates, we are going to calculate the book value. So what would be the depreciation for that year? 9 lakh was the asset we discussed, minus 9 lakh by 17. That is 52,941. That is the depreciation to be charged, and of course you would have charged 33,333. So if you want to understand the additional depreciation, they have calculated like this. Let me show the numbers to you. We just discussed 10 lakh divided by 30, 33,333, 3 years completed, so 9 lakh, 33 into 3, depreciation you subtract 1 lakh, 9 lakh, 9 lakh divided by 17 years, that is 52,941. And If you are not done this, you would have charged 33,333, and therefore additional depreciation is 19,608. But effectively, that year depreciation taken to P&L account is 52,941. Is on second and first same note, is it? Okay, fine. Does not matter. Okay. Prepare the accounting entries to record the effects of events after the end of reporting period in the accounts for the year ended December 19. Kindly ignore the tax impact. So basically, deferred tax impact we are ignoring. So at this point in time, what is our carrying amount? It's not there, just calculate. 9 lakh was the beginning amount minus depreciation of 52,941. Some 8 lakh something you get. 8 lakh 47. But recoverable amount was 6 lakh. So that 8 lakh 47 minus 6 lakh, which is called as the impairment loss. So impairment loss account debits to accumulated depreciation. Okay, the second part of the question. Discuss the disclosure requirements. Okay, disclosure requirements, you write it as whatever the disclosure requirements in relevant Ind AS. So when there is a change in the useful life, you have to mention the same in the notes to accounts, and in case of impairment also, there should be some indicator reason for which there is impairment. They're told whatever leak happened, structural fault. Of course, you don't give the full description. To an extent, those information should be mentioned. I mean, that is not part solution here, but you should mention that. First of all, will it be an adjusting event? Because 31st December 2019 is where we are preparing the accounts, but it was found on 27 Jan 2020 because of the fire. I mean, because of the rain. Structural fault was there earlier. Condition was existed, no? No, it was there. We did not know, but it was there. Yes, the fault became apparent when the warehouse building leaked severely after rainfall, but the structural fault was there. Again, on 100% wise, the standard will not give any answer in these cases. We have to apply a judgment. So reasonable judgment if you have to apply. There was a fault. I mean, there was a issue. And 27 January the fault was discovered. On 29th January the warehouse was damaged. On February 20 investigation revealed. Investigation might take place later, but the fracture, the structure was there earlier, and fault was not arising later also. The fact that we don't know is a different matter. A similar question I can say, I mean, approximately, if there is a fraud, if there is a cash lost, we might discover that there is a fraud or there is a missing inventory item only later. But the fact that that was happened earlier will call for the condition existing on balance sheet date. It is event occurring after balance sheet date. Adjusting event is what we are going to treat it. Yeah, if you knew that information but you're not providing it, yeah, if after the year end, before the approval of accounts, if information was there and you are not able to, you did not provide information, yes, that would be an error if you are supposed to account and not account it. But again, alternatively, again, this is not a conclusive answer because these are all again subject to interpretations. When you say that a condition existing, should I interpret as condition that existing which is being aware of the, I mean, which is being aware? Not necessarily. You can also argue that yes, the physical thing might be there, but how do you expect us to know on 31st of March the condition should be there? So you can still argue. I'm not denying the fact that it cannot be treated otherwise. There is honestly not a clear cut answer, and that's how the standards are built. So you can argue that there is a structural fault, yes, but so again, for example, let's say the building was okay, but later there is something happened and the inventory or the asset now is becoming having problems. Now can we also argue, oh, asset was there earlier? Now you argue that it is being damaged, the event might happen later, but it is being damaged because asset is there. So we can go to that extent as well. That will be too much, but it's like telling the cause of death is life. You die because you had life. It's like telling what is the cause of divorce is marriage. We can't go to that extent. No? So we have to apply our reasonable interpretation. My interpretation is because it's a structural fault, they were supposed to know it. I know it's a technical fault, but when something is obvious, it is the duty of the company while taking the delivery, or the engineer or the construction company, to tell the fact that okay, there is a problem there. In a basic fault, if it is some other issues which you could not have identified, is a different matter. So I would interpret this as a adjusting event. That is my interpretation. Let's see what institute has given. The damage to warehouse is adjusting event occurred after the end of the year for reporting, since it provides evidence that the structural fault existed on the reporting period. It's an adjusting event in spite of the fact that fault has been discovered after the reporting date. So fault identification becomes more of a, you can say in the form, legal form, but in substance it was already had a problem. Second part, will your answer be different if there is no structural fault and damage were been caused by event occur after 31st of December? Then yeah, this should be very clear because the event itself is occurring after December. So it is not because of the physical earlier fault. The fault itself is created later. So this will be treated as, where is that? Yeah, this will be treated as non-adjusting event, and it will be accounted in the subsequent year. Previous year you don't provide any revisions. You don't provide any adjustments towards impairment loss and all. In the first case, that is assuming the first case. No, if it is an adjusting event, I should consider that, no? Because we are calling it as adjusting event. That's a meaning of adjusting. No, we should make adjustments. Even though the fact was discovered later, but there is a fault already existing in the asset earlier itself. So if you imagine purely from the concept, keeping the standard aside, what is the meaning of depreciation? The value of the asset coming down over a period of useful life. Now the fault was already there, so the depreciation already started, and depreciation can be there only till its end of useful life. So it makes absolute sense to depreciate over the revised useful life, even though you discovered it later, because discovery is for you, but it is already having that useful life. We call this as one small puzzle kind of thing. I don't know whether you heard of it. Before Mount Everest was discovered, which was the highest peak? Mount Everest itself, right? Because it was discovered by somebody else, but it was there already. That does just mean something else is the highest. That is still the highest peak. Similarly, the fault of the machinery, we have found out it later, but the machinery had the fault means the useful life was already reduced. You have estimated later. So making depreciation at a higher useful life, at lower useful life at a higher rate of depreciation, it's fine. It should be appropriate to reflect the benefit pattern. The already fault means you would be producing less units, you would be getting lesser benefit. So you provide impairment and you provide less depreciation. If the company was aware of, they should still provide the depreciation on the remaining useful life. Whether whether this fact was discovered after the year end or the fact was discovered during the year, the answer would be same, because the machinery had a useful life of so many, or whatever the asset had a useful life of so many number of years. The fact that we discovered later would not have that impact. But when the event itself is caused in the next year, so we are going to account it in the next year. That is what the second part of the question, or part C, whatever the question number. That would be a non-adjusting event. Okay, so that is regarding this exam questions. So let us move further. Heaven Limited, starting with the Heaven, purchased a machinery on 1/4/2001 for rupees 30 lakh, which is reflected in the books. Written down value 17,50,000 on 1/4/2006. Okay, that is 5 years over, and 30 lakh became 17,50,000. You provide depreciation. The company estimated upward revaluation of 10% to arrive at the fair value of asset. As Heaven Limited availed the option given by Ind AS, transferring some of the surplus as the asset is used by the enterprise. Additional depreciation from revaluation reserve will be transferred to retained earnings as and when the asset is used. That's what meaning of it. On 1/4/2008, 2 years over, machinery was revalued downward by 15%, and the company re-estimated the machinery life to be 8 years. And on 31st March 2010, 2 years later, I think every 2 years something happens, the machinery was sold for 9,35,000. Okay, after that nothing will happen. The company charges depreciation on straight line method. One good thing, thank them. Prepare machinery account in the books of Heaven Limited over useful life to record the above transactions. It's a pure ledger accounts, straightforward thing. Date of purchase 30 lakh. What is the depreciation? Have they given useful life initially? No, we don't know. So we just know that the 30 lakh became 17 lakh 50,000. So 12 lakh 50,000 divided by 5 years. So it's the cost minus carrying amount divided by useful life. Divided by number of years. Anyway, so it's in that way of calculation. 30 lakh became 17 lakh 50. That means depreciation for 5 years is 12 lakh 50,000. Divided by 5, you get 2 lakh 50,000. So by depreciation 2 lakh 50, by depreciation 2 lakh 50, by depreciation 2 lakh 50, by depreciation 2 lakh 50. By depreciation 2 lakh 50, 5 years over, yes, ultimately the balance became now 17 lakh 50,000. I hope this kind of question they don't ask in exams. Just time consumption, nothing else. As on that, you are revaluing upward by 10%. So 17 lakh 50,000, 10% means 1 lakh 75,000. You will transfer it to the revaluation reserve. And you start providing depreciation on the remaining useful life. How much is remaining useful life? But on which date? Is it 1/4/2008? Oh, but is this 1/4/2006? No. No, on this date, they have upward the revaluation by 10%. So we'll assume that the machinery also upward by 10%. Okay, so if you do that 2 lakh 50,000, 10% means 2 lakh 75,000. Okay, that's the only assumption reasonable possible, but we don't have anything. So when the revaluation is upward by 10%, we assume depreciation also is upward by same thing, 2 lakh 75. Again, next year 2 lakh 75. So it will be 2 lakh 75 subtract 2 lakh 75 subtract, it will come to 13 lakh 75,000. And on 13 lakh 75,000, this dates, you have revalued downwards by 15%. So will you get this number? Check it. 13 lakh 75,000 into 15%. 2 2 lakh something you get? 2 lakh 6,000. Out of which revaluation reserve was 1 lakh 75,000. But they also did one more policy, no? 1 lakh 75,000 revaluation reserve. They used the policy of transferring the assets. I mean, they're transferring the reserve to general reserve. They've used that policy. So as on date, we don't have 1 lakh 75,000. This would be transferred to general reserve in proportion to depreciation. So how much of the depreciation, what basically differential amount without. Previous depreciation was 2 lakh 50, I mean without revaluation. Now we are having 2 lakh 75, so difference is 25,000 and 2 years over. So from 1 lakh 75, 25 is transferred to retained earnings, again 25 is transferred to retained earnings, so balance will be 1 lakh 25,000, and 1 lakh 25,000 is what you are adjusting in revaluation reserve. Excess loss is there, that is what is taken to P&L account. Remaining amounts, whatever you have, you are going to provide depreciation and over useful life, and here you know remaining useful life is 8 years. You divide by 8, check it out, will you get 13 lakh 75,000 downwards by 15%, so into 85% divided by 8 years. Hope you get that 1 lakh 46. Please check out. Or 13 lakh 75 minus 1 lakh 25 minus 81 250 divided by 8. Getting it? 1 lakh 46 approximately. Getting it? Or no? No. Yes? Okay. Next year again same depreciation you provide. By depreciation 1 lakh 46,094, and this date you sold 9 lakh 35,000. Next year 2010 you sold it. Revaluation reserve I think is closed, right? Nothing balance is there. So balancing figure you transfer to the P&L account, profit on sale of asset. So see if you are able to understand the concept of revaluation reserve, depreciation calculation. Revaluation reserve white is only 1 lakh 25 and depreciation subsequently. Okay, any doubts on that one? Okay, next. Okay, Ind AS 116. As usual, before we start, any specific concern in this standard, any particular confusion you have in this standards? Everything is an answer, but just one basic question, again not relevant for exam, but just a curiosity question. Which industry is most affected because of these standards? Of course, CS students industry, but beyond that, it is airlines. Because usually airlines don't purchase air flights, they take it on lease basis, and they used to avoid showing it in the balance sheet. They used to have very good ratios. Now they are forced to show it in the balance sheets, the operating leases, because in the books of lessee there is no distinction between operating lease and financing lease. It was there and now it is removed. That is a major change. The lessee books, the distinction between operating lease, financing lease has been removed. And recently also one interesting news is going on. I don't know whether you followed it. That is between Reliance and Future Retails. That is Big Bazaar. This case going on between Amazon and Reliance and who will acquire it. And intelligently what Reliance did is they occupied the Big Bazaar stores and gave it to Big Bazaar on sublease basis. Now Future Retail is not in a position to make the payment of lease. So what will they do? They will exit. And so who will occupy the stores then? Reliance will occupy the stores then. So without amalgamation, they amalgamated, they acquired. Because amalgamation means case going on. Amazon has put file a case against CCI, against all these things that we have invested. They cannot take over all those things. Anyway, so lease is such an interesting topic, even practically, and Reliance is winning handsomely there. So fundamental change as compared to the previous standard is in the books of lessee, where we don't have the concept of operating and financing. Instead, what we have is exempted lease and other leases. Exempted lease, where we don't have to apply this standard in case of two cases. One is the short-term leases and the other is low value items. Short-term lease less than 12 months. We even include renewal period, like if 8 months is the lease period but likely to be renewed for next 5 months, likely also we consider, or our habit is to renew, that also we should consider. Substance over form matters. So short term less than 12 months, we don't have to worry about this standard. Whatever the amount you pay, you can take it to P&L account as expense. No other treatment required. Low value items, they have not specifically given how much is low value item. They just told you two conditions. Lessee benefits on or readily available resources, or it is not dependent or not highly integrated. This statement or this wording is there in one more standard. Similar wordings is there in Ind AS 115. In which context, when we go there, we'll discuss. Basically, this point is trying to tell that it is capable of being used independently. Otherwise, you know what our brain will think. Low value items will do one thing. Car is there. Tire you take separately. Tire renting. Then seats renting. No, low value items, we'll say low value items. We don't have to apply any of these Ind AS 116. But they cannot be used independently. They have to be used together. That's what we mean by low value items. Basically, it has to be small in nature and used independently, not in connection with anything else. In these cases, you can directly take it to expense, or you can do a straight line method. That is the choice you have. Now, here we comes, what is the meaning of lease? Basically, it is use of asset, but not having ownership. At inception, earlier of lease agreement date, or at the date on which you commit yourself. So if you have to have a lease, there has to be an agreement, lessor, lessee. The most important point for lease agreement is this: there has to be a right to control the asset, and the asset has to be identified asset. For a period of time, yes, there has to be a lease period for a consideration that is called as lease payment to be made. But important is, the asset has been transferred to you and we have given the right to you to use in that period. So in this context, you go to theater to watch a movie and you sit there for 3 hours. You have the right to use the seat. So does it mean that you have to account for operating lease as per Ind AS 116? So that's where we have that exempted lease. Otherwise, that also we start applying it. In concept, it is true. Okay, and one more important point. I mean, these things are there. That's concept wise, I'll explain. That is called as SSR, substantive substitution rights. Again, these points are very similar to Ind AS 115. Let's try to apply at a later point in time. A typical example we'll take, you understand this point better, which is hiring of cabs. Let's say company want to provide a cab service to its employees and they hire a cab service company. Now, will that be called as a lease? Now, will the company know which car they provide? The car which the company not know. We need cab service company. We are not worried about the whether you take it Innova or you would come up with Nano or you come up with also, I don't know. I need the car to be used for our employees' transportation. So our agreement is service. Our agreement is not the product specific item. But if you hire, let's say if you take a company, but one car is dedicated for you or for your managing director, specifically, that becomes a lease agreement, because the asset is specified and you are not just using the service, you are defining the asset and you are using the asset. That is one example. And if they can substitute the asset whenever they want, the cab service company, can they take back the asset according to their wish? They can put another thing back? then again it falls into the outside the scope of 116 because they have the right to substitute. So basically, summary is this: the person who is giving you the asset, if he has the right to take it out, then Ind AS 116 don't apply. He cannot take out whenever he wants. It is under the lessee control. Ind AS 116 applies because the asset becomes very integral part of the lessee's operations and it cannot be taken out. But sometimes they will have a protective rights, especially Indians. If it is not ours, we do whatever we want. Anyway, it's not ours. Who cares? It's not mine. Our mindset is like that. Therefore, they will have a protective right. Like if it is too much damage, then I will have to take it out. Or if it's too much damage, you have to compensate for it. So these kind of, for protection purpose, some clauses will be there. That is ignored for the purpose of classification, whether Ind AS 116 applies or not. So that's what they say. Substitution right, this should be practically able to substitute. Just the right is not sufficient. Whether he can really come and substitute it backwards. That is what is this identified point is all about. Identified asset, physically distinct, right to control, need not be explicit, maybe for a portion of the term also. So for example, if it is, you'll be like in case of supermarket and all, or big bazaar, you tell during the festival season, 1 month you dedicate this space for us, particular space, not any other space. So throughout the year you don't occupy. Only during festival season occupy. Good enough. We are not worried about the full term occupation as long as the asset is clearly defined and right to use the asset is in place. Maybe for a portion of the term, that's what the meaning. It may be for a portion of asset also, like the capacity may be shared. In case of cold storage and all, a particular capacity may be shared because many people have to use it. That is also fine. So ultimate point is this: who will direct the use of it? Your parents will purchase a new mobile phone with some extra features and all, but you only use it, or you tell your parents how to use it. In both cases, it is your asset, it is not there. Similarly here, you might purchase a machinery. Popular example we take, even institute question is there. There is one solar plant which being installed, and for installing the solar plant, government gives some subsidy to the owner. You receive it. And once you manufacture the units, for that also government gives subsidy. So who is the real beneficiary of the solar plant? The person who produces solar units or the person who owns solar units? We should look at the use, not the ownership. Who is using the asset? The person who is producing the units, electricity. He is getting the benefit. Therefore, it is the person who is having physical ownership, physical possession. He will have the direct to use, and he will account it under Ind AS 116. So basic agreement, what you should divide is it a supplier arrangement or is it a lease arrangement? Many times construction contracts, what happens is the customer only gives you the asset also. Use it. Let it be in your place, use it, but I'll tell you how to be used. So in those cases, it will be a supplier arrangement, not a lease arrangement. That would be these points. Institute has given in so many pages. Ultimate summary is this point. Practical expedient is available when you are not able to separate lease and non-lease components. Sometimes it happens, especially in case of association and all, you might collect maintenance charges together with parking fees, so you don't know the separation between the elements. If you're not, to the extent we should separate, of course, but if you're not able to do, use the practical expedients, and you can show it as direct expense. But if you can do it, separate the lease and non-lease component, you do it on SASP. This is one more name you will hear a lot: standalone selling price. Again, we'll take same example of residential apartments or for companies. They will have to pay monthly maintenance charges. Maintenance charges include the payment towards the security services and the payment towards car parking, let's say. So you have to, they might give only one invoice. involving many components, lease component, non-lease component, meaning the security service is a non-lease component, car parking is a lease component. So we should divide proportionately based on their standalone selling price, meaning had they charged separately for somebody else, what would be that amount? That is based on standalone selling price, we should apply proportionately. But if you apply practical expedient, you can directly show it as expense. That is the practical application given. Contract can be combined. If there are many contracts, contract can be combined. Again, same points we see even in Ind AS 115. There we'll see this point. This will be more appropriate. The same terminology. When the leases are negotiated as part of package, consideration is dependent on other contract, or you have right to use is a single lease component. Okay, so important point is that whether it is a supplier contract or a lease contract. Then comes the lease term. Lease term, basically we try to understand the period in which both cannot cancel, non-cancelable periods. Both cannot cancel. If one party can cancel, it will not be part of lease period. That both party cannot cancel means the contract will be alive up to that periods. Then many things can be added. A lessor will have a choice of termination, a lessee will have a choice of termination, or you can stop it earlier, or you can extend. Extension also there. All these things are there, and what we consider is the past experience, significance of the asset, economic consequences. For example, at least in this city, we usually enter into an agreement only for 11 or 12 months maximum, or let's say like 13-14 months, or let's say 3 years. But if you look at the history, we would have occupied that building for 20-25 years also. These agreements says 1 or 2 years, we keep renewing it. So when you know the fact that in the past experience it is being renewed so long, then we should take as much as possible in the next period. To what extent you can estimate, you can extend, that also will be considered. So all these things are logical. If you are planning to extend, the renewal period also you consider, or if you're planning to terminate, the lower period only you consider. Depending on your expectations, you can include it. You can reassess the term as well in certain situations, when the event occurs, or when non-cancelable period is cancelled, or some factors affecting your moving out, or rent is increased for whatsoever reason, it might be reassessed. That is also not a worrying point. Lease payments, broadly we are having 2 kinds. Okay, we'll discuss that. But any questions up to this point in time? Okay, lease payments, broadly 2 varieties. One is fixed payments, other is variable payments. Fixed payments, as the name suggests, it is a fixed number, but variable payments changes subject to few things, and few elements we will still consider it. For example, variable payments depending on index or rates. Basically it might be like an inflation related thing. We connect with the consumer inflation index, those kind of things, they are part of lease payments. But if it is not connected with index, it might be connected with units produced, for example, or units sold, any other connection, then they are not part of lease payment. You can call it as royalty or something, or any expense. That is not called as lease payment. Lease payment means it should be towards use of the asset, not sale of any items. And use of the asset, inflation will happen, increase in prices. That's why they said it can be indexed, it can be connected with some rates. In substance, lease payments are there, that you don't worry. Lease incentives, like a cashback offer. Lessor will give you some money, maybe you have constructed something, or you have taken care of the asset, or if you enter into agreement within 3 months without taking much time, some sort of concession will be given. That is called as lease incentive. Basically we will subtract from the lease payments. and if it is regarding any improvement like some construction happening, and from that it is going to be reduced. Ultimately we will reduce from lease payments the incentive portion. Variable lease payments already covered it. Direct cost, incremental cost of obtaining the lease, we will take it to the part of lease payments. Which discounting rate do we use? We should use the implicit rate or incremental borrowing rate. Again, lot of interest rate rules are there, don't worry much. What is relevant for you in the books of lessee? Let's focus on that. Initial recognition, how do you measure it, and lease modification, how do you do it, and ultimate presentation points. On the commencement date, this is the important point, you will recognize an asset as well as liability. You will recognize ROU asset equivalent to the lease liability. So lease liability means the whatever the lease payments that you are going to make, the present value of lease payments, of course present value means present value discounted at the rate. The present value of lease payments you are going to record as asset as well as liability. The liability you will follow amortized cost basis, you keep adding the interest minus the payment, but asset you will provide a depreciation depending on the class for which that asset belongs. It may be furniture, building, network equipment, maybe property and so on. So right of use of the asset, ROU asset, will be recorded at equal to liability plus few things. Any cost you incurred separately, any further cost of restoration, dismantling liability as per Ind AS 16 we discussed. Any incentive received will be subtracted. Payment before commencement also will be capitalized. So because of these elements, the asset and liability may not be equal. Payment already made. Subsequent measurement, ROU asset, you provide depreciation, you also provide impairment, and if liability is remeasured, you correspondingly provide adjustment in the asset. We'll see what to be done on that. Lease liability means we follow amortized cost basis. If there is a remeasurement, that liability and asset will be connected. What and all you recognize on the ROU asset, you recognize depreciation, and if asset value is decreased, impairment and variable lease payment, you show it separately. On lease liability, you keep providing interest expense, whatever the rate of discount that you have used earlier. Okay, remeasurement of liability, when will happen? When the lease term is reassessed, or you have got the option to purchase. Earlier you thought you will not purchase, no, I will purchase the asset, or vice versa. In those cases, or in guaranteed residual value changes, future lease payments because of index rate. In these cases, sometimes use original rate, sometimes use revised rate. Let's understand the logic behind this so that you don't have to by heart this point. When you use the revised rate, in case of lease term being changed or purchase option being changed, when do you use the original discount, GRV, guaranteed residual value, GRE is guaranteed residual value guaranteed by the lessee, or payment on index changes, variability is resolved. In these cases, you continue to use the original discounting rate. So basically you can see the impact here. Lease term change, you are not expecting it earlier. Purchase option change, earlier you thought you will not purchase, now you thought it will purchase. It's an impact on concept, principle. There is a change in the lease term. We call it as dissolution of partnership versus dissolution of firm. Again, if you remember your previous life, when there is a profit sharing ratio also, the partnership is dissolved but the firm is still there. See here also, when the GRV change, when the payment amount change, when the variability is resolved, in substance the lease agreement is same. Amounts is getting changed. Use the original rate. But lease term is only changing, or purchase option is being changed, meaning these lease getting extended. So it is a substantial impact, and therefore we should use the revised rate. And in case of lease remeasurements, we are going to adjust the asset as well as liability. Asset is increased, ROU is decreased, or asset is reduced, liability also reduced. If ROU was not there, because if it would have been impaired completely, then you transfer it to P&L account. Lease modification. Modification will happen in these areas, actually, in this situation, mostly when there is a substantial change. That is, change in scope of a lease. Earlier you're having 2000 square feet, now it is 1500 or 2500, decrease or increase. Change in consideration, the lease payment have been changed, not in connection with the inflation. In substance, the value is being changed, which was not part of the original lease. In these cases, you are going to account for lease modification. Renewal option is not lease modification. Change in the assessment of option to exercise, it's remeasurement, we just discussed. That is, earlier you thought you are going to purchase, later you decide I will not purchase. Exercising or not exercising, that is not called as lease modification. Accounting wise, you account for the modification as a separate lease if it increases scope and commensurate with the standalone selling price. For example, you have taken 2 floors in the building on rental basis, now you take 1 more floor, and for 1 more floor you pay separate rent. So the floor is a separate in scope and the rent payment is also separate, so you account it as a separate agreement. But if the normal lease agreement for the floor is 1 lakh and they will tell you, okay, you have been with us for a long time, we'll give you only at 40,000. That 40,000 is not commensurate with the standalone selling price. So that lease agreement I cannot treat separately, I have to take it as a part of my existing contract. That is, I cannot treat it as a separate lease. If not a separate lease, decrease in scope can happen or other increase also can happen. If there's a decrease in scope, means the liability will reduce, asset will reduce, we should do it proportionately. Because when the scope reduces, the ROU asset, when you recognize right of use, is towards using the, let's say, building or asset. When the scope of the asset is reduced, that is, you're not going to use 5,000 square feet, use only 4,000 square feet, ROU asset should be reduced proportionately. Similarly, the liability also should be revised to reflect the new liability, and difference, if any, taken to P&L. Understand, in case of remeasurement, the difference, we take it to the ROU asset liability, we adjust there itself, because only liability is remeasured, asset is not touched. There only liability is remeasured in case of remeasurement when the amount changes. So liability changes and asset we change it. But here, in, for example, decrease in scope, asset also reduced, liability also reduced. That's a major difference between lease modification and remeasurement. And difference, if any, is transferred to P&L. In all other cases, that is, if it is not decrease in scope, then you treat it like a remeasurement. That is, ROU asset is adjusted and lease liability is adjusted. Okay, any doubt in the modification? All these charts are there in the material, you can read through it. And recently they have put on a concession thing, COVID concession, telling that if you look at this point, change in consideration means when the lease rental changes, we have to account like a modification. Modification means ROU asset should be reduced and liability also should be reduced. Slightly more complicated, but because of COVID, if you are getting a concession in the rent, don't worry about the lease modification, you account it as remeasurement, meaning difference you can directly take it to P&L account or something. No need to worry about ROU adjustment as well as liability adjustment. That multiple calculation is not required. The practical experience says it's optional, not compulsory. That if you are using the COVID rent concession, you treat as if it's not a lease modification. It's a expedient, not a compulsion. It's a choice that entity should make. This is in the books of lessee, the person who takes the asset on lease. The charts are there in the material, part of the PDF shared. You can go through it at your free time. But any conceptual doubt, get it clarified. One of the very common question I get from students, at least I think 2 days once I get this question, that how do the institute question assumes lease payments are done at the beginning of every year. The study material questions, every question they have assumed lease payments are made at the beginning of every year. Question did not say it. All the solutions are based on that. That is just an assumption. It is not a rule. You can assume either ways depending on problem information. Usually I like to assume as payment made at the end of the period. Okay, any doubts until here? Okay, let's come to lesser accounting or lessor accounting, not lesser accounting. This is same as AS 19, if you remember your previous life. The accounting is a financing lease or operating lease. Financing lease means it is a lease treated like a sale, deemed to be sold, substance over form. You are not treating it as a sale, but as if it is given out. Hire purchase also an example. So substantial risk and rewards are transferred. In that case, it is financing lease, and financing lease basically means asset is derecognized, and the fixed asset is derecognized in place of the debtor is replaced. You have sold the goods indirectly. That is the treatment. And there are some specific situations, illustration given in the standard, whether it's a financing lease, and if at all they ask an exam, it will be these areas only. Ownership is transferred at the end, or option to purchase less than fair value at the end of lease period. Lease term is major part of economic life. The present value of lease payment is more or less same as the fair value of the asset. Asset is a special nature that only lessee is capable of using for its intended purpose. So in these illustrations, even though lessor is the legal owner, lessee is the real owner in its typical usage. The benefit of a owner is accrued to the lessee, so we treat it as a sale only. And recognition is financing lease. Initially you de-recognize the book value carrying amount and replace it by NIL, net investment in lease, nothing but present value of lease payments. The lease payments present value is called as the GIL, gross investment in lease, which considers lease payments by lessor as well as unguaranteed residual value. UGRV means unguaranteed. The reason being, from lessor point of view, only GRV would have taken. Unguaranteed we would not have taken. From lessor point of view, we take both. Lessee we take only guaranteed. Any difference is there, we take it to P&L. Subsequently, on this present value, on this net investment in lease, we are going to recognize income. And one more term is also there. Difference between gross investment in lease and net investment in lease is called as unearned finance income, because this is the income will be earned over a period of the lease period. Okay, there is one more concept, that is sublease. Sublease means you take the asset on lease and give it to somebody else. It's a release by the lessee. So two lease will be there. One is head lease, other don't call tail lease and all. It is called as the sublease. You take one lease and you give it on lease. So basically the middleman is a lessor as well as a lessee. So party will be original lessor at the top, in between sublessor, and below him it is sublessee. So classification of sublease, when the head lease is short-term lease, that is top it is short-term, then a sublease operating lease. Otherwise it can be either operating or financing. Classification of head lease, you cannot use the exemption because you are taking the asset and giving the asset. So exemption cannot be played out here. And accounting wise, especially the question will be only in the point of view of the middleman. He will recognize the lease income as well as he will recognize the lease expense. So when he takes the asset, You will recognize ROU asset and you will recognize the lease liability when you take the asset. When you give the asset, depends on whether you give it as a financing lease or you give it as a operating lease. If you give it as a financing lease, ROU asset will be taken out because it's no longer with you. You will de-recognize the ROU asset and you will recognize the net investment in lease if it is financing lease. If it is operating lease, ROU asset will continue. You just recognize operating income every year when you receive the money or on straight line basis. That is regarding the sublease. Who will claim the depreciation? And whoever is the owner of the asset. Okay, if you take the asset on lease, you will recognize ROU asset, lease liability. On ROU asset, you will recognize depreciation. You give it to other person on lease, your intermediary. If you give it on financing lease, ROU asset is de-recognized, you cannot claim depreciation. If you give it on operating lease, that means ROU asset will continue in your books, you will provide depreciation. So that will be the treatment in case of sublease. Don't ask me about income tax, because as of now, both people will claim depreciation. On ROU asset we claim depreciation, on the asset other person also will claim depreciation. Income tax, it's a different status together, and here we are going by pure standards. And there is one more, that is sale and lease back. So it's again very interesting one. A problem is also there in the institute material. Not sure to what extent we can cover it now. I'll quickly explain. You sell the asset, therefore you are a seller, and you take back the asset, so you are called as lessee. Other person is taking the asset, buyer, but he is giving it to you, therefore it is lessor. To the extent of you have sold the asset, Ind AS 115 will come to the extent of you transferred the control. For seller, for you who is selling the asset, lease liability is recognized because you're taking it back on a lease basis, and ROU asset is also there. Sale transaction is accounted as per Ind AS 115, and sale consideration minus not the full carrying amount, proportionate amount transferred will be recognized as profit. For the buyer, reverse, he will treat as either operating lease or financing lease because he's the lessor, and he will purchase as per other standard. If control is not passed, then we treat the difference as borrowing amount, the difference between sale consideration and fair value, and asset is not recognized. For the buyer, it will be trade receivable, and asset is again anything additionally not recognized. I'll try to share one example. I don't know to what extent you are able to understand. Try to understand is all my request. Company A transfers to company B. The book value is 1000, selling it at 1200. Therefore, you will have a profit of 200. And the asset will come back to you. That is why it is called as the lease liability. And let's say that 60% is transferred and 40% is retained. Retained means it is coming back to you in the form of lease back. Therefore, you have to recognize the asset to ROU asset. You see, 1000 rupee was the carrying amount, that 400 you have to recognize. And the lease liability, let's say 480 rupees, you have to account it as ROU asset account debit to lease liability. Approximately that's what I mean. 480 out of 1200 is the 40% retained, balance 60% continued only to the extent of 60% transferred. So out of thousands, 60% means 600. The amount consideration 720, you will take it as a profit on sale. Balance 480, you are receiving the money, you will treat it as lease liability. So journal entry, if you see together, bank you are receiving 1200, ROU asset is 400, basically proportionate of asset retained to asset entire asset is derecognized. Profit on sale only to the extent of asset transferred, profit recognized. Lease liability, whatever the present value, happened to be 48. Just take a look at the example. I'm not sure to what extent you can follow it, but it is interesting. Basic point is this: you have an asset, it's going out, it's coming back, and it's coming back as ROU asset. So the amount of ROI asset should be proportional to my carrying amount. I'm selling the asset, entire profit I cannot recognize. I'll tell you once more, see what you're able to understand, maybe with the help of this number. 1000 rupees the carrying amount. 40% is coming back. That 1000 rupee will be transferred to ROU asset account. That 40% of thousands, what is being back, will be transferred from my book value of the asset, will be transferred to ROU asset. So you debit ROU asset 400. And balance 60% is transferred. On that I can recognize my profit on sale. 1000 rupee was the carrying amount, 60% means 600, transferred at 720. So 120 I'll recognize profit. The balance 480 represents my lease liability. And if I sell it above market price, that will be treated as either loan or loan given or loan taken, treated under Ind AS 109 when it is above fair value or it is below fair value, like in this case. The 200 will be accounted separately. Anyway, just take a look at this example and see if you have any other doubts in Ind AS 116. Lease liability of 480, assume it is present value of lease payments. Assume that this 480 is calculated as present value of lease payments, discounting the lease payments. That approach. You assume you got that 480 on fair value basis. So 480 is the number representing a portion of fair value asset transferred. That's why 480 present value of lease liability, you see lease liability 480 out of 1200. So 40% on a fair value basis. I can't compare 1000 rupee because 1000 is my carrying amount, but 480 is the lease fair value. So that's not comparable. Sale value is comparable, 1200. If it is sold above fair value, let's say 1250, that 50 rupees will be taken as a liability. That is an additional liability. That's a separate liability. That will not be mixed with these calculations. If I have to explain other way around, had you not applied any of these things, you would have recognized 480 rupee as the asset. The lease liability equal to ROU asset. But this 480 includes your own profits, which I don't want to include, and that is why I am debiting ROU asset only to the extent of 400. That 80 rupees is my asset. I have not sold, so I cannot recognize profit. Only the cost element will become ROU asset. If I had not applied this point, ROU asset would have been 480, lease liability also would have been 480, and my profit would have been 200. The entire sale consideration minus cost. But because asset is coming back, I cannot recognize full profit. Again, if you purely think logic, you don't require any of the standard requirements. That is how the Ind AS is structured. Anyway, take a look at this, see if you still have any doubt. Okay, one last point is there, that also I'll quickly cover it. I think I've been telling for 3 points, last point. Transition approach, when you're moving to the standard for the first time or applying Ind AS for the first time. Practical experience is there. Yes, you can directly take from the date of acquisition, or what you have is less or no change. For lessee, transition gives you broadly 3 options. One, full retrospective approach. That is as if you go back to the origination of the lease period and account from the beginning. This ROU asset, you provide depreciation, lease liability, recognize the interest expense, full retrospective approach. And you use the original rate. Modified retrospective approach means you show the cumulative effect in the opening balance. Whatever happened, let's forget. Opening balance will show the cumulative approach, and from this point onwards, I'll start providing the correct rate of interest. Then second alternative is don't worry anything about the past. Let's account it this as if the lease agreement is signed today. Historically, we forget on this date of transition becomes the date of lease agreement initiation. That is what is prospective effect. We use the new rate of interest. That is modified approach alternative. Okay, any other doubt in Ind AS 116? Broadly, principally. Expected questions in the exam can be one, case study oriented, whether lease applies or not. Then maybe in the books of lessee, basic calculation regarding lease liability calculation or remeasurement. In the books of lessor, whether it's a financing lease, operating lease, and maybe to compute unearned finance income, prepare the table. Sublease, I don't expect any question. Transition approach, yes, they can ask. Sale and lease back also they can ask. Modification, yes, definitely important. Okay, so no questions. Let's go to problems then. Lessor L leases retail space to lessee Z and classifies the lease as operating lease. Lessor point of view. The lease included a fixed lease payment of 10,000 per month due to COVID-19 pandemic. L and Z agree on a rent concession that allows Z to pay no rent in the period from July 20 to September 20, but to pay 20,000 per month for the period from Jan 21 to March 21. There are no other changes to the lease. How will this be accounted by lessor? I don't expect this question going forward, but we never know. Our institute is not reliable in that sense. Suddenly they can ask one question. So what they're happening here, 10,000 per month you need not pay from July to September. So how many months? July, August, September you don't pay 10,000. From January to March you have to pay 20,000. January to March means how much? How many months? 3 months. So what is the benefit you're getting actually? You're just postponing the 10,000. No? So it's making look like as if you're getting some great benefit. 3 months 10,000 is postponed to next 3 months. Nothing else. And that is where this concession also will apply. They have given 3 points. Because of this pandemic, if there's a rent concession, you don't have to account like a lease modification. You account as if it is a regular modification, not a lease modification. So L continues to recognize the operating lease income on straight line basis. Okay, how to be accounted by lessor? If it is a lessee, then at least we should be worried about lease modification and all. For lessor, actually, this don't even apply. For lessor, whatever the money receive, you do it on proportionate basis because it's operating lease, not even a financing lease. So no question of any present value also. So you'll continue to do it over a period of months, like 20,000 over a period of 6 months. You divide by 10, 10,000 per month. You recognize straight line basis. So L does not account for the change as lease modification. L continues to recognize operating lease on straight line basis, means 20,000 over a period of 60,000 over a period of 6 months, 10,000 per month on straight line basis. Next. Okay, so let's read this one. Lessee Z entered into lease contract with lessor L to lease 1,500 square meter of retail space for 5 years. The lease commenced on 1st April 2018 and the rental payments are 1 lakh payable quarterly in advance on April 1st, July 1st, October 1st, January 1st. Z's incremental borrowing rate at the commencement of the business is 5%. Assume that interest rate implicit in the lease cannot be readily determined. There are no direct cost, incentives or dismantling cost. Z's business is severely, this also COVID only, okay, severely affected by COVID-19 pandemic. L and Z negotiate rent concession. On June 1st, L agrees to provide Z with unconditional rent concession that allows Z to forego payments of its interest due, in rent due from July 1st. That is, L forgives Z rent payment of 1 lakh due on 1st of July. What will be the accounting treatment in the books of lessee for rent concession, assuming that it is eligible for practical expedient? This is 7th, 8th. We don't have any information about the discounting rate and all, right? So we can't, or do we have? Z's incremental borrowing rate is 5%. Actually, we can calculate, but Institute has not given that solution. I don't know why. Anyway, let's quickly go to the Institute solution. What they say. Z determines rent concession is eligible, apply practical expedient, trigger variable lease payment. So therefore, Z accounts for rent concession as negative variable lease payments on June 1st. So assuming that there are no other changes, because why it's called as negative lease payment, because the concession has been given, you don't have to make payment, so it's as good as the amount is received, is what they're telling. Recognize the rent concession as a variable lease payment in profit and loss. Okay, that's all. The answer is over. Then there's nothing else to read in this problem. Whatever the benefit that you are supposed to pay, now you are not paying that benefit, you take it to the P&L account. That is all is the answer relating to this. And in addition, Z continue to depreciate the carrying amount and all. That will continue on right of use asset. That is unchanged. Only whatever the benefit you receive, in the sense you recalculate the liability or whatever the benefit you get or amount that you need not have to pay. Negative lease payments. The lease payments concession what you got, you used to write to bank. Lease payment to bank, don't do to bank, take it to P&L account, is what they are telling. So no other calculation required. Okay, so let us do this November 20 problem on sale and lease back. So maybe then we can continue further. Venus Limited, seller lessee, sells a building to Mars Limited, buyer lessor, for cash of 28 lakh. Immediately before transaction, the building is carried at the cost of 13 lakh. At the same time, seller lessee enters into contract with buyer lessor for rights to use the building for 20 years with annual payment of 2 lakh payable at the end of each year. The terms and conditions of the transactions are that the transfer of the building by seller lessee satisfies the requirement for determining the performance conditions satisfied with Ind AS 115. Fair value of the building on the date of sale is 25 lakh. Initial direct cost, if any, are to be ignored. Interest rate implicit 12%, which is readily determined by seller lessee. Present value, annual payment, 20 payments of 2 lakh each, discounted at 12% is 14 lakh 94,000. Is it same as institute metal question? Or have they modified it? Anyway, buyer lessor classifies the lease building as operating lease. How should the said transaction be accounted by Venus Limited seller point of view? Okay, I know solution is there, but let's write the solution slightly differently logically, so you'll follow it better. First, you compare what is the fair value of the contract or sale consideration. What is the sale consideration? Sale consideration is sold for 28 lakh. And what is the fair value of the building? Fair value of the building on the date of sale is 25 lakh. The excess sale consideration, excess amount that you are receiving, will be treated like loan receipt. We are going to account for sale and lease back only for fair value up to that point. The excess amount, whatever we receive, will be accounted as loan received. So it will be a what do we call, borrowing component or financing component. Yeah, additional financing, basically loan, 3 lakh. Okay, when you have to account for the lease, forget about the sale. How will you account for the lease? You will account for the lease on asset as well as liability amounting to present value of lease payments, and that is what is equal to ROU asset. And how much is present value of lease payment here? 14 lakh 94,000. But this 14 lakh 94,000 includes 3 lakh. In the sense it is towards repayment of loan. Therefore, what is towards purely about the lease is only the remaining amount. So I will take out this 3 lakh. Remaining is what we will be calling it as towards the lease. So present value of lease payments is 14 lakh 94,000 less towards loan 3 lakh So present value of, shall we say, pure lease payments? I don't know what we call it. Let's say related to lease. Present value of lease payments related to lease. Pure lease payments also we can say. Lease payments related to lease. $11,94,000. Now at this point in time, if I have to pass journal entry, what entry I would pass at this point in time? bank account debit 28 lakh, to loan 3 lakh, to whatever the fair value of consideration 25 lakh. That is for the first entry. The second journal entry would be what? Regarding lease payment purely, I will pass ROU asset account debit to lease liability. How much will I write? 11 lakh 94,000. ROU asset account debit to lease payment 11 lakh 94,000. But there is one small catch here. Because this asset is not coming to me. This asset from me coming to me. Again, you have to imagine Nityananda there. This is my own asset. I have sold it and coming back to me. I cannot recognize including profit. I have to recognize at cost. This ROU asset. So what we are going to calculate is what proportion of asset is coming back. As a percentage of fair value, if you calculate, what proportionate amount is coming back towards us. Okay, so what is the fair value of the asset if I consider 25 lakh, and how much of the 25 lakh is coming to us is 11 lakh 94,000. This is the percentage proportion coming back, and how much of the number relevant with my cost of the asset. In the sense, if I have to write a formula kind of thing, see if you are able to understand like this. Cost of the assets, I mean WDV, carrying amount of the assets, multiplied by whatever present value of lease payments divided by fair value of the assets. Is that proportionate amount straight enough to understand? Fair value of the asset is the total amount. Out of it, some total amount. What amount is coming back to us is lease payments, and proportionately I should recognize to the carrying amount. How much is the carrying amounts? A building is carried at the cost of 13 lakh. So 13 lakh multiplied by 11 lakh 94,000 divided by fair value of the assets 28 lakh. Sorry, 25 lakh. So this supposed to be my ROU asset to be recognized. How much get? 6 lakh 20,880. This all the calculation required. Okay, let me pass the journal entry one by one. See if you are able to understand. What is the carrying amount we have? 13 lakh. Out of 13 lakh, something is going out and something is coming back. What is going out? I mean, what is coming back is 6 lakh 2880. Remaining is transferred. So can I pass the transaction or account like this? This is like ROU assets 6 lakh 20,880, and assets transferred, or you can say like consideration receivable or something. I'll do one thing. Cost of asset transferred. To the carrying amount of the asset 15 lakh 13 lakh. What are the balancing figure? So 13 lakh is my asset cost at present. I'm retaining 6 lakh 2880. Balance amount I'm transferring, I'm selling. What is that number coming to? Balancing figure 6 lakh 79 120. This is like cost of asset transfer. I'm writing detailed transaction. One entry also you can pass it. 13 lakh, uh, 6 lakh 20,000 I'm retaining, coming back. 6 lakh 79 is going out. Okay, at what value I'm transferring that number? How much money I'm receiving indirectly? At what value it is transferred? Can I say like this? Out of 25 lakh, 11 lakh 94,000 is towards the lease. The balance money received because I'm selling the assets. Or I can do one entry also here. I can say, instead of doing cost of asset transferred, I can say bank account debit to the extent of whatever money received. Or I'll do one thing. I'll take out this number. I'll write bank account. I'll write full bank account. How much bank account? Uh, Full amount 28 lakh. But out of 28 lakh, one component is a loan, pure financing component, additional financing component, which is 3 lakh. Then something towards present value of lease payment, lease liability, which is how much? 11 lakh 94,000. The remaining amount is like a sale consideration towards the asset transferred, and I'm going to recognize profit on sale as balancing asset. So how much you get? Six lakh 26,880. That's all. Answer is done. The only point of understanding is this calculation. The ROU asset is not the lease liability. ROU asset is the proportionate amount of carrying amount. Because what will happen indirectly, just for understanding purpose, just for curiosity, even these ROU assets, you simply make it as not proportionate. Suppose you did not apply this. Suppose, what would have been this number? You would have taken this number only, that is lease liability. I mean, 11 lakh 94,000 only. Lease liability equal to ROU asset. You would have taken 11 lakh 94,000. Then what would be profit on sale? Can you tell me in that case? $12 lakh. And what is that 12 lakh means? Fair value 25 lakh, carrying amount 13 lakh. So 25 minus 13, 12 lakh profit recognized. On a simple terms, plain transaction, it looks like this. My book value is 13 lakh. I've sold for 25 lakh. My profit is 12 lakh. But I'm not allowed to do that because something is coming back. So when something is coming back, on that I cannot recognize my profit. Even regular transaction also, that when sale is coming back, we cannot recognize profit element on that. We should recognize like our inventory. We should value on cost basis. I cannot recognize the profit element there. Or even if you recognize that, if you take out the profit element, ultimately the transactions will look like this. So step 1, additional financing. Step 2, the liability related to the lease payment. Step 3, proportionate amount, and then you pass the journal entry. That's all about sale and lease back. See if you have any doubt conceptual. Any other doubts on this one? Okay. Buildings Limited entered into 10-year lease of 6,000 square meter of office space. The annual lease payments are 60,000 payable at the end of each year. Interest rate implicit cannot be determined. Building incremental borrowing rate is 8%. At the beginning of sixth year, the building limited and the lessor agreed to amend the original lease to reduce the space only to 3,000 square meters of original space starting from the end of first quarter of year 6, means beginning of year 6. Annual fixed lease payment from year 6 to year 10 is 35,000 per annum. 35,000. Building Limited's incremental borrowing rate at the beginning of year 6 is 6%. CFO of the company has requested your suggestion. You are only in deep trouble and is suggesting your suggestion on how to account for the modification in lease of the office space. Prepare detailed working for the modification. So this is a case of reduction in scope. Okay. First, imagine conceptually when the scope is reduced, we have two line items. One is ROU asset, other is lease liability. Which will be reduced? Both should be reduced. For the reason, lease liability is the present value of lease payments. ROU asset is the right of use of 6,000 square feet. When I am reducing my scope, my lease payment also is changing, so lease liability is affected, and my asset also getting reduced, so my right to use the asset also is getting reduced. So both are affected. So first thing is give the effect of reduction. Next step is you go for change in lease payment. So I mean interest rate change. It's changing from that 8% to 6% and all. But the first effort of ours should be to reduce or reflect the change in scope. Then we'll come to the amount. First, our objective is to reflect the change in scope. Let's calculate it. Institute has given. Okay, let's write it. So step 1 is to account for decrease in scope. So if you want to know for decrease in scope, first you should know what is the existing carrying amount of ROU assets and existing carrying amount of lease liability as on which dates. We need at the beginning of 6th year. Beginning of 6th year. Meaning just before the change. 6th year only, no? Beginning of 6th year, they are going for this modification. The original lease to be reduced by 3,000 square feet. So account for the decrease in scope of 50%. We need to account for that. Amount you worry later. Existing amount you calculate first. First of all, what is existing amount? ROU asset do they have given? At the beginning only they have not given. So we are already thinking about 6th year. We have to calculate 60,000 at the rate of 8% for a period of 10 years. So at year 0, lease liability equal to ROU assets equal to lease payments into annuity factor at the rate of 8% for 10 years. Lease payment is 60,000 into annuity factor 1 divided by 1.08 equal to 10 times GT. You get 6.71, something like that, approximately 6.71. 4,02,600. I'm just taking in what institute has taken. Approximately is fine. 4,02,000 approximately. Okay, at year 6 beginning or at year 5 end, after 5 years, at the beginning of 6th year, what will be lease liability? Can I calculate like this? Lease payments multiplied by annuity factor at the rate of 8%, comma 5 years. Which 5 year? This 5 year, that 5 year? In the means completed or remaining? We are talking about the remaining 5 years. I mean, this concept we discussed in financial instruments also. When you want to calculate the carrying amount, one of the method is present value remaining cash flows at original rate, or you can do opening plus interest minus payment plus interest minus payment. Ultimately, you'll come to the same thing. So let's make use of this. 60,000 multiplied by what will be the annuity factors? 1 by 1.08 press equal to 5 times GT. So what is annuity factor coming to actually? Approximately 3.99. 0.99. Okay. Anyway, I'm going to take the amount what institute has taken. 2,40,000 something, 2,39,000. Okay, let's do one thing. Let's make 2,40,000. I know you have to be more accurate, but where we have a chance to round off, we'll do it. 400 rupees some round off. But what institute has done, I'll quickly show it to you. They have prepared the table. 4,02,600 plus interest minus lease payment closing 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 plus interest minus lease payment closing. So 2,39,555. We got approximately 2,40,000. This is at the end of year 5 lease liability. Similarly, at the end of year 5, before that, this will be reduced by I'm just thinking how to present. Okay, 2,40,000 is the carrying amount. I'll do one thing. Let's me complete this, then I'll prepare this table. At the end of year 5, what is the at year 5 ends? What is ROU assets? I think this we should be able to do it faster. 4,02,600. 5-year depreciation is over, so I'll do 4,02,600 into 5 by 10. 5 year is over. Everything is half year, so it should not be confused. So it's 5 by 10 over, so it is 2,01,300. Both are fine because institute has done like this in the financial instrument chapter, and in lease for this problem they have done like this. So both ways it's fine. Both ways fine because two different persons, no, for the institute, but for us we are same, so we can use either of them. They should not, because the question did not ask, no, that we should do like this. Again, I cannot give guarantee. The probability is definitely not there. Because as I told you in the exam, our focus is to get answer right. Then we'll make it look like we got any differently. So this is definitely acceptable, and as long as we write the description, in the sense lease payment, multiple annuity factor. So we are showing the way we are applying it. That should be reasonable. Okay. I'll write in the next slide. I hope this is done. Okay. Now we'll account for this. What I am writing at the top, I have it, existing ROU of the set. Okay. So at the beginning of 6th year, what I'm going to do, existing carrying amount of the asset, I'm going to subtract the reduction in scope. Same thing with liability also. What is existing carrying amount of the asset? We just written 2,01,300 minus 50%. Which is 1,06,50. After subtracting this, minus 50%. The remaining amount also will be same only. If you write remaining not required, but still, if you write remaining, 650. Similarly, existing carrying amount of lease liability is 4,02,600. 50% reduction. Actually, I should not do 50% like this. What should I do is I'll take the 50% of lease payment and then do present value of that. It will come to same thing, but just a expression. 2,01,300 approximately. Oh, 2,40,000. Sorry. 2,40,000. Sorry. 2,40,000. 50% means 1,20,000. So remaining is 1,20,000. So asset also I should reduce now. Liability also I should reduce now. The difference we will take it to the P&L account. This portion, what I am highlighting in red, that is what is to be eliminated. My liability will be reduced, my asset will be reduced. My asset is reduced by 1 lakh, liability reduced by 1,20,000. So liability reducing more, the excess amount is a gain to be taken to P&L account. So gain recognized in P&L, 1,20,000 minus 1,06,50. 19,350. So journal entry will be lease liability account debit 1,20,000 to ROU asset 1,06,50 to P&L 19,350. Gain on reduction in scope transfer to P&L account. So this is the first step. You account for decrease in scope. Then you go for the new agreement, the new scope with the lease payment being changed. That will be a separate treatment. First you account for the scope change, then you account for the new lease payment being changed. Okay, let's calculate the modified lease liability. Okay, modified lease liability, modified lease liability with the new lease rental for the remaining years. So new lease rental multiplied by annuity factor at the rate of what is the new rate? 6% for remaining 5 years. So new lease rental 35,000 multiplied by the anti factor 6%, whatever it is, and we tell you the number, whatever amount you get. How much you get? Oh, 1 lakh something. 400. Okay, 1,47,400. Let's. I'm just rounding it off for my convenience. In the exam, whichever number shows in calculator, you trust it. I'm just writing for approximate thing here. Exam, trust your calculator. So this is the second step actually. You account for modification. Okay, so what is the existing liability? 1,20,000. After subtracting this 1,20,000, we got 1,20,000 revised at 1,47,200. This will be adjusted both in ROE asset as well as the lease liability. So this will be added to lease liability and ROU asset. So if I simply add it here, what will happen? Remaining we had 1,20,000. So modification, we are adding plus 1,47,400, and here also we'll add plus 1,47,400. Not 1,47,000 difference. So the difference, so not 1,47,000. 1,47,000 minus 1,20,000, which is 27,400. So add 27,400, and here also we add 27,400. So this is what is going to get you the revised carrying amount. They are not asked, but just for reference, 1,28,250 something, 1,28,50. 1,28,50, and this is 1,47,400, which is what the value of known liability is all about. Is the amounts correct? Same amount as liability. So this is what is accounting for modification. It is done in 2 steps: adjust for the scope, and then you account for the modification in the amount. Gain recognized, you mean why is it a gain? We have a liability of 2,40,000 getting reduced by 1,20,000. So liability reduction 1,20,000. Asset 2,01,300 also to be reduced. So basically we are doing a set of entry: liability account debit to asset account. Liability reduced by 1,20,000, asset reduced by 1,0650. So liability reducing more. That more liability is a gain. The liability excess amount. Okay, so that's it about this problem, modification. One more small monster, that is Ind AS 115. So only request from my side is, as far as possible, rather than looking at this standard like a law, treat it like a maths or a logic. The calculation, the reasons or the format becomes more logically interesting than a law, where law is there, we have to do it. We don't really think about why and all. Here, the more you think why, you start connecting the dots. Especially in Ind AS world, this will happen because it's more connected with, again, financial management. Okay, Ind AS 115, construction contracts. Basically it is about 5-step model. Quickly we'll go through it and some terminologies. The standard subsumes many standards existing. I don't know whether you're aware of it, so don't worry about it. It substitutes many things. 5-step models identify the contract with the customer, identify the performance obligations, determine the transaction price, allocate the transaction price, recognize revenue as and when entity satisfies the performance obligations. Okay, let's look at the first step quickly. Contract. What is the contract definition? I don't know whether you remember. Anyway, it does not matter. Contract is an agreement that enforces. There, I think enforceable in law. Here, enforces rights and obligations. The contract may be written, oral, implied, whatever name it may be. Contract term, just like the lease term, it is where you can enforce it, meaning both parties should not be having the ability to cancel. Non-cancelable period, contract term. 5 criterias you can remember. I think people say like AR, PCP. Approved, meaning the contract in negotiation discussion cannot be considered. Identified rights. One person will have the right to receive the goods, other person will have the right to receive the payments, consideration. That's what identifying the rights and payment terms. Commercial substance should be there, and the probable receipt. Probable receipt is more of a prudence principle. When you sell the goods, you should have probability of collecting it. If not, don't recognize sales. Commercial substance means it should have an impact on the cash flow of the organization. Otherwise, what will happen? Imagine we are company like Paytm, Policy Bazaar, we are looking for venture capital investor, and what venture capital is looking for? We want more sales. So I'm a startup, you are also startup. Let's do one thing. I will sell it to you, you sell it to me. I will show more sales, you also more sales. Cost, profit, they don't worry. They look at sales, top line growing is what venture capitalists look at. So like that, if people keep on looking at that exchanges, sales can be shown by any company, anybody in the world. So commercial substance means these kind of exchanges without substantial transfer, we will eliminate. So ultimately, it should have an impact on cash flow of the organization. Commercial substance. What is most relevant is contract modification. I will come to it in one more chart. There is also one more small thing about combining the contract. If there are multiple contracts entered, should we combine it to them? Typically applicable in situations like you are getting a contractor to construct apartment, swimming pool, playground area and multiple things, or you are getting a contract, or government is giving a contract to construct roads or flyovers or a separate city, where it will involve construction of house, construction of roads, construction of flyovers, many other elements. Should I combine it or should I separate it? Again, if you apply logic, you get the answer. You can combine the contracts provided the negotiation, the discussion is considered as a same package, single performance or single commercial objective, or consideration is connected. So this sale consideration, contract price is having an impact on the other contract, or goods or services are part of single performance obligation. In those cases, you can combine, or you can identify the individual revenue, cost, negotiation prices separately. You can treat as individual contracts. What is important is the contract modification. Modification means, can we extend the class today a little bit? Or we were supposed to have this for some number of days. Can we extend the class by one more day? Anyway, that is an example for modification. When you change the scope, buy a distinct product and you charge maybe separately for it, or you don't charge for it. All these comes under modification. I think many of you got heart attack that something is postponed. Anyway, don't worry, we will not do it. So when you enter into a contract to provide something additional product and you charge separately for it, so you treat it separate. Contract accounting also nothing connected with the existing one, you call it as prospective accounting. Distinct remaining products, but you change the price. Typical example we give, for example, let's say security services. We have agreed that the 12 months contract 10,000 per month, but after 3 months, not 10,000, we'll make it as 12,000 per month. Remaining 9 months is pending, and for the remaining 9 months we are changing the consideration. That's what it says. Remaining products distinct, each month service is distinct, and the change in the price we treat termination of old and creation of new. So whatever happened, that you forget. Going forward, you account separately. Newspaper changes, newspaper price, security services, accounting services, subscriptions, all those things will apply here. No distinct product and part of single performance obligation, continuation of existing contract, and here we follow retrospective basis, means cumulative catch-up basis. In the sense, again, it was part of your previous life, but in a different name. For example, you had one standard called as AS7, construction contracts, where we used to calculate the percentage of completion by like cost incurred to date by total estimated cost. That will give you the percentage of completion, and that percentage of completion will apply it on the revenues. and next year again we apply it on the revenues, so the differential is the amount to be recognized. Something like that, cumulative catch-up basis. When we apply, for example, you are a software company agreed to deliver services for 2 months, and you told in 2 months we are going to build a website for you. Maybe lot of CAs are there influenced, we keep on postponing it, and 1.5 months over, it is not likely to be completed. So what we thought of going to be there in 2 months, now we are going to extend it to 2.5 months, and we request the client, it is taking some time extra, please pay some compensation for that. So the extra amount what you're collecting is not for a separate obligation, is not for a separate product, it is part of the existing commitment, existing performance obligation. So we follow cumulative catch-up basis, means we have what is the revenue to be recognized. You remember we followed share-based payments method, closing balance method. What was supposed to be the cumulative expense closing minus the previous opening, balancing figure is the expense for the year. Same approach. What is the revenue at the end of the year was supposed to be recognized by the end of the year. Cumulative was supposed to be there. Then what is the revenue already recognized? The difference revenue is for the period. That is what is called as the cumulative catch-up basis. That's the important point in the step number 1. Any doubts in modification? This is also applicable for contracts such as, escalation clause will be there. Increase in the cost, and therefore we ask for increase in revenue, or there might be some penalty, incentive, bonus, everywhere this concept would apply. Okay, second step. Identifying performance obligation in the contract. PO, performance obligation. Let's look at definition of performance obligation. A promise in a contract with a customer to transfer the customer either goods or service, or a bundle of goods that is distinct, or a series of distinct goods and services that are substantially the same and have same pattern of transfer to customer. We call that as one performance obligation. A simple example, let's take newspaper. Is everyday newspaper different? It has to be different only. Otherwise, why will you take it? So it is distinct, but it is having the same pattern of transfers. Person will come to your place, so either you just look at the first page, last page, and you keep it aside, or don't even touch it. That is having the same method, same process. That's really not having any different approach. That is called a series of distinct goods and services. All the subscription service, accounting service will come under this element. And what is the meaning of this word distinct? For that also definition is there. Let's take a look at it. Distinct goods and services means distinct performance obligations. Distinct means customer can be benefited on its own or readily available resources, so that it is being capable of used. That is the point. Either goods are sold separately or customer has already obtained, but the benefit is more than just the scrap value. When I say being customer can get the benefit, it should be more than scrap value. You cannot say, and then otherwise everything customer can get the benefit. For example, ERP installation. Now, when you sell the ERP module, can customer start using it directly? If he can, yes, then it is a distinct product. Or sometimes you feel, no, we cannot use it as it is after purchase. Tally you can purchase, does not require much of installation. But ERP, you require the person to come to your place and maybe do a customization, do the installation for you, and provides maybe some tutoring guidelines. Then only you can start using it. So that requires an installation process. So those things should I treat it as a separate service? Or if I can think of mobile and SIM card, are they distinct? Mobile I can use separately. I can put some other SIM card, or I can use SIM card separately by putting it on some other mobile. That's what I mean. Readily available resources, or on its own, or you can have it on resources, which is distinct. But if you imagine, earlier we used to have that mobile phones where you cannot separate the SIM card and the mobile phone. There you have to treat both of them as same product. They are not distinct because they cannot be used separately. And promise to transfer separately is identifiable, and there should not be integration of service, no modification, no customization. It should not be highly independent. For example, again I told you, installation service, can the person get the service of anybody else to install ERP, or do you want that let's say SAP people only come to your place and install it? If it is a situation that only those people should come, then the installation service and the product is integrated. It cannot be used independently. So both of them is put together called as one product. But there are many cases where the installation service need not be by this company. Anybody can do. Any servicing person can do. Then service is one performance obligation. The product becomes one more performance obligation. So ultimately the point of distinction is, can the product be used independently without using in conjunction? That is what is performance obligation. A series of distinct goods and services, also I have explained it. That is a definition of second step, performance obligation. Okay, any doubts until here? Okay, next, third step. Second step was basically what the entity should do to the customer. Performance obligation, what entity is doing or what customer is expecting. Next step is the opposite, what customer is going to give it. That is called as the transaction price, what customer is obliged, series of payments, one payments, the amount of consideration which entity expects to be entitled in exchange for transferring the promised goods. This word is very, very important. Triple E or 4E, you remember. Entity expects, entitled in exchange, or exchange you forget about it. Entity expects to be entitled. That means what you are expecting it to receive from the customers. This will apply some complication, especially in the situation where there are some discount or voucher coupons. For example, they'll tell you like this, you buy 10,000 worth of goods, you will get 100 points, which you can use it in the next transaction. So next transaction, if you purchase goods worth, let's say 2,000 rupees, you are going to pay only 1,900 because you get the discount of 100 rupees. Now that 100 rupee discount when should be recognized? What the standard says is this. This 10,000 what you received is not only towards this transaction but also towards the next transaction. Therefore, this 100 rupees should be allocated to current transaction and the next transaction proportionately, and whatever amount you collected only towards this, the remaining you will show it as advance. For example, advance may be like this is 90-10 kind of thing. 90 will be taken towards this, 10 will be taken towards next. So that amount received will be shown as advance. Out of 10,000, maybe that number, out of 100 rupees discount, 90 rupee may be adjusted, 10 rupee may be shown as revenue later. There's one problem also on that, maybe some RTP question. I think I've uploaded the video also on YouTube. Please check it out on the discount or voucher. Okay, and one more typical problem it's coming in exam. It's where customer purchases in slab rates. For example, they tell you right this: if you purchase between 1 to 100 units, your price is 60 rupees per units. If you purchase between 100, no, not 100, 101 to 500, your price will be 52 per units. and if you purchase anything above 50 or 500, then it will be only a 42 rupees per unit. Now customer purchases, let's say, 70 units. How much are you going to charge him? Based on this slab, you will charge 60 rupees. But based on your experience, usually in a year, he will purchase 120 units. Usually. That means what is his average rate of purchase going to be? It will be 52 rupees per unit. Though you received 60 rupees, you know 8 rupees you are going to give it back to him in the form of adjustment in the subsequent transactions. So the 8 rupees what you received, 8 or what is that? Yeah, the additional concession is 8 rupee into 70 units. That 8 rupees you are going to show it as advance in the current transaction. If things turns out to be as per expectation, this will be adjusted in the next payment, the amount what you collected, because he will not pay you 52 rupees fully. He will adjust the 8 rupees and they pay you only the balance amount. Or if he does not purchase, the advance amount remaining on the expiry date will be transferred to the revenue. The time to expiry is completed. That is what it is entitled to be exchanged. Then various elements we have. Measurement, transaction price, it may be fixed amount or it might be variable amount. We have 4 kinds of variable factors to consider, 4 kinds of consideration. One is variable consideration, significant financing component, non-cash consideration, consideration payable to customers. Interesting point, let's discuss. Variable consideration is, for example, bonus or penalty, both ways. They might tell you if you can complete the construction within 6 months, we will give you 10% as extra bonus. Or if you don't complete the construction, we are going to charge, we are going to deduct the revenue. Both ways it can happen. So variable consideration you should recognize only when there are no constrained variable consideration. Constrained variable consideration means it's likely to be reversed. It is like this. Suppose your parents tell you, if pass the CA exam, I will give you 1 lakh, take 20,000 advance. So that day only don't go and do the party. Because if you exhaust 20,000, when the results comes, you have to give those 20,000 rupee back. There is significant chance of reversal of the amount. Variable consideration may be reversed. So without having sufficient background or sufficient past experience, you may be confident, but look at the historical things, whether in that transaction to that customer in those conditions, if it's a regular things we are being getting, it's fine. So even, for example, they might say that if you get some 5-star rating, you get 10% bonus. You do it only when you're confident that you will get it. Especially in CA exams and all, don't recognize unless it happens. Pure prudence principle. Other exams, at least out of 6 semester, you complete 2 semester, you can tell, okay, I've completed 33%. CA examination, how do you calculate the percentage of completion? You finish intermediate, can you say 50% have passed? You finished group 1, then can you say 50%? Then also you cannot. Can you say that I've passed group 1, I will sign only the liability side of the balance sheet. I'm 50% chart accountant. No, proportionate recognition you can't apply there. So there we have to wait for the event to complete. And one more typical area where this will play a role is in case of mutual funds, performance managers. Performance depends on the company, the investment. From last year 2020 to 2022, the market had a bull run. It's almost doubled. Even index itself is doubled. Forget about the stock price. And you recognize the percentage revenue. But the contract says that you have to get the commission. Your incentive will depend on 5 years average. So imagine the structure is like this. If your 5-year average is more than 20% per annum, any excess you get, half of it is yours. Did you get a typical situation like this? I have seen many clients like this. Because if I put in FD, I get 4-5%. If I put it in cooperative bank, I might get 8%. If I put it somewhere, okay, I'll get around 12, 18%. You give me 20% for 5 years. Anything excess, you take it. Some people also will tell, or some people say, you take half, you give it to me half. But benchmark is 20%. Now, last year, what happened? In 1 year only, we got 100%. No, money doubled in 2020, 2021. Money doubled. Index from 7,500 shoots up to 15,000. It reached 18,500. Now it's back to 15,600. Now again today it's back to 17,000. In this process, everybody has lost money. I also lost money. But anyway, your target for 20% for 5 year means 100%. You reached in first year itself. Let's say first year it gave. First year it came 112%. How much is your excess? Target was 20% for 5 year means 100%. You reached 112% in first year. Therefore, you have an extra profit of 12%. I cannot recognize that as my revenue because this can be taken away in the next 1 month, 2 months also. It will not happen other places. See, in other places, I was supposed to construct the building in 5 years. I did it in 1 year. I'm very happy. In the stock market, you are supposed to do it in 5 years. You did it in 1 year. Don't be happy because in next 3 months, everything can be wiped away. It happened in so many places. I'm witnessing it, and sometimes I also have experienced it. That evaporation happens in front of your eyes. It will not happen in any other place. So in those cases where there is a chance of reversal, do not recognize the revenue. That is what they say, except constrained variable consideration. And actually there are two methods of recognizing the variable consideration. One is called as expected value method. I will call it as EVM, expected value method, basically probability method. We have one column for amount expected, other column for probability, then we multiply and calculate the expected amount. So many things would have done in SFM. And this is applicable when there are more than two varieties or two possibilities, two outcomes, multiple outcomes possible, multiple probability, multiply. Or if there are only two possible outcomes like yes, no, pass, fail, either or this, then we follow MLA, most likely amount. There we don't apply probability. Whichever probability is high, that full amount we take it. That is most likely amount. Only when there are two possible outcomes. A significant financing component means we have to recognize interest separately. And there will be situations where there is a time gap between date of the performance obligation fulfillment and collection of money, but not connected with interest. Typical example you can think of is school fees. That's an amazing revenue model. For the full year revenue, for the full year fees, you collect at the beginning. In which business that will happen like that? For the full year amount, you collect at the beginning. Before even doing any performance obligation, you collect the full money. You have to make the payment to the teachers that you do it every month. But money you received full in advance. So you have so much of time value of money, but that is not towards interest component. The money received in earlier, because what if you don't collect later? People may not come later, and that is why the amount is collected advance. So these amounts are not considered as financing components. They are done for convenience. Even in your subscription fees and all, you pay in advance. They don't have interest components because the objective is not to collect interest. The objective is to protect the sale proceeds. Because if you have to pay every month, some people do not pay also. For that reason, they collect the money in advance. So the purpose is about protection, not about the financing component. There you don't have to separate it. Non-cash consideration, that is you don't pay cash, you exchange the other goods and services, you recognize on fair value basis. That's a straightforward thing. The last one is very interesting. Consideration payable to customer. Why will you pay consideration to customer? Customer should pay to us. I don't know whether you're able to understand this speciality, uniqueness. Why will you pay customer anything? Customer is the one who purchasing the goods from you, and he should pay you. He will supply component, then yeah, that is one typical case. But if you can imagine the practical situation of supermarkets, you will understand the importance of this better. Let's say you are company, Pepsi company, and you are Big Bazaar. Big Bazaar is our customer, and we sell the goods to them and they will buy from us. But what we do, we want them to place our product in certain places. It has to be where everybody can easily access it. It is should be next to the bill counter, or on the day of festival we need a standee. Like we have certain conditions, or some space should be reserved for us, and I'm going to make a payment towards it. In those cases, I'm paying the payment to, I'm making a payment to my customer, I'm getting a service like this advertisement, you can recognize separately. But sometimes it lack differently, in the sense I am selling the goods, they are also providing services. So what do? You also charge, I will also charge more. Both of us can show more expenses. Ultimate profit will not affect, but our top growth will be there, sales growth. See, these things you don't realize now. When you're in a corporate, you'll understand. When you're an auditor, you don't worry, because ultimately your thing is profit, prudence principle there. But as a part of the company, especially listed company, more than the profit, we were under pressure, we will be under pressure to show more and more sales. We want more users on the board, we want our sales to increase on exponential basis. We need the sales number to be as high growth as possible. Expense also more, that is fine. If this was not the reason, why will company like Byju's, Paytm, Credit and all get any sort of money? They are burning the cash almost literally, because they are convincing the venture capitalists that we will show more sales. That is what they, why Paytm has given so much of discount. You see that P&L account, you understand the enormousness of the Paytm. They also have given in their prospectus, I don't know anybody who actually went to read in prospectus, they said we are not at all confident in the near time future we make any profits. They use this, not exact sentence, something like this, where there is unlikelihood of earning any profit in the near future, and in which case the share price might fall significantly. They have used these words in the prospectus, and people have invested. Now it's actually being there. Devil is always in the detail. So when those company want to show more and more sales, they will pay more to customer, you pay me to me, I will pay it to you, both of us can increase our sales. If that was the case, difficult, easy to explain, difficult to identify practically. You have to adjust in the sales and you have to adjust in the purchases, in the sense you can show the payment only up to fair value. If you make anything beyond fair value of the services, then my sales should be reduced. So I have to reduce my sales, I have to reduce my cost. That is what is transaction price, step 4. Let's quickly go to step 4, step 3. Step 4 will just move towards this transaction price should be divided, allocated. Okay, allocation, so much is there, but only thing what you need to remember is you please allocate it on proportionate basis. That's the only point you have to remember from exam point of view. Allocate transaction price to each performance obligation in an amount that depicts entity's entitlement. If there are many performance obligation or series of distinct performance obligations, that is where this will apply. You do it based on SASP, standalone selling price, that is the fair value basically if the price is sold in similar circumstances as on standalone basis, as if it was the only product you sell. Take that price on a proportionate basis, you divides. This is on transaction price. Last step, that is important. Ultimately, that is where you recognize the revenue. That is important. When to recognize the revenue? When entities satisfy the performance obligation, that is when the revenue to be recognized. When the entity satisfies the performance obligations, when the goods or services are transferred. Again, the word coming back is control. In AS9 we use the word significant risk and rewards. In Ind AS 115 the word used is control. If the control is transferred, that is when the sale have taken place. So when the control is transferred? Is it the consideration paid? Is it the physical transfer? Is the legal name? All of them are just indicators. There is no one specific thing says, okay, this is when sale have taken place. Principle is we should transfer the control, meaning other person, customer should be able to use it. Right of payment, legal title, physical possession, everything is just an indicator. Everything to be read into injunction, not on independent basis. Performance obligation, there are two varieties. One is performance obligations over time, performance obligation at a point in time. This is like people will tell, right? We live only once. I don't agree with that statement. We live every day. We die once. I don't know how people use. We live only once, and you live every day, every second. Death is only once. So this performance obligation over time is a life. A performance obligation at a point in time is like a death. It happens at a point in time, and after that, it is no question asked. So performance obligation happens over a period of time. For example, okay, three conditions. Let's look at it. Simultaneously, the consumer receives the benefit, especially in case of services. For example, let's say cable, or Amazon, or this Dish TV, all those kind of things. They provide the service, and simultaneously you also watch it. So both of them happening simultaneously. So this is happening proportionate basis over a period of time. One of the three conditions should be satisfied, or it creates an asset that customer can control. For example, software company has committed to provide a website for an e-commerce company. They're agreed for to provide payment gateways, brochure of different products, different kind of things. Now, should you wait for the payment gateway to happen, or can you start releasing to the customers directly? That depends on the contract, of course. But there are many websites where payment gateway is not there. I see a website where payment gateway is there. Maybe when you fill exam form, that's there, but the purpose of IC website is not like that. So website is not, all website at least will not have a payment gateways. So the moment you have a website ready, the customer can start using it, the control is transferred, revenue can be recognized. Or does not create an asset, but it creates enforceable right to payment. This is not substance over form, this is form over substance. Means the legal terms will supersede the existing situation. You have done the work, it's not completed, the customer cannot use it, so none of those two conditions are satisfied. But do you have the right to receive the money as a compensation for the work done? This is where legal terms come into picture. If you have the right, then you can recognize the revenue proportionately. Otherwise, you have to wait for completion of it, that is performance obligation at a point in time. This particular point, when the standard was introduced, the sector which was affected most was construction contracts. Earlier, construction, these real estate companies were following guidance note or AS7, where they used to do proportionate completion method and recognize revenue. But here, imagine a real estate company building big apartment. It might take 5 years to complete. Look at one by one. Will the customer receive the benefit immediately? They will not. Will it create an asset the customer can use? It is not. But can the company ask for a compensation for the work done? That depends on terms of the contract. Some real estate developer will have a clause saying we will complete the project in 5 years, and in case the project is completed within 3 years, whatever the status it is there, up to that point we have a right to receive money from the customer. If that clause is there, many people don't have that clause. If that clause is there, I can recognize it on proportionate basis. If not, I have to wait for the completion of the product, hand it over to customer, then only you recognize revenue. Let the time be 5 years, 6 years, it does not matter. We keep showing it as our work in progress closing stock. It will not be shown as sales. No proportionate service if one of the condition is not satisfied. Two methods are there, either output basis or input basis. Either of them you can use it. There are other many more points. I will not try to mix everything here. Only one point I would like to discuss is consignment okay, principal agent okay, sale with right of return is fine, warranty you make a separate provision. This is what I would like to discuss. Repurchase agreements. You sell the goods today with an agreement to repurchase the asset at a later date, either same asset or substantially the same asset. It might be a forward contract. Forward contract means you are obliged to purchase, and the difference will be taken as a, if you are paying more, that will be taken as expense. If you are paying less, what kind of income? Finance cost, true. If I am selling the goods, receive 1 lakh rupees, and later I pay 1 lakh 10,000. 10,000 is because I'm using your money, I pay finance cost. But if I pay 90,000, if I pay less, you are having my goods, so I'm paying you less. This will be treated like a operating lease income. I mean, not a property, but conceptually, because you are having my asset, you are using my asset, and therefore the value of asset would have reduced, so I'll pay you less when I'm acquiring it. You are using the asset, the value of the asset is being reduced, so it is like a rental income considered. It need not be obligation, it might be a call option, right to repurchase, or it might be a put option where other person will have the right to sell it to you. You have an obligation to repurchase. Anyway, that is what is considered in different ways. This is one thing you should be aware of. Okay, this is the important point as far as the examination is concerned. Any questions before we take up some problems? Okay, any doubts? Don't keep on looking at the watches. We will leave at the right time. Fortunately, in class we don't have clock, because I have experienced in some other classes where if clock would be there, the moment I look at your face, the student will be looking at this clock time, just to remind the faculty that the time is getting over. And also I've seen some people, like, they will purposefully drop the calculator. Maybe if the faculty is sleeping in the class, or you put the calculator down, you could put the bag down. Sometimes you push the friend also, just to push him and wake the faculty up. That's why I always keep saying the calculator will take its revenge in examination. Till then, calculator will be silent only. You will not be using it much. On the examination, the calculator will take revenge. And I'm also a positive person. Even if calculators are falling, books are falling, people are falling, I take it positively. People are falling for my classes. So, and sometimes people sleep in my class also. That also I take it positively. People achieve their dreams. They sleep in class. You should always be positive in every manner whatsoever. Okay, let's take up some small problems. GTM Limited has provided the following 4 independent scenarios. You are advised to respond to the queries mentioned at the end of each scenario. Support your answer with relevant extract of the applicable Ind AS. Scenario 1. GTM Limited enters into contract with the customer to sell a product GTM in exchange for 1,90,000. GTM Limited will satisfy the performance obligations for each of the product at different points in time. GTM Limited regularly sells goods G separately and therefore standalone selling price is observable. Standalone selling price of the product T and M are not directly observable. Because the standalone selling price of product T and T are not directly observable, see the way they waste their students' time in exam. First sentence, the standalone selling price of the product T and M are not directly observable. Because the standalone selling price of the product T and M are not directly observable, like this if you write in the examination, just imagine what will happen to your marks card. The company has to estimate them. Okay. To estimate the standalone selling prices, see they look at the previous sentence. Company has to estimate them. To estimate the standalone selling prices, the company uses adjusted market assessment approach, product T, expected cost plus margin approach, product M. In making these estimates, the company maximizes the use of observable inputs. Entity estimate the standalone selling price follows. The question starts now. The standalone selling price is GTM 90,000, 44,000, 66,000, total 2 lakh, and you are selling for 1,90,000. So you divide 1,90,000 in this proportion. Scenario 1 is done on the proportion of standalone selling price. Let's see what they have done. 90,000 divided by 2 lakh into 1,90,000, 44 by 2 lakh, 66 by 2 lakh, the proportionate amount into the transaction price, you get 1,90,000. Simple proportionate basis on standalone selling price. Scenario 2, GTM Limited regularly sells the product GTM individually. The standalone selling price are as under 90, 44, 66. Again, same table they repeat. They could have told the above table. This is an exam question. Imagine the amount of paper, the length it would have considered. This page, next page. We don't know whether this is this problem or next problem. In addition, the company regularly sells the T and M together 1 lakh. T and M together 1 lakh. T and M together 1 lakh. The company enters into the contract with another customer to sell the product GTM for 1,90,000. GTM will satisfy performance obligation for each of the products at different point in time, for T and M at same point in time. Determine the allocation of transaction price of product T and M. So this is 1 lakh and total is 1,90,000. So indirectly we can say that T and M is 1 lakh and product G is 90,000. Adding up there only, no? Even if they don't give 1,90,000. 1 lakh is T and M together, G is 90,000. So G is 90,000, T and M is 1 lakh, and inside a T and M, how do you do it? You do proportionately 44,000, 66,000. In that ratio, the 1 lakh can be divided. That is what is scenario 2. You see 1 lakh or this is 90,000 is allocated towards the product G, and remaining 1 lakh will be divided in the ratio of 44,000, 66,000 within the two products. In the ratio they have divided. That's all. Scenario 2. Scenario 3. Okay. GTM enters into contract with customer to sell the product GTM as described in scenario 2. I think now they have learned the lesson. They said as in scenario 2. The contract also includes a promise to transfer the product Hope. So basically they are reading your mind in exam. After reading so much, do you still have the hope to read this question further? See, they have used the word GTM, some more alphabet they could have used. Suddenly the word hope is coming there. Just to give you the hope in exam. The total consideration of the product is 2,40,000. As considered here means 1,90,000 for GTM together. Now GTM and Hope is 2,40,000. So indirectly when we say 40,000 is towards the last product Hope. And the product Hope is ranging between 40 to 60,000. The broad range, yes, it is inside that broad range. You can allocate 40,000 to the Hope. You still have Hope. 40,000, 40 marks, very close. The same facts as in scenario 3 applies to scenario 4, except the transaction price is 2,25,000. Discuss how transaction is allocated. So what was the number here? 1,90,000 and incremental to 2,25,000 means 1,90,000 to 2,25,000. Incremental is 35,000, but this is not inside the scope of 40 to 65, it's outside the range. So we tell this is not the right method. They should find a suitable method. Which method? Let them find out after exams. But we just say that this residual approach is not appropriate in this context because the residual selling price is outside the normal range. So some alternate method is recommended. Something like that you can write. They've also told, consequently, entity should review its observable data, include the things, and use some relative standalone selling price. Okay, in some method you have to, it is outside the range. That's what it means. It is not within the range of 40 to 65,000. RTP May 2022 question. On 1st of April 2001, S Limited entered into contract with Corp Limited to construct heavy duty equipment for a promised consideration of rupees with a bonus of rupees if the equipment is completed within 24 months. At the inception of the contract, S Limited correctly accounts for the promised goods, promised bundle of goods and services as single performance obligation in accordance with Ind AS 115. At the inception of the contract, company expects cost to be rupees. Cost to be rupees. How much? I think it's a typing mistake or something. Cost to be rupees, and concludes that it is highly probable that the significant reversal in the amount of cumulative revenue will occur. So reversal will occur means we should not recognize. Completion of heavy duty equipment is highly susceptible to the factors outside the company's influence, mainly due to difficulty with supply of components. On 31st March 12, S Limited satisfied 65% of the obligation on the basis of cost incurred to the date and concludes the variable consideration still constrained accordance with Ind AS 115. However, on 4th June 2002, what happened in the month of June? Results are yet to come, I think. The contract is modified. The result only they're using the word. The result that fixed consideration and expected cost increase by 1,50,000 and 80 respectively. With all due respect, what they are telling. The result of the fixed consideration and expected cost, like an escalation clause. The cost is also increasing, the revenue is also increasing. The time allowable for achieving the bonus is extended by 6 months, with the result that S Limited concludes it is highly probable bonus will be achieved. So they are now confident. The contract remains single performance obligation. S Limited wants your opinion. Please give your opinion on the accounting treatment with the Corp Limited in light of Ind AS 115 for the year 2001 to 23. Okay, what is the transaction price? I think that's a missing here in the problem, right? I think that's a typing mistake. I don't know whether institute only missed in RTP question, I don't know. It is 20 lakhs. This company, not revenue. Have they given revenue also not given? Any paragraph itself is missed? I don't know. Let me check the website quickly whether I have made the wrong thing in copy paste or institute itself conveniently extracted some books without copying properly. Let me check it quickly. RTP May 2022. This is not my mistake. Institute only conveniently not copied that. Okay, then we'll have to look at the solution. Assume these were there in the question. I just hope that this printing mistake will not happen in examination. Just know that fact. Transaction price is 20 lakhs. Assume that cost is 11 lakh. So what is the percentage completion? I mean 65%. I think previous year data itself is incomplete in this problem, I think. They have given only data of 2002-3. The data of 2001-2 is I think not given properly. I think they have completed, see 45% something now they are calculating. For the 2-3, they're telling all these calculations, 24 lakh, I mean, these numbers, 1 lakh 50, 80,000. But conveniently, they ignored it. I think we cannot touch this. Just be aware, if this question comes as it is in exam, grace marks will be given provided you try it. Giving the paper blank and expecting grace marks will not come. So what you should do, if the same question comes in exam by chance, you try a level effort telling as on 31st March 2002, increase in the cost 1 lakh, increase in the cost 80,000, increase in the revenue 1 lakh 50,000. Write 2-3 lines and then write. To continue further, sufficient information seems not available, and hence the appropriate opinion cannot be given. I mean, you can't write like that, but you write that the relevant data seems missing, and hence further calculations are not done. So you don't please give grace marks and all. Just write that point and stop it, so that you are attending that and they know that you know the problem needs some more data. You will get marks. You write question number 12, do dot come out, you don't get any marks there. So that is many times I've seen, especially in SFM also, so many printing mistake have happened. People thought that they'll get grace marks, they have not got it. For the thing, only if you have made an attempt, you will get it. And institute has covered itself by giving that one line. Make appropriate assumptions wherever necessary. Institute is saved. But you can't write that in your exam. While valuing my paper, make appropriate assumptions wherever necessary. That would be nice, but this seems lot of printing mistakes are there, so I'm not going on this further. Okay, this one problem might be important for the reason it's RTP problem, but and a warranty problem. So this not complicated but important. So let's do this one problem. XYZ Limited offers 6 months warranty on its small medium sized equipment which can be put into use by customer with no installation support. The warranty comes with the equipment and the customer cannot purchase it separately. So it is integral part, integrated. The equipment is typically sold at a gross margin of 40%. X Limited made a provision of 30,000 during the year ended March 2002, which is approximately 1% of gross margin on the sales of this equipment. They are making 1% of provision for warranties and the provision amount is 30,000. So the sale should be 30,000 divided by 1%, maybe 30 lakhs. Based on the past experience, it is expected that 1% of the equipment sold have been returned as faulty within the warranty period. What is the warranty period? 6 months. Okay. See, this is where again institute is smart. Had they given like this 6 months, we would not have put the effort to search where it is. Especially in exam, this question will be in 2-3 pages. Where is that number? Read, not available. Then read, not available. Because you search for the numbers directly. You don't read the sentence. Only when you start reading the words one by one, then you will read it. So my recommendation, when you see the numbers like this in exam, please highlight it or write somewhere so that it is easily accessible. 6 months on 31st March 2002, which is approximately 1% gross margin. Based on experience, 1% of the equipment sold returned faulty within the warranty period. Faulty equipment returned to XYZ Limited during the warranty period are scrapped and the sale value is fully refunded to customer. Assuming the sales occurred evenly during the year, how should XYZ Limited evaluate whether any additional warranty provision is required on the equipment sold in the past on March 2002? Had the warranty period been 2 years instead of 6 months? Here also the number 6 is not visible. SIX. What additional criteria would XYZ Limited need to consider? Okay. it is actually not 1% of sales, no, 1% of gross margin. They are playing with our feelings in exam. 1% of margin in a sense, then what is their margin? 40%. So can I say like 1% off 40%? My warranty provision is 0.4% of sales. 0.4, 0.04. 40 into 0.01. 0.4, just do the 30,000 by 0.4%. 75 lakhs. Okay. So 75 lakh is the amount of sales. And 6 months warranty. And they said, I think, accrued evenly during the year. So for the sales made up to October or September end, 6 months is completed. But for the sales made from October 1st to March 31st, 6 months is completed. I mean, on an average, if we take it, November means 5 months over, 4 months pending, and then 1 month over, 5 months pending. If you sell in 31st of December, then 3 months over, 3 months pending. On an average, if you take like that, you can say that half is still pending, 6 months sales. So what they have calculated, 40% of age. Okay, they could have given percentage. Good. This is extreme. Okay, we got the fact that 37 lakh 50,000, I mean 75 lakh was sales, and half of it, if you take only 6 months, 37 lakh 50,000, 1% of it, 37,500. But provision we already made would be 30,000, but the likelihood of value is 37,500, because they said based on experience 1% only will come back. So 1% will come back. So 1% is the returns expected of only 6 half month sales, not the full year sales. So 75 lakh, half year means 37 lakh 50,000, 1% means 37,500. Already made 30,000, so you have to increase the provision by 30,000. Would it be okay? What would be the change if the warranty period is 2 years instead of 6 months? Okay, if it is 2 years, then making a provision for half year sales not sufficient. You have to make a provision for full year sales. Full year sales means 75 lakh, 1% means 75,000. 75,000 already made provision is 30,000. So additional provision of warranty required is 45,000. Okay, so this is about Ind AS 115. Any other questions that you want to ask? That is time value of money, no? Like if it is more than 1 year, the amount you are going to spend, it is present value. And that discounting rate should be pre-tax rate, some story and all they are telling that you're not required to write it. And that is not only with respect to this problem. Anything in general, if it is beyond 1 year, normally we discount it, and the discount rate should be pre-tax rate, and it should reflect the proper currency and the risk. All those things should be there. This and all is not required. That discounting rate shall not reflect the risk which affect the future cash flow. Not required. Okay, so let us have next problem. Smile is the answer.